want to go skiing. Where should I go? That agent will then broker with agents at different resorts. And I think it's going to completely change the way people plan trips, the way they buy passes. So I think in many ways, what we've seen with the Epic Pass and Icon Pass and other passes, we're going to see a complete change in the relationship of how people buy products, plan experiences, and it's all going to be hyper personalized. Like, yeah, I have this thing I always say is like, have my people call your people. That's like the joke that they've always said on cartoons, and that's the way I think people are going to plan their trips.
You're talking about agentic AI, right?
Absolutely, yeah. Agentic AI, where everyone has their agent, each business has their own agent. Different, like I see a world in the next few years where it's not just Epic and Icon as the leaders. I think there's probably 20, 30, 40 flavors. The technology we're building allows any resorts to team up together, have different segmentations. It's really exciting.
I totally get it. Hey, just one thing I want to ask you, climate change, is that creating opportunities for you, especially when it comes to inside kind of ski experiences?
Yeah, you know, I think it's definitely easier to operate a business when you don't have to worry about the weather. You know, we have our outdoor resort and our indoor resort, and it's really easy to, you know, what's interesting about operating Big Snow is it's kind of like retail, where I can literally predict what we're going to do almost every day because of it's so consistent. When you have, you know, the changes in the climate and you have different variables, you need to be ready for what if we have a slow start like we're seeing out in the West right now. And I always remind people that you have to have a good pre-sold strategy. So Vail has done great with the Epic Pass. They've sold them. Same thing with Alterra with the Icon Pass. Resorts know how to make sure they protect themselves early. And I always tell the skiers I have a bunch of trips planned out West this year, don't judge the early start for the whole season. This could still be an amazing season out West. I was at Jackson Hole on Monday. They're getting a massive storm this weekend. So, you know, I wouldn't give up on the season on the West. I think we have good ski days ahead of us.
Hey, Joe, to Carol's point about other parts of the business, if we think about Snow Partners and the umbrella organization, how much revenue comes from actual operations of Big Snow and Mountain Creek versus SoundCloud snow operating business and SnowGo, the bikes that you manufacture and sell?
Yeah. So revenue-wise, we're probably... so high level, think of like 100 million in revenue. We're doing 60 in operations at this point. The rest of it is primarily focused in SnowCloud, our software technology. As far as where the growth opportunity we think SnowCloud is going to be the Shopify of experiences. We work with Stripe on our platform. We're really lucky to be one of their category leaders in the space that we're in. And I think we can see growth with SnowCloud that's not just in the ski business, but water parks, amusement parks. I feel a way that Shopify has opened up the doors for people who want to be in retail at all sizes and levels. I think that's what we're truly trying to build with SnowCloud. So that right now is not our largest business, but I always tell people it is by far our largest opportunity.
Just going to say, I love the Mountain Creek Water Park. Did that with my daughter. It's pretty wild. It's pretty wild. I actually had the wind kicked out of me out of one of the rides, but it was a lot of fun.
That's how you know you had a good time.
There's no water park like that in the world. One of a kind.
It's crazy.
Joe, appreciate you joining us. Joe Hession, founder and CEO of Snow Partners. I'm going to see him on the slopes.
Yeah, you should try the water park. It's wild.
Anytime. I'd love to take some turns. Thank you for having me.
Take care.
All right, we'll see you later. Joe Hession, founder and CEO at Snow Partners. Hey, just a reminder of where we are in terms of how things closed out the day today. S&P 500 up 0.8%, so off its best levels of the day. The NASDAQ, though, up 1.4%. The Dow up 0.1%.
I'm Carol Massar along with Tim Stanvick. Let's get to some stocks on the move. For that, we're joined by Bloomberg News equities reporter Jordan Fitzgerald here in studio. Where shall we begin?
That's up to you guys.
No, it's up to you.
I guess let's do the most salacious thing first. Pot stocks had quite the day. Trump did ease restrictions on cannabis as was expected, and instead of boosting the group, it actually had the opposite effect. The MSOS cannabis ETF fell about 27% today. I know. That's the
but worst. They initially rallied.
Exactly. So they had the worst day since last November today, but last Friday had their best day ever. The ETF was up 55%. So I think it was a case of people getting a little high on their own supply a little too early.
Hey, look at that.
I was just waiting for it.
But
even in today... What?
Was it because it was priced in, or was it because people think the legislation doesn't go far enough?
People have been expecting this legislation for a while.
They also want the banking stuff, too.
Exactly.
The Safe Banking Act.
But we kind of got exactly what we were told we were going to get and not more. And who doesn't want more?
I mean, like Canopy, ticker CGC, was up Friday 54% on the day. And then today, earlier, because I was going to use it as gainers.
Sorry,
I
girl.
thought you were going to say you were going to use it as a product.
No. But it was up 24% in today's session, and then it ended down about 12%. So you're right. It was quite a ride, right?
Quite a ride. And these
That's what
stocks
happens when you get high. It's kind of quite a ride.
They tend to,
Can I say that on
I
air?
don't know, man.
it's the end of the day.
All right, I'm going to move on because there's 4 that I want to get to. I want to now get to a couple in the after hours. Nike shares. The results were good. We spoke to Poonam Goyal over at Bloomberg Intelligence, but we're seeing some selling in the after hours.
Yes. So initially, everyone saw these results, thought they looked good, but belied some more concerning troubles. There's still softness in that giant China market, and that really is an important one. Some of its legacy brands also aren't faring well. Converse, for example, didn't post the strongest quarter. And it's been over a year now since Nike's had this new CEO who's promised to turn the company around. I know time moves crazy.
I cannot believe it's been a year.
I know.
It's wild,
I
right?
believe it was last October.
Yeah, it's kind of,
Don't
I
quote
think
me
about
on
it the
that.
same time as like when Brian Niccol was announced
Yes.
at Starbucks.
It's a big company, though.
It's a big company, and it's a company that used to be quite cool. And I think people expected a lot from this turnaround, and maybe the market is asking, has it been enough, even if it looks good?
Poonam Goyal agreed with that the things that they are doing, and Elliot Hill, the president and CEO, is doing is on target. It just takes a little bit of time.
Okay, what about FedEx, ticker FDX?
FedEx, opposite story. FedEx shares, last I checked, were up 2.5% about in the post-market, and FedEx narrowed its full-year EPS guidance to the upside and also posted a quarterly beat on profit. And that really comes from the fact that demand is improving, yes, but FedEx has also managed to pretty deftly cut costs and ride out these headwinds.
Yeah, stock up 2.5% still in the aftermarket. So yeah, holding on to gains. We didn't talk about Micron.
Oh, I saved it for last because it was the one that set the tone for the day's trade.
Exactly. Who could
Nice.
talk about the movers
Well
of the
done.
day without talking about Micron? Micron shares up 10%, best day since April, since that Liberation Day craziness. And I think these results were really a important test for the market because Oracle disappointed, Broadcom disappointed, and so we needed one of these AI names to show us that this rally was justified for the broader market. And so that's why we had this rally today, because traders could take a breath and say, okay, we haven't been pumping up AI stocks for no reason. Like, there is still something to go on here.
Micron now up 195% year to date. I believe, isn't it like one of the top gainers in the S&P 500 this year?
Yes.
Yeah.
Robinhood, also among
Is
the
it?
top gainers. Yeah.
That's kind of fascinating. I'm just looking at the, pulling it up here, and we still have a few more days until we get the ultimate end-of-year list.
That's when
Let's not jinx ourselves.
Yeah, I was going to say, we don't know what's going to happen.
Robinhood is the number 4 gainer in the S&P
How much this
500,
year?
214% to the upside, followed by Micron, which is up 195%.
And the number 1?
SanDisk,
Yeah.
more than 500%.
Pretty wild, isn't it?
I feel like every day I check the movers and SanDisk is there, and I'm like, oh.
Love it. Jordan, thank you so much. Catch Stock Movers, 5-minute episodes of the biggest winners and losers. You can find it on Apple, Spotify, or anywhere you get your podcasts. Have a good and safe evening. That does it for us. Balance of Power starts now.
This is Balance of Power, live from Washington, D.C.
From Bloomberg's Washington, D.C. studios to our TV and radio audiences worldwide, welcome to Balance of Power. I'm Joe Matthew. Tonight, the affordability blame game. In a primetime address to the nation, President Trump touting progress made on the economy and blaming the mess, as he put it, he inherited from President Biden. Is his message landing with Americans ahead of the midterms? Also, the Obamacare cliff. Lawmakers heading home for the holidays with just days until health care premiums are set to spike for millions of Americans. Speaker Johnson says a vote on subsidies is set for January. But after weeks of infighting, it is unclear what Congress will pass. Plus, half-baked, President Trump signing an executive order to reclassify marijuana today. But Does it go as far as some expected? We'll look at how cannabis stocks are responding. And Patriot Games, the president unveiling a packed agenda to commemorate the nation's 250th birthday next year. Events including a parade, high school athletic competition, and the largest fireworks display, they say, in the world. But we begin this evening with Congress about to dash out of Washington without a health care fix in hand as the president looks to shift the narrative on the rising cost of living, doubling down today on his administration's accomplishments in a frenetic primetime address to the nation, facing mounting anxiety over economic agenda heading into 2026.
We're bringing our economy back from the brink of ruin. Wages are rising much faster than inflation. There are more people working today than at any time in American history. 1,450,000 military service members will receive a special, we call, warrior dividend before Christmas. I'm also taking on the gigantic health insurance companies. I will announce some of the most aggressive housing reform plans in American history.
Joining us now with the latest here in Washington is Bloomberg's Mario Parker with his eyes on the White House. Mario, I'd like to start with what we heard and saw from the president last evening. Thanks for joining us. 18 minutes in prime time. Potentially a different audience than he would get going live from the Oval in the middle of the day. Did he win the message? Did he win the day?
Not sure he won the message necessarily, but the White House had to try to figure out a way for the president to deliver a sharp message within the confines of some type of structure, right?
Yeah.
The first outing, which we saw last week at the Poconos, didn't go quite so well. We saw the president be himself. It was a sprawling speech. It was memorable for a few things. One of them was a foot fault on the number of dolls or pencils children can have, right? Or attacks on immigration, et cetera. Well, yesterday it was a little bit more confined, a little bit more structured, but nevertheless, we still saw the president kind of begrudge having to deliver the message.
We didn't hear the word hoax. We didn't hear con job, as he's been suggesting. Democrats came up with this affordability crisis. I'm sure that the staff and the folks who wrote the speech were happy about that. But stylistically, the president racing through the copy, barely taking a breath, at times seemed to be shouting into the microphone. Is that the lack of an audience that left him in a different environment?
It's such a brilliant point, and it's the conundrum that the White House finds itself in. You put him on the road in a place like Pennsylvania, and he goes off script. You put him in those confines, and this reality TV president, and this is from talking to the aides who describe him as a reality TV president, he's not quite comfortable in those environments either. Americans voted for Trump in part because they feel like, oh, he's a straight shooter, his comfort in some of those rallies and those stages. Now, that's the disconnect that they have.
Pretty amazing. News today from the press secretary, Caroline Leavitt, that the Kennedy Center, as we all call it, is being renamed. Maybe not a big shock to the Trump Kennedy Center. The chairman of the board claims he knew nothing about it.
Yes, and he's packed, since coming back to the White House, he's packed the board, obviously, with a bunch of loyalists. So, surprise there. What's unclear is a theme that we've seen throughout the past year, just a legal mechanism for it, whether or not at the end of the day, this is a power that rests with Congress to rename the center.
Sure. Will he get a vote? Guess that remains.
We will see.
Mario, don't be a stranger. It's great to have you back. Bloomberg's Mario Parker helping to run our coverage here in Washington. While President Trump's speech focused on economic progress, as he put it last night, today we received some data. In fact, receipts he might have preferred to have had last evening, showing underlying U.S. inflation rising in November at the slowest annual rate since early 2021. The report's findings muddled, though, by the government shutdown, which prevented the BLS from collecting much of the October and November price impacting the annual figures. Joining us now to break it all down for us, Anna Wong, the chief U.S. economist at Bloomberg Economics. Anna, great to see you. The headline certainly reassuring. Do the data under the hood support that idea?
Yes, so this CPI report is particularly noisy because the survey period in November only covers the second half of November, which was when Thanksgiving and Black Friday sales were there. So this is why many economists, and we one of them, believe that the downward bias of core goods prices are showing up in this report. Nonetheless, with that said, Joe, I will say that our team has collected millions of prices covering the whole month of November. We did notice that prices are indeed coming down. It's just not coming down as steeply as today's report, but there is some truth in that trend of coming down.
The President spoke to the economy directly in that 18-minute address last night. Here's a taste of what he said.
For the first time in years, wages are rising much faster than inflation. Remember that. The wages, just look at it. Wages are going up much faster than inflation. How big is that? Very importantly, there are more people working today than at any time in American history.
Do the data support what he said?
I think what he's referring to is real wages, so nominal wages adjusted for inflation. If you look at nominal wages, that statement is not true because the pace of growth has actually declined. We saw in the employment cost index a couple of weeks ago, now it's growing at 3.5% in the last quarter. But however, corrected for inflation, it is going up.
Anna, thanks for being with us as always. Anna Wong of Bloomberg Economics, we thank you. The House is on the verge now of leaving town after passing a Republican-backed health care plan last night. That does not include an extension of Obamacare subsidies, one of the big sticking points among lawmakers, and in fact the grounds for the longest shutdown in American history. Last evening, we spoke, though, with one of the 4 moderate Republicans who crossed the aisle and sided with Democrats over the discharge petition for a vote on the extension of ACA credits. That would be Republican Congressman Mike Lawler of New York. His reasoning here for voting with his Democratic colleagues. Listen.
Unfortunately, we couldn't find agreement, and so I had no alternative but to sign the discharge. I've signed 3 separate discharges, 2 bipartisan bills, and 1, the clean 3-year extension offered by Leader Jeffries, has already failed in the Senate. But the objective is to force a vote on the House floor, pass something, and let the Senate come back to us with a bipartisan agreement.
And that might happen, but there's still a lot of gray area here. And joining us now with his reaction, Lawler's colleague from New York, Congressman Republican Nick LaLota, a member of both the House Appropriations Committee and the House Small Business Committee. Congressman, it's great to have you back on Bloomberg TV and radio. It looks like this vote will hit the floor, according to the Speaker, in January, the discharge petition. Do you share the view of Mike Lawler? What's your position on this?
I do. I do support Lawler's efforts. He's got his head on straight on this. We do need a bifurcated approach. And last night here in Washington, Republicans passed the Lower Health Care Premiums for All Act that, according to the CBO, who doesn't often score Republican bills quite favorably, said that premiums for everybody would decrease by about 12% as a result of that bill. That bill should get support in the Senate. We hope that it becomes law to help some of the long-term issues for all Americans' health care. But Lawler's right. We do need to do something in the short term for these expiring health care credits that, unfortunately, 3 years ago were said to be merely temporary and pandemic related. Nevertheless, millions of Americans have come to rely on these credits. We should extend them for some period of time in exchange, I think, in a bipartisan deal for some of the longer-term reforms that can help Obamacare, which has some cracks in its foundation. Obamacare, in the 15 years that it's been law, has led to 1 in 3 claims being denied, premiums rising 60% more than inflation, and those healthcare companies are making $1 gazillion along the way. All those things challenge constituents like mine, and we do need a bifurcated approach like the one that Lawler described.
Well, the way you just talked about that, and I know that there are a growing number of Republicans who seem to agree with you here. We're so close, Congressman. Is Speaker Johnson just a man out of time right now?
Listen, there's always time on the clock. When we get back in January, that bill will be on the floor, the clean 3-year extension. I expect it to pass with probably 230 votes or so, and the Senate will have to contemplate what it does with that. Of course, that bill failed a couple of weeks ago, maybe a week or so ago, but it'll have to contemplate what it does. Will it just shut that bill down again? Will it not take it up? Or will it provide the impetus necessary for a bifurcated deal that both solves the day for those who rely on those credits, But in the long term, for the 93% of the other Americans who are not on Obamacare, will we be able to get a conservative plan through like the one the House passed last night? I think there is a path to achieve both victories, and I'm hoping we could do so in early January.
You know, we heard from the president and have been hearing from him repeatedly about the approach to health care that he prefers. And at one point, he suggested a deal like the one you're talking about should be needed. Now he says he doesn't want the money to go to the insurance companies. And we may as well use his words. Listen to President Trump.
We have a problem. The insurance companies own the Democrat Party. They own it. And the Democrats having a hard time. They give a lot of money to the Democrats. Very little money to Republicans, by the way. A lot of money to Democrats. And they're going to have to decide, do they want to do the right thing or do they want to be beholden to the, insurance companies? They're making a fortune. I want the money to go to the people.
What do you make of this, Congressman? Because if you start sending money to the people and then they're all approaching the insurance company alone, I guess working out rates over the phone somehow, wouldn't that take leverage away from the consumer? Or is there a way to make this work?
President Trump, a populist president, is exactly right. The better method, rather than the U.S. Treasury cutting a check for tens of billions of dollars per year to these insurance companies who have profits in mind, not their patients. A better method than the Treasury doing that is to send the money directly to American citizens. I actually have a bill on that would create a tax incentive, a tax deduction, and an above-the-line tax deduction for those who are on Obamacare. I think that is a better solution to the cliff that is happening with the expiry of these credits. The president is right. If we're going to invest money, American money in this, we should give it directly to Americans and allow them to make smart decisions, allow them to have autonomy and discretion in what they do, and let them have leverage when they're negotiating and whatnot. I think that's the better path ahead, and maybe it's one that the House and Senate will undertake in early January.
Well, I know that money does cut both ways. Open Secrets has insurance PACs giving $10 million to Democratic nominees, $14 million to GOP nominees in 2024. But I want to ask you about the budget. We talked to Jody Arrington earlier today. He seems to think that there is a chance to not only avoid a shutdown, but do it with regular order, Congressman. Are we serious about this? It's been a generation.
Yeah, I serve on the Appropriations Committee. We had a nice meeting today where our understanding is there's a bipartisan, bicameral approach that we'll undertake in early January to get a series of 9 bills across both the House and Senate floor, 3 at a time, 1 per week for 3 weeks in January. I'm hopeful that everybody is operating in good faith towards passing those bills. We certainly can't avoid another shutdown. We shouldn't have another continuing resolution. Instead, we should get all 12 of our appropriations bills passed under the leadership of House Chairman Tom Cole from the Appropriations Committee. I'm confident that we'll do that path 3 by 3 by 3 in January.
That would be news for sure. Congressman, our listeners and viewers should know that we're talking to a former naval officer, and I want to ask you about the tensions in the Caribbean right now as the president announces the blockade is the word that he's using for these oil tankers that will now apparently be traveling with Venezuelan naval export. What are the rules of engagement here? Are we entering a shooting war with Venezuela?
The president is serious about securing our border and keeping America safe. He's serious about deterring Chinese involvement and over-influence in our hemisphere. And Venezuela, Nicolas Maduro, has been an adversarial to that end. And I think that what he's doing on striking the terrorist boats, the narco-terrorist boats, is in America's best interests, and ensuring that Venezuela doesn't continue to poach upon American lives is also in our best interest as well. And we hope to achieve peace through strength. Deterrence is the better option, and we hope to have a peaceful transition to that through Venezuela sometime soon.
You were a tactical action officer on the Carl Vinson, I see, Congressman. Thank you for your service. Are you going to go to the Trump Kennedy Center soon?
I don't have any plans to go to the Trump Kennedy Center anytime soon. I just heard about the renaming of it. I'm sure that'll anger some of my friends from across the aisle. I couldn't care less what the heck they call that center. I'm focused on trying to make prices lower, our nation safer, get out of endless wars overseas,
I hope that my friends across the aisle don't take the bait on the naming of that center.
Well, I'm glad you could come see us again. Republican Congressman Nick LaLota of New York, we thank you for joining us again on Bloomberg. It was a busy afternoon on Wall Street. Nike and FedEx both with earnings results after the bell, and both stocks are moving. Nike exceeding earnings expectations, FedEx raising the low end of its full-year profit and sales outlook, but stocks are moving in separate directions here. For all the details, we turn to Power Moves with Bloomberg's Romaine Bostick live from World Headquarters in New York. As goes FedEx, so goes the nation, Romaine?
Yeah, interesting. I mean, they are, both of these stocks to a certain extent, Joe, are bellwethers for the consumer economy, none so more than FedEx. And of course, this has also been a company that's been in a bit of transition, really trying to get its legs back after a series of missteps under previous leadership. What they've done as of lately, Joe, is to put much more of a focus on B2B deliveries, basically higher margin, larger packages that effectively they're going to make more money off of, and that appeared to work. In the most recent quarter, I could sum it up like this. It was pricing power, it was cost cuts, and it was higher domestic volume, particularly here in the U.S. That's why you saw the beat, and more importantly, that's why you saw the confidence they had in the guidance that they gave, the idea that some of the momentum they had in the quarter that just ended, in their view, is going to continue in the quarters ahead. So you get a modest bump in the stock here in the after-hours trade. Now take a look at Nike, because this is also a turnaround story. They also beat on several key metrics. They also are trying to guide people slightly higher. But the shares are plunging largely because of concerns about two key components of the business: China and their direct-to-consumer business. Basically, when you go to Nike.com, for example, and buy something, those two businesses were down. They've been down for quite some time, and there's a lot of concern as to whether the new CEO, Elliott Hill, can sort of arrest that slide, bring it back into some of the growth rates that we're seeing in other parts of the business, like the wholesale business, as well as their domestic North American business, which actually has been doing better, Joe.
All right, interesting turn for the cannabis stocks today. As Nathan Dean at Bloomberg Intelligence likes to say, these stocks have hot sauce on them, whether they're going up or down. The president actually signed the rescheduling order today, Romaine. Is this a sell the news kind of thing?
Oh, yeah, absolutely. I mean, you just take Curaleaf, for example, which is kind of one of the bigger publicly traded cannabis stocks. Remember, that they had rallied like almost 40% just over the last few days. They dropped about 30% today, kind of again, sell the news event, if you will, Joe. But all those names that you have on the screen there, yes, they are down today by a lot. But if you sort of look at the run-up that you had in some of those names over the previous few days, and if you were lucky enough to be at the start of that, you did okay, Joe. And, you know, the president's order, again, it gets to this idea, the changes from that order really won't kick in for a while now. So it'll be interesting to see whether we actually see a material impact on actual sales going forward. But, you know, I think overall cannabis investors have been relatively pleased with the direction this administration has taken with regards to regulation in that space.
Who would have thought it would be a Republican president making this happen? Bloomberg's Romaine Bostick. Good to see you.
Strange bedfellows.
Yes, indeed. Coming up, we'll have more on the marijuana move today at the White House with Bloomberg opinion columnist Nia Malika Henderson. And later, could we see another government shutdown? Nick LaLota doesn't think so. But we'll discuss with a Democratic lawmaker coming up straight ahead on Balance of Power on Bloomberg TV and radio.
was honored by it. The board is a very distinguished board, most distinguished people in the country. And I was surprised by it. I was honored by it. You know, we're saving the building. We saved the building. The building was in such bad shape, both physically, financially, and every other way. And now it's very solid, very strong.
It's Balance of Power on Bloomberg TV and radio. I'm Joe Matthew in Washington, where we heard from President Trump a short time ago there, responding to news that the Kennedy Center, the board at the Kennedy Center, unanimously voted to change the name to the Trump Kennedy Center. It should be noted legally its name remains the Kennedy Center after Congress established the living presidential memorial through federal law more than 60 years ago. Joining us now with her reaction to this and a lot more is Bloomberg opinion columnist Nia Malika Henderson, live with us here in Washington. It's great to see you. Tickets were already having some trouble there after the president dispatched the board, made himself chairman. A number of touring groups canceled. Is this going to make it worse?
Yes, it absolutely is going to make it worse. They were already down 50% year over year. Shows canceled. Alvin Ailey, for instance.
Right.
Hamilton. Also pulling out. So this isn't good. You know, and the important thing to note, I think you led with it, which is this is by law named the John F. Kennedy Center, and it's a living memorial. It's like changing the Lincoln Memorial to the Trump Lincoln Memorial or something.
Well,
you know,
just put
we'll
it
see.
out there.
I know, we'll see. So you know, this was something he sort of joked about when he hosted the Kennedy Center, and this was something that people in Congress, in the House, they put forward bills to rename it, to rename the Opera House, the Melania Trump Opera House. Also, that wouldn't be legal. So we'll see. I mean, this is, you know, it's kind of like the Department of War. It's kind of like, what is it, the Gulf of America now? There are all of these sort of renaming attempts happening. But, you know, I don't suspect this will really go anywhere. They're not going to change the name on the building. But listen, we'll see.
Well, yeah, and they just might.
Yeah, they just might.
We'll see about that. It could take some time to remake all the stationery in a couple of years. But I want to ask you about what the president was up to today on a policy standpoint. He signed an executive order and surrounded himself in the Oval Office by pro-cannabis activists, largely medical marijuana activists, some of them wearing lab coats, which was interesting optics, to reschedule cannabis. This is something he floated on the campaign trail, but is undoing generations of Republican orthodoxy in the process. Who is this for?
Listen, I think it's for some of these MAGA folks. I think it's for some of his donors, quite frankly. I think for, if you're in a state where it's legal, the fact that now it is changed its classification, this is going to mean something financially now, because you can write down expenses in a way because of this classification. So I think it'll mean something for these businesses that are popping up, and they're doing quite well in these states. So, but it is quite a shift, and it'll be sort of a further destigmatization around cannabis use, I think. But it is a little bit surprising to see a Republican president do this. But again, this is a Republican president that has a sort of mixture of ideologies, a mixture of, in terms of his base and who are the folks who voted for him, working class folks, African Americans, men in particular, the sort of podcast bros and the manosphere. So I think there'll be a lot of...
Stone, while we're at it.
That's right.
In our remaining moment, you've surely watched the president in prime time last evening. He wasn't talking about this. He was talking about affordability. And to a different crowd. This wasn't, I'm guessing, the MAGA base sitting at home watching the finale of Survivor, and suddenly Donald Trump's on your TV set in prime time. Did he succeed in delivering the message?
You know, I think once you start to get to thinking that this is a messaging problem, thinking that you can sort of message reality, it's a problem, right? You can't really reframe people's actual experiences of higher prices. We see some prices coming down. He talks about eggs, for instance. But overall, you know, if you go Christmas shopping, the prices are a little bit higher. You know, I got some Omaha steaks for my in-laws. They were a little bit higher this go round.
You know how to treat the in-laws. I'm still trying to figure out, why was he yelling? I don't. He was shouting. He was not happy. He did not want to give this speech. Apparently, he was forced to give it by CC
ran through it. 18 minutes on a speedboat. Nia, great to have you. Nia Malika Henderson, only here on Bloomberg. Coming up, health insurance costs set to soar for millions of Americans. We'll address the cliff next on Bloomberg.
Mike Johnson and House Republicans leaving town when there is legislation supported by a bipartisan majority of the House that would extend the Affordable Care Act tax credits for 3 years. We should pass that bill and then send it over to the Senate before the end of the year, before the Affordable Care Act tax credits expire.
This is Balance of Power on Bloomberg TV and radio. I'm Joe Matthew. That, of course, House Minority Leader Hakeem Jeffries, who was speaking this afternoon about last night's passage of the Republican plan for health care, the proposed bill that does not include an extension of Obamacare subsidies. That passage coming, of course, after 4 moderate Republicans joined Democrats separately here to force a vote to extend the ACA credits for 3 years. That vote set to take place sometime next month. That's the way a discharge petition works. And joining us now to break down what comes next on Capitol Hill is Bloomberg's Eric Wasson. It's great to see you, Eric. You've been in the middle of this now for weeks and going back before it even caused a shutdown. It feels like we've got a half dozen bills here, some of them discharge petitions, others are bills waiting to get to the floor. Is there a world in which lawmakers return in January and actually craft a deal?
I think there could be. I talked to Senate Majority Leader John Thune about this, and he actually said he was looking forward to a compromise emerging. It would have to have reforms. He says the 3-year clean extension that the Democrats' discharge petition would set up is dead on arrival in the Senate. But if there are reforms, if there's some way to incorporate Republican ideas, he'd be in favor of it. He talked about people in South Dakota, where he is from, being affected by this. But Democrats certainly feel that they're in a win-win position. Jeffries in that press conference says this is the Titanic for the Republican Party. Either they get a win on this, force an extension of the ACA, or they take it to the voters in 2026 and really make it a centerpiece of their campaign. Mike Johnson, on the other hand, is preparing to go to the voters and say Obamacare itself is broken and Democrats are responsible for 15 years of health care increases. So that's really setting the table for next year's campaign. We had Nick Lalotta on air. I just talked to him off the camera, and he said Johnson's engaging with the moderate Republicans on trying to turn off this discharge petition, maybe offer them a vote, which they were originally seeking, on a compromise by Brian Fitzpatrick, which would extend it for 1 or 2 years in exchange for some income limits and other reforms. So this is very much a live ball. They'll be talking over the Christmas break, potentially coming back and doing some quick action to turn off the discharge petition through a rule and getting a vote on a Republican plan. So there's a lot of different options here. There is a chance, but as Thune said, it's not likely, it's not impossible, it's somewhere in between. I think that's about right.
That's really interesting, and that's pretty big news. Just to quickly, Eric, if that discharge petition was turned off, would the bill get a vote in January still the same?
No, it would not. The discharge petition can be turned off by a rule, but moderates would only vote for that procedure if they got a vote on their own preferred plan.
Got it. Great reporting. Eric Wasson, thank you so much. Live on Capitol Hill on the front lines for Bloomberg. Today on the early edition of Balance of Power, we spoke with another member of the Republican Conference, Congressman Jody Arrington of Texas, who's in fact chair of the House Budget Committee. Talked about the prospect of another shutdown when Congress returns in January. Here's what he said.
I don't think that Democrats and Republicans are going to be able to work together. I think many of the Democrats, not all, but the leadership wants health care to be a wedge issue for November. There are others who want to actually address it. We have different ideas on that. But Republicans have the tool that actually Democrats use to create these COVID-era subsidies called budget reconciliation. It gives us the simple majority in the Senate, so we don't need Democrat support. We did that with the big, beautiful bill. Let's do it to make health care affordable. Health care's got to be addressed, and I think the only way to do it, Joe, and unfortunately, because I think it's better when we can work together, but we shouldn't apologize for using reconciliation and having taking a unilateral approach as Republicans if we believe in our policies, and I certainly do.
So the chairman throws a whole new log on the fire. We wait to do it in reconciliation in the new year. Joining us now with her reaction to a menu of options, Democratic Congresswoman Melanie Stansbury of New Mexico, who's live on the Hill, a member of the House Oversight Committee. Congresswoman, it's great to see you. Welcome back to Bloomberg TV and radio. Do you support Hakeem Jeffries in suggesting that lawmakers stay in town to get this done before we go over the cliff?
Yeah, absolutely. I am still here in Washington, D.C. at our nation's capital, and I think it's reprehensible that the Speaker not only sent his members home, but canceled votes tomorrow. We're literally 1 week away from Christmas, and he had the opportunity to extend the Obamacare Affordable Care Act extension for millions of American families, and instead he canceled votes and sent his members home to go celebrate with their families while millions of Americans will lose their health care. So I believe we should stay here, get it done, and make sure that Americans can access health care.
Of course, what you believe and what you want, Congresswoman, is not necessarily going to be on Speaker Johnson's agenda, and it looks like we are going over the cliff. We come back in January, and I'm curious what you think happens in that scenario, because you've got the discharge petition, we've got the Fab Four on there already, and maybe there are more Republicans who sign on, but then you've got the Senate to deal with. Could there be a gang of 8 or a gang of 6 that comes from the discharge if it shows there's enough momentum here?
Yeah, absolutely. So the discharge petition will require that within 7 days of ripening of this petition, which basically, I know it's very complicated, puts us on January 6th for a vote on the House extension, which is a 3-year extension. That's the day we come back from the holiday recess. We expect that will be available to be brought to the floor that week. I think this changes the dynamic with the Senate dramatically, and I think it basically will require that the American people speak loud and clear to the Senate that they demand an extension so that millions of people don't get kicked off of their insurance. So yes, we could see a shift in the Senate, but I think it will require the American people speaking out and speaking loudly on that.
Interesting. Where are you on this idea of a shutdown potentially at the end of January if a deal is not struck, Congresswoman? I know there's a lot of scar tissue from that last shutdown, and Chuck Schumer today was indicating that he does not think that's a vehicle to apply more leverage. How about you?
You know, I think that all shutdowns are damaging. My background is actually as a budget analyst, a policy and budget analyst. I worked at OMB during the Obama administration. Shutdowns are harmful, and coming from a state that has a high proportion of federal militaries and active duty, federal employees and active duty military, it's devastating to our communities. So we never want a shutdown. But what I will say is that the Republicans shut down the House for weeks and weeks and weeks and promised that when we came back, they would allow a vote on health care and that they would pass appropriations bills. And here we are a week before Christmas, and they've done neither. They haven't passed a health care bill, and they have not passed appropriations bills. And so ultimately, this is on them. They control the chambers, they control the presidency, and we need a serious commitment to actually keeping the government open, operational, and serving the American people.
Well, to your point, we're a week out from Christmas, which means tomorrow is deadline day for the Department of Justice to release the Jeffrey Epstein files. Congresswoman, I know you serve on the Oversight Committee, and I would love to ask you about some of the decisions you've made on that committee. But do you expect the DOJ will make good on this or find a reason not to release them?
Well, I know what the law says, and the law says that they have to comply by tomorrow. We have seen zero signs of compliance so far, but they have essentially until midnight tomorrow. And I think it's important for anyone that doesn't know what's in the act that was passed by Congress and signed by Trump. They have to release all DOJ files, all the FBI files, and the U.S. Attorney files. We know it is a voluminous and vast amount of information. It not only has to be released to Congress, it needs to be released publicly and searchable. And so we'll know by midnight tomorrow if they have released those files, and if they have not, we will have to look at what kind of compliance tools we can use as Congress.
Wow. Well, this is going to redefine a Friday news dump, Congresswoman. I'm curious about the process that you've been through on the Oversight Committee, because you've been putting out hundreds, thousands, in fact, documents, photographs, and so forth. And there was another release of more photos just today. How does the committee discern which photographs to release and when?
Yeah, so the committee's investigation, which was initiated in August after Democrats made a motion to subpoena the Epstein files from the administration, from the estate, and subpoena a number of witnesses in this case. And the Republicans agreed to that vote. And so we have a bipartisan investigation is of the entire case. So this is much larger than just the disclosure of DOJ's files. It also now includes subpoenas that we've issued of financial institutions, which we know were complicit in not reporting financial transactions that may have been implicated in Epstein's crimes. And so as those documents are coming in pursuant to the subpoenas, the committee is processing them. And in the case of the last 3 tranches of documents that we've received from the estate, they were released in their entirety to the public. But last week on Thursday, the estate transmitted 95,000 photographs that came from Jeffrey Epstein's emails and iCloud account. And because of the nature of those photographs, some of which include potential photographs of victims as well as sex acts, the committee is undergoing a review process, talking to survivors to determine what is appropriate for disclosure for transparency purposes, but also to protect the identities and the safety of the victims as well.
Well, this is going to be quite a moment. I don't know what you think Americans should prepare for based on what you've seen, Congresswoman, but his chief of staff, Susie Wiles, told Vanity Fair in a rather casual interview or series of interviews that she's read the files. She's actually seen them, and Donald Trump's name is in them, but said that they show no untoward activity. Is that what you expect to see?
I don't know what we'll see tomorrow. We don't know if they're going to release all the files. We don't know if they're going to try to redact the files. We know that at some point Donald Trump said he was going to remove all mention of Republicans, probably including himself. So we don't know what they're going to release. We know what the law requires. But listen, we all know that Donald Trump was friends with Jeffrey Epstein for over a decade. We know from the estate's emails that they released from Jeffrey Epstein's own hands that he typed on a keyboard that he stated that Donald Trump knew about the girls in reference to young women that were recruited at Mar-a-Lago and came to his house. And he talks about in those emails and texts of having photographs of Donald Trump with young women. I mean, whether or not that is investigated and in the Department of Justice's files, we don't know. But what we do know is that they have a long association, and we know that the president has been actively engaged in a cover-up. He's threatened members of Congress. He tried to stop the discharge petition from moving forward, and he has tried at every single moment to bury this case and to distract the American people. And so all of that raises questions. What is he hiding if he doesn't want the American people to know what's in there?
Well, maybe we'll start getting some more answers tomorrow, Congresswoman. Thank you for joining us. Melanie Stansbury, the Democrat from New Mexico, here on Bloomberg. Breaking news just out. TikTok signing agreements to sell its U.S. arm into a joint venture. We've got details coming up with our Bloomberg reporters and with our political panel, all coming up straight ahead here on Balance of Power on Bloomberg TV and radio. This is Balance of Power on Bloomberg TV and radio. I'm Joe Matthew with breaking news this evening, a major development regarding TikTok. Yeah, the company telling employees in a memo today that the social media app's parent company, ByteDance, has signed a series of binding agreements to create a U.S. joint venture that will be majority owned by American investors. TikTok CEO telling employees, quote, TikTok Global's U.S. entities will manage global product interoperability and certain commercial activities, including e-commerce, advertising, and marketing. Joining us now to discuss the impact of this move, the man who's all over this story and has been for months, Bloomberg's Michael Shepard. Shep, what does this mean in terms of the countries involved in the politics behind this? Should we assume Beijing has signed off?
Well, we shouldn't assume anything based on that, because this memo that was circulated to TikTok employees by Xiao Chu, the CEO, there was no mention of China. It did make extensive mention of President Donald Trump's executive order from September 25th, really clearing the way for this deal to go through and giving his blessing, the U.S. imprimatur, on this transaction, and also codifying in a way some of the security guarantees that would be baked in and enforced by one of the investors, and that is Oracle Corp, who, of course, is very close to the president for a lot of other things and is involved in the AI agenda as well.
Is the rest of this investment group the same names that we've been hearing since the president rolled this out?
That's a great question, Joe, because a lot of people have been wondering who will end up as the TikTok owners, and it really is the same trio coming in as new investors, including Oracle, but also Silver Lake Management and the Abu Dhabi investment firm MGX. So it will be pretty much the contours that we had seen. ByteDance, the Chinese owner that currently controls the app, its stake will be diluted down to 19.9%, which would comply with the U.S. law mandating a sale. And then we would also see ByteDance's existing investors, many of them whom are American investors, like Jeff Yass of Susquehanna. They would get a 30% stake. So altogether, you would see ByteDance's control of the company shrink below the legal threshold, and yet the security guarantees are going to be one of the big questions out there. And the other will be, has China signed off on this as well? And we are waiting to see what Beijing will say, and if it has been part of the trade conversation.
That would be a huge development. Did they get the algorithm, by the way? Did they lease the algorithm? They borrow the algorithm?
Well, that is another thing that is in the deal that may not satisfy U.S. lawmakers. Okay. The idea was to have the algorithm completely separate, perhaps even recreate it from scratch. Instead, the idea is that it would be a copy leased from ByteDance, but then retrained to some degree or another by Oracle, and also walled off in a way. They would create some sort of a security firewall or barrier that would keep ByteDance from ever gaining access to U.S. data or to the algorithm itself, out of concerns that there could be some manipulation going on.
Pretty complicated deal, which I guess is why we've been talking about it for so long. I suspect we'll update this tomorrow with you, and I hope that you'll have more for us. Shep, thank you. That's Michael Shepard live in Washington as we assemble our political panel now for their reaction to this story and more. We're joined by Bloomberg Politics contributor and Democratic strategist Adam Hodge, managing director at Bully Pulpit International, alongside Republican strategist Annalise Keller, partner at 7 Letter. Great to have both of you with us. Adam, based on your experience in the USTR's office, I'm just curious, your thoughts on this deal. Complicated, yes. Is it possible to keep the Chinese out? Do you trust it?
Joe, I just think back to what Xi Jinping has said himself, was that TikTok would never be sold. And in China, Xi Jinping tends to get his way when he says that certain things should happen a certain way. So the Congress is pretty clear what the law should be here. The president has clearly flouted that over the course of this year and saying he's going to do a deal, giving waivers to some companies that seem to contradict the actual law that was signed. I think I should go back to TikTok. Has clearly been a very effective partner in Washington trying to get their way. They've done an effective lobbying on this issue. The devil, as Shep was saying, will be in the details. That is 100%, because how it is structured, whether the source code, whether the algorithm stays in the U.S., really does matter at the intent and spirit of that law that was passed.
Statement from Chu this evening says the organization will, quote, operate as an independent entity with authority over U.S. data protection, algorithm security, content moderation, and software assurance. Annalise, do you trust the framework that you're hearing?
That'll be hard. I mean, we'll have to see more, and everyone here in the U.S. will have to, be able to trust that some of the data and privacy security issues are solved. But, so I think that's an open question. But what is clear is that President Trump, and especially going into the midterms, has, been effectively, it's been effectively argued to him that this is something that this is a platform that lawmakers are on. It's an effective tool for them to reach their constituencies. And I think that's really what was able to turn the tide of lawmakers here in Washington appreciating that this was something that their constituencies used in a way that they could communicate with them back home.
Interesting. We're going to have a lot more on this, I'm sure, as we learn more. This just broke after we came to air. But I do want to ask you both about the healthcare debate that's punctuated a lot of conversation this hour over the course of the day. And, well, I guess it's been months because we did have the longest government shutdown in history. We heard from Hakeem Jeffries, knowing that he's got enough Republicans on the discharge petition now to get this thing to the floor and actually clear an extension of Obamacare subsidies. Here's what he said.
Our message to Mike Johnson is clear. You can run, but you cannot hide. The American people are horrified. Republican leaders are petrified. But House Democrats are unified, standing up on behalf of the American people to protect their health care.
Adam Hodge, Leader Jeffries is demanding that the Speaker keep everyone in town, and I guess John Thune as well for that matter, to get this done before Christmas. Surely he's not new to Congress. No one's missing their flyout day tomorrow, right?
No, Joe. I mean, I think the way that you nailed it, the way the House works, that seems unlikely. However, it sure would be in the Republicans' political interest to solve this problem before they went away for the holidays. I mean, you could see their own reelection ads running themselves saying, I stayed in Washington to get this done to lower your healthcare premiums. Instead, they're going to fly out of town, and there's no way that they address this in January. And in January, as they're suffering from this affordability crisis of some of their own making, they're going to have to deal with skyrocketing premiums. It boggles my mind that they haven't found a way to solve this political problem when you have members of their caucus who are the most endangered trying to actually get a deal. And it would be good for the American people if they did solve this problem.
Annalise, where's your head on this? Because it does seem like you've got the ingredients for a deal, but we're going over the cliff anyway, and everybody's going to come back in January and start pushing the rock. Couldn't we get this done now?
Well, I'll disclose that I work on this issue in my day job, but you're right. You're right on. Republicans appreciate that this is going to be a challenge for them when it comes to affordability and the midterms. I worked for an endangered Republican in the 2018 cycle in Detroit suburbs, and we were part of that landslide, the blue wave that lost re-election because of the pre-existing condition conversation. Democrats were really successful in pushing that narrative, and healthcare is an issue that the American people really do trust Democrats on. Republicans are typically stronger on the economy. Democrats typically are stronger on healthcare. So I think there are a lot of Republicans who realize that this is a really challenging place for them to be in and a really huge vulnerability. And that's why you have seen everyone coming out with their own plan. This is my plan. And, because people want to solve this problem. But what it takes is leadership in the House of Representatives and in the United States Senate to put these bills on the floor. Also, the last thing I'll say is the 3-year clean extension. I think people know that that's not going anywhere.
Failed already in the Senate.
It's already failed. I think it was really remarkable to see Republicans get on the discharge petition. I think that was a real rebuke of the leadership in the House right now. But there has got to be some sort of real decision from leadership in the Republican Party that they're going to move something forward.
This is an important moment for sure that we'll be looking back on at some point. Adam, I know you like a party, and it looks like the president's planning one. Have you heard about Patriot Games? This is not to be confused with Hunger Games. Kate Sullivan at Bloomberg out with this story. The president announcing a bunch of events to celebrate America's 250th birthday, including Patriot Games will be a parade and athletic competition for high schoolers, a fair on the National Mall, and what they say will be the biggest fireworks display in the world. What's the president doing making plans like this right now while we're talking about affordability? Don't we have a ballroom to build?
Well, I'll tell you, the one who's not happy about those fireworks is my dog, who's going to be going crazy on 4th of July when the fireworks are going off. But I think you have, this is in keeping with the administration, right? They had the secretary doing pull-ups in the DCA. This is it's kind of in keeping with some of the shenanigans that they've been up to. It seems to me you're right on the political side. If you have a budget problem, you got an affordability problem, spending hundreds of millions of dollars on fireworks and parade.
I thought.
Annalise?
Yeah, I don't know. I'll try to make it. I thought this was AI when I saw it.
I'll meet both you guys there. Adam Hodge, Annalise Keller, thank you. This is Bloomberg.
This has not been a great time for genius. The people who claim to have it do not seem to qualify for it. The people who diagnose it in others seem to have a very, very narrow definition in mind. And the people we can all agree are stone-cold geniuses always seem to have a dark side. I read in Bloomberg Businessweek about the biggest crypto genius of them all, Sam Bankman-Fried. At his peak, he was worth like $26 billion. And that was before he was accused of running one of the biggest frauds in American history. His defense is that he is not a criminal, essentially, just inept. What does it mean to have genius in work, in the marketplace, in life? And who is even to say? To make anything simple takes actual genius, and we're going to try to live up to that name together tonight. It's the Business Week Show. Hello, I am Max Abelson, and I'm not a genius, just a regular, slightly above average journalist who has spent about the last decade and a half here at Bloomberg News and sometimes our magazine, Bloomberg Business Week, writing about Wall Street's money and power. And what that means is I write about ambition and ownership and imagination and survival and risk and second acts and, of course, genius. Tonight, and in the weeks to come, we are going to be talking about those things at this table with people whose lives and careers and ideas are big or interesting or just really fun. So, welcome. This is the Business Week Show, and it's starting right now. If you consider yourself a master of Wall Street, a connoisseur of investing, a soothsaying financial genius, a brilliant portfolio manager, our guest has very bad news for you. Burt Malkiel's book, A Random Walk Down Wall Street, 50 years ago, had a clear and vivid message, which was that Wall Street genius is really just an illusion, and that professionals in pinstripe suits, at the end of the day, are no better than naked animals. It was a genius and radical idea, because what he had to say is that you should forget them and just buy and hold clear, boring, basic, low-cost index funds. He is here to tell us about it. Burt Malkiel, welcome to the show.
Thank you very much. Glad to be here.
Your book is actually pretty funny. It's a little saucy sometimes, your book. I mean, you say no one in finance can really forecast the future.
how long was it until you sort of reached that point where you were confident with your trading, you felt like you had an edge, and you were doing quite well in the sense of sort of pulling out consistent profits? How long sort of was that time from when you first got started?
I would say the first couple years, I mean, in a way, the answer is a little bit artificial because, as I said, like, geopolitical events kind of
Chat with Traders, episode 21.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey there, what's up? Welcome to episode 21 with a very special guest, Adam Grimes. Adam is author of the very popular book titled The Art and Science of Technical Analysis, which covers market structure, price action, and trading strategies. He is also the Chief Investment Officer of Waverly Advisors and host of the Market Life podcast. Adam's career dates back almost 20 years. During that time, he has traded a wide range of asset classes, both independently and alongside a well-respected prop firm. Plus, he also did a stint on the New York Mercantile Exchange. Over the next hour or so, Adam shares his interesting outlook on the market and many aspects of trading. So as you can imagine, this includes plenty of discussion around technical analysis, but you'll also pick up a number of great psychology tips to help you with the mental aspect. Enjoy, team. Here's this week's guest, Adam Grimes. Adam, what's up? How you going, man?
Doing pretty well. How are you doing?
I am doing very well. Thanks so much for coming on. How's your week been trading?
Fantastic. It's been a interesting week to see the markets pushing up against the highs. I think there's a lot of hidden strength, but one of the principles of markets is they tend to do whatever will hurt the greatest number of people. And I think there's probably a lot of the quote weekend longs here, the weekend bulls that could set up a pretty good shakeout market. So really interested to see what happens over the next week and a half or so.
Yeah, I think that will be interesting and very true as well. So, I mean, again, thanks so much for coming on. It's an honor to be speaking with you, and it's, really great to have you here. So I'd like to kick this off by asking you, where did it all start for you? So take us back, I think it's like nearly 20 years, and share with us how you got into trading. And I'm also keen to hear what you were doing before this point in time too.
Well, I literally had no clue or knowledge about financial markets. I think it would be difficult for somebody to start with less knowledge than I had. I was a musician, and I had just graduated from college with a degree in classical music composition. I was a pianist and composer, and I had always, part of the formal education of a musician was really the discipline with the work on the art. And I was very accustomed to working for long periods of time on things that required a lot of detail. I'd sit for 8 hours a day and work, but that's not how I thought trading would be. I got this thing in the mail with a crazy guy in a cowboy hat that had a really good ad and, send off for a few $100s. He's going to tell you how to open a trading account with $2,000 and basically corner the cattle or soybean market by pyramiding into trends and turn your $2,000 into $1 million and I knew that was some marketing BS. And I knew that wasn't really possible, but I also, it was good marketing, and I thought there was probably a seed of truth in that. So I sent off for his course, and I studied, and I learned the magical patterns, and called in. This was the days of dial-up modems, and there was no internet to speak of. It was still a little bit more of a infantile stage, I guess might be the word. So you would call into the hotline, and an answering machine would pick up, and a tape recorder would play back a message. There was no emails. So I armed with this, I opened a small account and promptly lost it in like 2 trades, and repeated that process a few times, and then really I suppose that's the point where most people would have said, okay, my get-rich-quick scheme didn't work now, move on. But something about the process really fascinated me, and about seeing the patterns in markets. And I dug deeper, learned more, and realized that it was going to be a lot harder, and started day trading. And I was fortunate and day trading was a little bit different back then, but I was fortunate to be day trading the British pound during the Asian financial crisis, and that worked out pretty well. It was good times. Along the way, I realized there was a lot going on that I didn't understand, and that I just didn't have the analytical tools, analytical mindset. As a kid, I was really into science, and science and math, and it was kind of a toss-up whether I was going to go to university to study music or to study some science-related field. I went for music. So even though I didn't really have the formal training and the analytical skills I needed, I kind of understood the mindset. I understood what I needed to do. So I set about giving myself that education, and taught myself math and statistics and calculus and kind of my spare time. That was part of my learning to trade journey. People learn chart patterns. Well, I was doing that, but I was also learning calculus on my couch at night, and had some points where I had varying degrees of success, and took some time off at different times to explore some other things. I always wanted to be a chef, so I got a culinary education, and it allowed for a pretty interesting life. And then I started day trading the stock index futures, and spent a good deal of time. And the reason I'm telling you these transitions is that every transition was a little bit of a learning curve, and spent quite a few years day trading, and same pattern, not really knowing what I was doing, then figuring it out. And eventually I migrated to a style. But I guess I should also tell you, I got a formal finance education. I got an MBA, came to New York, spent a few years on the New York Mercantile Exchange, worked for a prop firm in New York for a few years, and launched my firm, Waverly Advisors, 2009, 2010. And somewhere along the line there, I kind of gravitated to a trading style that people might describe as swing trading, but it's the right balance for me between having a sane lifestyle. If you're an intraday trader, you really need to be glued in front of the screen every moment. And again, I had no problems doing that because I was used to sitting in front of an instrument for 8 hours a day. So I had no problem sitting in front of the market for every tick when it was open. But there's a life outside of the market, and there's also it just clicks better with my psychology, I think, to be able to step back and give the market a little bit more time to breathe. So, I'm I guess a cross-asset, multi-asset swing trader. I've kind of been all over the place, every product, but trade both trend following, mean reversion systems, stocks, currencies, futures, options, and typical holding period now. Kind of target 2 weeks, but of course there's a widespread, everybody who's a 2-week swing trader, what we like more than anything is to get those trades like we had in currencies last year, where we can hold them for months and months and months and just do nothing and make money. But generally speaking, looking for about 2-week holds. So that's kind of my trading experience in a nutshell there.
Okay, that's excellent. So looking back, what would you say were some of the things you struggled with most of all as you were starting out during that time?
Well, definitely being undercapitalized. And I mention that because I think a lot of traders are undercapitalized. And it's kind of a seductive thing, because I think one of the keys to trading success is, there's no one most important thing, but there are a number of things that without these things you can't succeed in the long run. And one of those is money management, which simply means you're betting small enough that no single bad trade's going to take you out of the game, but big enough that your trades matter. And if you're undercapitalized, you simply can't trade small enough. If you're an undercapitalized futures trader, you might put on a trade where the risk has to be 50% of your account. You're basically buying a lottery ticket. Good luck. So being undercapitalized was definitely one of those things. And I know that a lot of traders I've talked to over the years, this is a common problem. And I think that a lot of the issues that I thought that I was dealing with psychologically actually went back to being undercapitalized. I think one of the other things that I struggled with was, and this is probably not a negative, but frankly, I spent a lot of time looking at things that just didn't work. And I guess that was, I try to, a lot of the stuff that I write about and put out now, it's stuff that I wish that I had when I was learning. I wish that somebody had told me, don't waste your time going down that road. But maybe I had to anyway. Maybe that was just kind of my process of development. But I think those two things, really working with models, and I use models in a very general sense, just with ways of understanding how the market works that were not based in reality, and also early struggles with being undercapitalized. Those were probably and then of course, from that flows a bunch of emotional and psychological issues, but they weren't necessarily psychological issues. They were really grounded in issues of reality.
Yeah, okay. So those are two really interesting points. So you mentioned you felt undercapitalized. What would you sort of say? I know there's not like one number, but like as sort of a guide, what would be a good amount of capital to start with? Because obviously you don't want to go too hard and put too much money in, because then you're risking right. Too much. So right. What would you say would be a good amount to start with, just roughly?
Well, I think it varies depending on who you are and what you are going to trade. I'm not giving you. I'll give you a few solid answers here, but here's how I would think about it. So the answer is very different if you are somebody who is 65 years old and retiring after a successful career somewhere else, and now you want to learn to trade. That person obviously has different concerns and different things they need to focus on. For somebody who is basically like, I was an idiot just out of university, you could make a case from the standpoint of game theory that with the potential payoff probability and distributions, that you could risk a significant portion of your net worth in trading. And if it doesn't work out, then you just lose it. You're still young. You can move on to something else. The upside's a lot bigger than the downside. So I think the answer very much depends on where you are in your life. It also depends on how active are you going to be with this trading thing. Is this going to be something that you do and kind of leave simmering in the background while you go about your job as a web developer or chef or whatever? Or is this going to be something that you focus on? Are you going to sit in front of the screen for 8 hours a day for many years? And by the way, I say that, and most people think, well, choice number 2 is obviously the right choice. I don't know that it is. I think, again, depending on who you are, you could be very successful with choice number 1, but it's a different type of commitment. It also depends what you want to trade. Are you going to trade something like currencies where you can trade very small? The question here is you lose. Now, let's notice my Freudian slip there. As you learn, you are going to lose. And as a beginning trader, you are going to lose money. That is the reality. You are going to lose. You are probably going to lose consistently, and you are probably going to lose consistently for a considerable period of time. So what do we need to do? Well, we need to limit the size of those losses. So for the beginning trader, the question becomes, how can you limit your losses? Now, there's a bad way to do this, and the bad way is to take trades with, quote, very small risk. I think it's one of the silliest things that we say. I'm going to get into this trade. Let's say you're trading something in US dollars, and I'm going to risk 5 cents. I'm going to get into this trade, and I'm going to risk 2 ticks. It's silly, absolute silliness. That's not how you limit your risk. How you limit your risk is your unit size by trading small enough. You can trade. Let's go to the absurd limit. You can trade one, or you'd even do more in currencies. Let's say you trade 1 share of stock, and you buy a $50 single share of stock. Well, your risk is pretty clearly defined, and that can go against you by 50%, and you're not feeling any financial pain. So I think it's really a question of, if you're a futures trader, even those minis can be significant losses. And then there is a tendency to say, I'm going to try to, quote, nickel and dime this market. I'm going to use very tight stops. Where if you were trading something like, currencies or stocks, where you could really trade very small units, then your risk could be smaller. So that's the number that matters. It's what you're going to lose on each trade is a percentage of your trading capital. And frankly, we just want to keep that number as small as we can. And you certainly don't want to get into this, and many people do, with the idea that you're going to open a trading account and you're going to live out of that trading account. The initial fantasy is, I'm going to open this trading account, I'm going to pay school XYZ.com $15,000 for their online trading education, and then I'm going to start trading. I'm going to make enough money to pay all my bills. Well, when that doesn't work out, then the fallback plan is, okay, well, that didn't work. I'm going to continue to learn to trade because they told me I have to work on my psychology now, and I'm also going to pay my bills out of this trading account. That's not a good plan, because you're going to deplete your trading account. What you really need is some amount that you can set aside, and you can lose little tiny bits out of that account each month, and you're not really going to feel pain. So, I kind of think probably a realistic number for trading capital, if it was, the number I've thrown around is $50,000. You could probably do it with less, but $50,000, if that was your only, and again, you're not taking rent out of that, you're not taking food out of that, that's your trading capital. Knock on wood, you could do it with less, but $50,000, 3 to 5 years, I think would be a realistic learning curve for most people.
I just want to pick up on the other point you made earlier, and that was learning trading methods that are not based on, as you said, sort of realities, like just learning things that don't work. How do you know these things don't work until sort of afterwards? I mean, is that kind of the power of hindsight, or when did you discover they don't work? Was it afterwards?
Well, there's a certain, afterwards, and then, after what? Fill in the blank, right? After trading results are so variable. I could give you a magic coin and tell you just go long when it comes up heads, and short when it comes up tails. You could use that coin for quite a while before you realize it didn't really work. And I think that's the way it is with a lot of trading systems, and a lot of trading results are so variable that if I give the same magic coin to 20 traders, for instance, in a chat room, some of those traders are going to have really good results. Imagine that. Imagine this as an experiment in reality. Say that I literally did that. I sent you in the mail or in the post a coin, and you would take your trades off of that coin, and then we'd have a group of people talking about your results. You would really find that a few people in that group had very good results. And you would wonder what was wrong with your coin flipping skills. I mean, maybe you'd be one of the lucky ones, who knows? And so it's really hard to evaluate trading results based on what other people say, what other people experience. There's all this hearsay, plus add to this that people lie, people exaggerate, people write books and articles without firsthand experience. So you just don't know until you experience it yourself. And then even when you experience it yourself, you certainly can do something that works and have a string of losing trades. That's just part of the business. So that was why I really wanted to develop the right quantitative tools for looking at market data, and the right mindset, the right I guess, scientific approach to thinking about market data in terms of hard statistics. And I started with, I was really taken in by a lot of the secret methods. I spent a lot of time looking at GAN, a lot of time looking at Elliott wave. And, now I don't use those things. So it's kind of funny when I say something negative, people are very dismissive. Well, you haven't looked at, well, yeah, I am willing to bet I probably went deeper into those things than 999 people out of 1,000. I was the one that spent more time that was, literally piles and piles of charts drawn by hand, looking at angles. And then when you actually start to understand how the mind sees patterns and randomness, your standards for proof change. Why do I know this works? Can't you just see it works? Well, no, you can't just see it works because you can't trust your perception. You can't trust what your eyes see, what your brain sees in patterns. Your brain will find patterns, so you can't trust that. So you have to have the statistical tools to look at the market. And then when you do use those tools and you start to see, wait, I can't really tell any difference between this thing and a, purely random flip of a coin, this tool is not really adding anything to the market, you start to get very cynical. And you start to feed more and more things into the magic number cruncher, and you start to see it's really it's an emotional experience. It was for me because I thought all these things worked, and I even had success with some of these things. I would have been the person who would have had a screaming argument in a bar defending Fibonacci ratios because I'd use them in my own trading and I was making money. So you're an idiot to say they don't work. How dare you? Look at my trading results. End of discussion. Well, no, not end of discussion. I was making money, but it wasn't because of the Fibonacci ratios. And as I said earlier when we spoke before the interview, I think there are a lot of people that are using tools that don't work, and they don't know they don't work, and they're making money. And so then it becomes a problem from two standpoints. If something breaks, they're not going to know what's broken. They're going to think, well, my magic moving average doesn't work anymore. It used to work. Now I'm not making money, so I better look at different moving averages or combining moving averages. And, well, that wasn't really why they were making money, but because that trader didn't understand why he was making money, he doesn't know what to fix. It also makes it impossible to teach because at one time I would have written a book about trading that would have talked about moving averages and Fibonacci ratios. And I would have shown you the trades that I was making based off of those things. It had nothing to do with Fibonacci's moving average. They just happened to be there. And they were actually obscuring the true things that were going on in the market that were driving my trading. So, for me, it really became a matter of feeding one sacrificial lamb after the other into that meat grinder of the statistics and seeing that this doesn't work, this doesn't work, this doesn't work. Oh, that works, but it doesn't work very well. But okay, this doesn't work, this doesn't work. That doesn't work very well. And then your standards change. And you begin to realize, wait a minute, that thing that doesn't work very well, that's what an edge looks like in the market. And wow, holy crap, it's an edge and it works, and it has worked. If I go back and I look at these different time periods of markets, it worked in the 1960s, it works in futures, it works in stocks. It worked in grains in the 1400s in Europe. Okay, so it probably works, but wow, it's a paper-thin edge. Of course I have to trade this with complete discipline. Of course I have to trade this with ironclad money management and risk management. And of course, I can't ever be arrogant and say, I know gold market is going to collapse because I know my edge. I have seen it. I have seen it over hundreds of thousands of statistical tests. And I should be able to say the word statistical tests. And I know how thin that edge is. So how can I not respect the reality of how thin that edge is and how difficult it is to use it to make money. So, it's on one sense, it's very humbling because it just strips away all of these misconceptions, all of these beliefs, all of these things that we wished were true. There is no magic technique, and it is humbling because you realize how thin the edge is, but it also brings confidence because then you realize, wait a minute, these traders who talk about their edge in terms of, say, a card counter in Vegas, well, my edge is a little bit bigger than his, and those guys can make money, and I can too. So it just, to me, it's really been a journey of focusing on what's real and learning what's real and learning to develop the right tools to deal with those paper-thin statistical edges.
Yeah, okay. So how long was it until you sort of reached that point where you were confident with your trading, you felt like you had an edge and you were doing quite well in the sense of sort of pulling out consistent profits? How long sort of was that time from when you first got started?
I would say the first couple years, I mean, in a way, the answer is a little bit artificial because, as I said, geopolitical events kind of aligned at the same time I was day trading the pound. I just happened to be in the right place at the right time. So I don't know that my answer is really accurate there, but I'd say the first year was a disaster. I had no clue what I was doing. I have experienced, I think one thing I've experienced as I've gone into new markets and new timeframes, my learning curve, there's still been a learning curve each time I've had a transition, but that learning curve has been less and less and less. And there's still a bump. You'd be silly, no matter how experienced you are, to go into something new and just start firing for effect, going full size. I would say, you use the word confidence. I don't know. I don't really know how I feel about that word because I think every time I have been confident, I've done something kind of stupid, and it hasn't. So I think I function best in the market when I really focus on having the right kind of humility and realizing that we are, to kind of put a religious wrapper on it, we're in the hands of an angry market. You're a very tiny trader in the face of an angry market, and you just have to. You just have to be very respectful of that. So, I guess I'm confident. I'm not confident in the way that I think a lot of people would. You see the people, the talking heads on television who are so confident. I've never. Every time I've had that kind of confidence, it hasn't really worked in the market. But I think it's been an evolving process. It's probably been part of me maturing as a person. I would say. I certainly had some good success within my first 5 years. It was probably not until I'd been trading pretty actively 10 years, looking back, that I should have had any real degree of confidence. And there were still some periods in there that were pretty rough.
Okay, so this is something we were talking about sort of off air, and I found it really interesting. And that was, you talked about sort of the degrees and the levels of success, and sort of as you hit certain points, certain things happen. Do you want to sort of just sort of go into that a little bit about the first degree of success that you mentioned?
Sure. Well, I don't know that this is universal, but it's what I've seen with a lot of traders over a lot of many, many years. And I've worked with a lot of traders in a lot of different places and capacities, as teaching, mentoring, friend, co-suffering trader. So, it's a lot of different interactions. And even more interestingly, when I talk to people who have been in my situation, have worked with other traders, they've seen similar paths of development. So I don't know that this is universal, but I do think it applies to a lot of people. And basically, what I would say to people is that this really, you're not going to learn to trade. That I think that word, that concept needs to be eradicated. You're not going to learn to trade. What you're going to do is you're going to become a trader. You're going to grow into a trader. You're going to go through the development process of becoming a trader. You're going to become a trader. And if you are going to become a trader, there's going to be some learning. You're going to learn to trade along the way, and that's great. That's awesome. But this trading journey is going to take you 3 to 5 years as kind of you use that as a benchmark. And people don't know what success looks like. Success is not, it's not that flashy web page you clicked on that shows you how to turn $2,000 into $1 million in 30 days. That's fantasy. That's BS. We all know that. It's not even making a lot of money. The first degree of success is you stop losing money. And keep in mind that this could take 3 years. This could take 3 years. It could take 5 years, where you are trading actively and actively on your time frame. You can be that guy I mentioned earlier who is the school teacher who is swing trading and looking at the markets when they're closed. As long as you're still involved in the ongoing flow and process of becoming a trader, that's okay. But a lot of people work and they take time away. Like I talk to people who've been trading for 3 years, and you really dig into it and you find out, of those 3 years, probably a year and a half, they took time off. They were away from the market. That doesn't really count. You've been doing it a year and a half. So you're looking at 3 to 5 years, a pretty concentrated, continuous effort. And that first degree of success is you are no longer losing money as far as transactions go. Now, you're still losing money. You're losing money, you're paying for data, you're paying commissions, you may be paying for some education, you may be paying for some type of market advisory or research. Those are legitimate expenses. And you are paying those expenses every month. And the way to think about, depending on how active a trader you are, month, week, quarter, when you evaluate your trading, I'll just say month. But, every period you evaluate, you are pretty much break even on your trades, but you're losing money on those other costs. That's success. You're no longer losing money in the market. Second stage of success is you're covering those costs. So your account at the end of this month, and remember, there's statistical variability here, so we're not talking utter consistency. Your account this month is the same number as it was the previous month, and you did not send a check to cover those costs. And then the next month is the same number. That's the next degree of success. And from that, you are now in the elite. You are in the ultra elite of people who tried to learn to trade. You are covering your costs as a trader. And that's the foundation you build from. And from there, then, there's how many beginning traders talk about wanting to increase their size? Well, how are you doing? I'm doing okay. No, how are you doing? Are you making money? No, I'm losing. But you want to increase your size because that's going to solve all of your problems, right? Of course not. So only once you have reached that foundation of you are not losing money, then you have the foundation from which you can begin to make money. And this is the point where you can start to think about increasing your size. You can start to think about figuring out what you do and doing it better, continuing to do it more consistently. As you increase your size, by the way, you're going to have some psychological issues. Maybe. Most people do. Maybe not. And then, from that point, we can start thinking about the future of your development as a trader. And one of the things to realize is that even once you've reached that degree of success, you are going to have setbacks. We would like to believe you put in the 5 years to get to the point where you can cover your commissions. And by the way, you tell most people this, they're not going to start on the journey at all. And maybe that's good, maybe that's bad. Personally, I'd rather have the realistic expectation, but if I'd had that when I started, I don't know what I would have done, but so I don't know. Maybe I'm doing people a disservice by telling it like it is, but I think this is how it is. Once you start making money, you are going to go through periods where you lose. When you go through stress in your life, it's very, very normal for a trader when there's some sickness, whether it's in the family or something like a divorce or some outside stress, depending how you trade, may affect your trading. You may go through significant drawdowns, and that's just the nature of the business, and you have to be prepared for that.
Yeah, absolutely. So That's really good. I'd like to start getting into a little bit about sort of more about how you trade and how you view technical analysis and that sort of thing. So I heard, I think you might have mentioned it in one of your podcasts or something like that. And you said, you mentioned that you look at like hundreds of charts a day and sometimes up to 800 charts a day. So obviously you're just sort of skimming over these. What are the few things you look for just at a glance, like before deciding to skip to the next one or whether or not you're going to take a deeper look?
Well, I think there's a few things going on here. I do look at a lot of charts, and I try to look at those with a very, I don't know what the right word is, but I try to be open to kind of the poking of intuition. I try to not do a whole lot of active processing. So I'm flipping through charts. I know what the chart is. I'm looking at and generally when I say a chart, I'm usually looking at least 2 time frames. I will do a lot of, because I've kind of tried to step back and, I've even recorded my screen to see what are you actually doing when you're doing this. I also do a lot of like going back to look at things. Like I will find myself going back to look at a ticker 4 or 5 times and then going to related tickers. So I'm not just dropping through a list of names. Sometimes it will send me off to look at related things. Sometimes it will send me off to look at other things in the sectors. Sometimes I'll look at some spreads. But if I'm just flipping through charts, I'm looking for a few patterns, and one of those, and they're simple. There's nothing too obtuse or secret or hidden here. But basically, I want to see markets that are making a strong move, or have made a strong move in their recent history. And if they have made a strong move, then I want to know what happened after that strong move. So, for instance, if a market's made a strong move up, did it just collapse? Did it make a strong move up? And is it kind of consolidating near those highs? Did it make a strong move up on the weekly and now it's consolidating up there on the weekly? What's happening on the daily? How do the lows look on the daily? How are the tests of the lows made on the daily? So I'm looking at things like that, and there's not a lot of, at this level, there's not really a lot of detailed analysis that goes in. I think that's an important part of me understanding like the process that goes into me getting a read on the market. Then I also use a lot of screens, but I set my screens very wide. So like if I'm looking at a relative strength screen, it's still going to give me 100 names. And then I'm going to go through those names and I'm going to pull out the 30 that I want to look at more. And then I'm going to go through those 30 and pull out the dozen that I'm really interested in. And those might pull up something because, like there are times, for instance, I think there's a legitimate edge here. Like you'll start to see lots of very bullish setups in certain stocks. And you'll be like, okay, well, there's a bullish setup going. And you kind of put it somewhere in the back of your head. Like, there's another one. Wait a minute. That's like 4 energy stocks that look very strong. Well, what does the energy sector look like? Nothing interesting. Okay, well, let's just keep going. Well, there's another one. And you go back, you look at the sector, nothing interesting. You look at the market, nothing interesting. I've seen this over and over and over where you start to build like it's kind of a bottom-up approach where you start to see a lot of, and if your patterns have an edge, this makes sense. You start to see a lot of bullish support that's visible on individual stocks that you don't see in the broad market. And that's information that's not available to everybody in the market. And the way to process that, the way to put that together, I think is a legitimate edge. Now, there's nothing magical to it. I think anybody can learn to do it, but it's just a matter of going through those charts very quickly. You also, you might assume that you're just glancing at them, but really these pretty well because you go through them all the time. And you've seen, I guess I would make the argument that 400 or 500 charts is not really that many charts. It's funny, you hear some people talk about their exhaustive work on 20 charts. It's like, I don't really know what you're doing. 400, 500 is not really that many. You should be able, if you're engaged with the market all day, you should be able to get through that list with no stress whatsoever, 3 or 4 times a day, I think at least. And because you're looking at them 3 or 4 times a day, you know them, you know how they develop, and it's touching parts of your brain, parts of your processing capability that you don't necessarily get from just, there's no secret on a chart. You can't put a chart in front of you and say, just tell me some hidden secret. It's like, everything is there. It's like music. If you have ears, you can hear what's going on. If you can see the chart, you can read the chart. It's a matter then of understanding where the edges are, where the patterns might mean, and wrapping that all in a healthy dose of respect for the fact that most of what you see, most of what you think you see, even having done this work, the majority of what you see may be just complete random noise that's not significant. That's fun. That's fun, right? I mean, that's the really fun part of this.
Yeah, for sure. So you mentioned it a couple times in there, and you've mentioned it earlier, and pretty much every pro trader will talk about how you must have an edge, and without it, you just sort of don't really stand a chance trading.
Right.
So we've all heard that, but let's just be clear. What actually is an edge? Like, how do you define that, and how do you determine if you have one?
Okay. Well, one of the ways I think about this is you can't think about this without, I hate to get too mathematical, I hate to get too philosophical, but I don't think you can really understand this without at least having a working understanding of probability. You don't have to know equations, but you can get to this understanding through equations, certainly. You also, like there are plenty of old school poker players who couldn't tell you what a probability space was, but they understand probability. And you have to have that kind of understanding. So I think some elements are to first of all think, what does it mean for something to be random? And we could talk about this for hours, but basically it means it's unpredictable. And if something is random, the classic example is flipping the fair coin, which is going to come up heads and tails 50% of the time, and each coin flip has nothing to do with the coin flip that came before it, blah, blah, blah. We've all read and thought about examples like that. Some people have deeper formal math educations than I do. Many people certainly do. But the core understanding is if something is random like that, you can't use it to make money reliably. You may have strings of winning trades. You may have long periods of time when you seem to be making money, but over the very, very long run, you are not going to be able to make money above whatever the market index offers. That's kind of a key understanding that, for instance, if you're trading stocks, they go up, roughly 7.5% a year over a long period of time. So you have to be able to make more money than that. And your random system is probably going to get you 7.5%. So what it means to have an edge is that you have some edge over that randomness. And another way to think about it is you have something that is not random. So that's the core understanding. You have something, you have identified something in the market. Now, I have to say something generally, because that something could be a pattern. That something could be something to do with fundamentals. That something could be something to do with a related market. That something, I suppose, could even be something to do with your intuition. That would be a little bit harder to prove. There certainly could be edges that we can't really wrap our hands around statistically. We have to remember that. Again, you have to be humble with the application of the tools. But very simply, what having an edge means is that you have something that is not random. And the sad reality is that most things you look at, when I talk about the number cruncher, you put it in, you see it's just the same as random. And now, the problem is, and people who know statistics are already raising their hands to point out, you never really know if something is random or not. There's no surefire way to know. You could have the best we can do is say within a certain probability, we can say this very probably is not random. If you flip that coin and it comes up 20 heads out of, it comes up 19 heads out of 20 flips, maybe that's random, but you'd be justified in saying, hey buddy, I think you did not give me a fair coin. There's something with this coin seems not random. And that's really what we do with the market, which again is why you got to be humble, because even with the best properly done statistical work, there is, all you're doing is saying, there's a pretty good chance this is not random. And you're hoping that it continues into the future, et cetera, et cetera. But that's really what it means. And if you don't have that, if you don't have something that shows some edge over that random coin flip, then you'll make some money, you'll lose some money. But over the long run, you're really very unlikely to come out ahead.
Okay, right. So thanks a lot for really going into that and, trying to make it a little bit clearer for us. That's really good. Now, there's a common criticism that surrounds technical analysis, and it is a lot of people say it only deals with the past. Now, I've heard you sort of quote that, this is a narrow-minded outlook. So would you like to expand on this and maybe explain why you do not believe this statement to be true?
Well, I mean, it's kind of, first of all, it's kind of silly, because what analysis deals with the future? Whatever you're looking, you only have the past. That's one of the craziest things people say. Yes, a chart is a record of past prices, but anything we put in a fundamental model, if you're looking at earnings growth, if you're looking at a company's debt, if you're looking at how capital structure has shifted over years, you're looking at CapEx, so you're looking at ratios, you start to look at macro factors. What are you looking at? You're looking at history. That's all we have. So where the whole point of this is, and this is where maybe we cross a line from traditional technical analysis to what I think is more useful, which is more of a quantitative approach, is where we're able to say, when these conditions have existed in the past, then this has happened in the future. Now look what I just said. I just identified an edge. When condition A has historically existed, so so what you're doing is you're looking at a point in the market. Let's just use something real. Let's say you're looking at a point where some stock index has been up 5 days in a row, and you say, okay, so when this market has been up 5 days in a row, going forward, it has acted like this. And that action in the future from that point A looks like it was not random. I'm just kind of trying to keep things general here. So then what we would say, well, when we see that condition again now, today is the day this market has been up 5 days in a row. So now I know, assuming the future looks something like the past, which is the great assumption we have to make, there is a probability, see the word? There is a probability of this happening in the future, which is not random, and I can place a bet on that with correct position sizing, manage my risk. That's how you trade. That is the kind of the essence of technical quantitative trading, and it's based off of, if I don't go back, what am I going to make my decisions on otherwise? I can't make my decisions on the future. It's unknown. If I don't go back and look at the past, I don't understand how the market has acted historically, then I have no basis for making decisions in the future. All I have is that information. But what really matters is not the record in the past, it's what has happened in the future, and then the implications I can draw for the present and the near future.
Okay, right. And I sort of presume that the majority of the people who sort of stand by that statement probably come from the side of fundamental and sort of more news-driven trading.
Well, I think that's silly too, though, because fundamentals are, and by the way, I would encourage anybody learning to trade, you need a comprehensive trading education. If you are going to be a technical trader, You might say, well, I will never need to rip a balance sheet apart. I'll never need to capitalize expenses. I'll never need to be able to build a DCF model. I never need to understand ratio analysis. But why not? Why would you not do that? When we trade doctors, when we train doctors, we train them in all aspects of medicine to get a broad education. It should be the same thing with trading, And if you can't rip that balance sheet apart, if you can't understand how the cash flow statement comes, if you don't understand those things, then you can't really answer that criticism. So I think people need to develop those tools. But the news already happened. The news is historical, and the news is already priced in. So I think the people who make those arguments they're just kind of, people like to make off the cuff arguments like, who knows if Warren Buffett ever said, I don't use technical analysis because I turned the chart upside down and it said the same thing to, people just say those kinds of silly, nonsensical things that may or may not even be true. I don't know. I don't know who says that. Sorry for the rant.
Don't want to get you wound up.
Yeah, exactly. It's too late.
So are you with the train of thought that patterns are perhaps more reliable if they can be identified by the majority of traders? Or do you feel there is sort of an opposite effect to this and that makes them maybe less reliable? I know that's kind of a broad question, but just generally speaking.
It's a broad question, but generally speaking, everything that I've ever seen that really works is pretty simple and pretty obvious. I don't think, I think by the time that you are into, like I was advising a quant team one time that came to me and said, do you think if we found something in the third moment of the distribution of cocoa prices that seems to have significance for the S&P 3 months out, do you think that would be something that would be worth looking at? And I said, no, of course not. I think anytime you have something that's kind of, that's very obtuse, everything that works is pretty simple. And it's pretty, with a dose of market-driven common sense, I guess. But I would not be concerned that you have to have a secret pattern that other people don't see, because I don't think they exist.
Okay, right. And this is kind of something you sort of touched on a little bit earlier, and that is sort of using multiple timeframes in your analysis. How do you go about, viewing these multiple timeframes and then making a decision from them? And are you only trading sort of one of those timeframes? Do you want to just talk a little bit about that topic?
Well, yeah, I think, first of all, you don't need multiple timeframes. I use them as a crutch to help me get through all those charts so quickly, but you definitely, with a little bit of education, and by a little bit of education, I mean a few days or a few weeks. This is not something, I remember somebody told me, price action takes 3 years to learn. No, maybe learning to trade takes 3 years, but there's nothing in trading is analytically that difficult. So a few days, a few weeks of looking at charts, and you can look at a daily chart and have a pretty good idea what the weekly chart looks like. Or you can look at the weekly chart and make some guesses about what happened on the daily. When you drill down, you don't really know, right? Because you don't necessarily know how that bar was formed. So it's certainly possible to read a single time frame and to be able to infer multiple time frame influences. But when I'm flipping through a lot of charts very quickly, it's just easier to have the two there. Also, sometimes I will trade weekly charts, and I'll specifically say, this is a weekly trade, and you have to use weekly risk. You have to manage it appropriately on the weekly time frame, which honestly means you do very little for the most part. I do think it's very dangerous. One of the things that gets people in trouble, unless it's part of your trading plan, it can be done if it's planned, but to get into a trade and then switch time frames without proper justification. So you get into a trade and keep bumping it up on time frames, and you take a very large loss on a scalp. That happens to people. Or you get into a weekly trade. I've seen literally seen this. Somebody get into a weekly trade and then be out a few hours later because they didn't like action on a 5-minute chart. What are you talking about? Utter nonsense. So it is important to realize what time frame you're trading, what information is relevant to that time frame and stick with that. I think probably, multiple time frame trading is something that's almost a buzzword that's being sold to people like it solves all the problems, and it really doesn't. The essence of trading, I think, can be captured on a single time frame, and whatever multiple time frame influences you want. Probably most people are better off inferring them from a single chart than worrying too much about what's lining up on different time frames.
Okay, sure. So I'd like to move it along a little bit and ask you about a topic, consistency. So how crucial is consistency to the success of your trading approach? Like sort of applying it the same way. I mean, even if you're not like a sort of hard and fast systematic trader, how important is consistency in your approach?
Well, so my approach is a blend of discretionary and quantitative tools, but the way I think of it is that it is it flows both ways. So it's my discretion is definitely informed and influenced by quantitative tools. I'm not just doing things because I want to do them. I'm doing things because I understand when this happens, that this usually happens in the market. There's also, a topic that I think might not be appreciated enough is that discretion or intuition also influences the quantitative research, because somebody has to say at some point, hey, let's look at this, let's go in this direction. So it's, these things to me work together, but it is a very disciplined approach. And I am very consistent. For instance, as we were talking before the interview started, markets have been difficult for the past few months. And I know that I will have strings of winning trades and I will have strings of losing trades. And, there was a period last year, particularly in currencies, when it was like I couldn't do anything wrong. Every time I looked at a market, it was a winning trade, and some of these trades went on for months and months and months. And when you're doing that well, you're not really that good. And you also, you'll go through periods where you'll have lots and lots of losing trades, and you're not that bad. And if it really takes the emotional charge away, and your job is to simply execute the trades, to execute the system with complete consistency and discipline. And then the other side of consistency. So you have consistency on the side of your behavior, which is critical. And then you have consistency on the side of your results. And you just have to know your results are not going to be as consistent as you wished. And you can make them less consistent by being less consistent with your behavior. But, there is definitely, this all ties together, right? This goes back to understanding how thin those statistical edges are and the type of it is possible to make consistent money in the market, but what does that consistent money look like? Well, most mature traders know that definition of consistency is not what they thought it was going to be when they started trading. It does not mean that your equity curve is a straight line. It doesn't mean that your trading account is an ATM machine that always and reliably produces money. But over the long run, consistency certainly is achievable.
Okay, and then taking sort of, while we're on the topic of consistency, taking that aside from the market and applying the same sort of consistency to your routine and your study and sort of the time you put into learning how to trade or learning to become a trader like we talked about earlier. Are you doing yourself a disadvantage if you're not sort of giving yourself a solid routine that you're sort of sticking to throughout the week?
Well, I think that varies with, it could vary. The consistency, I think there's a certain amount of what you're doing here is you're probably actually rewiring your brain and growing some new connections in your brain and learning some new ways to look at information, learning some new behavioral tools for dealing with emotions. And these things take time, and those changes are not going to happen unless you give the brain the correct stimulus over and over and over. So you do need some consistency. On the other hand, I talked about this being a trading journey, and it's not necessarily a linear journey. It's not a straight line. Tolkien, right? All those who wander are not lost. And there definitely is a point in your trading journey for doing some wandering. And, part of my trading journey took me through a formal apprenticeship with a French chef. So, there are, I think this is, at some point, your trading journey kind of intertwines with your life story. And it may, certainly for some people, the very regimented, I had a composition teacher who every day sharpened a certain number of pencils and sat down to compose music. And when the pencils were dull, he was done for the day. And that was his routine. It works for some people, but then there are other people who need a little bit more room to breathe. And I think it's really, most people probably could benefit from more discipline. And there's a place for that, but there's also a place for leaving enough breathing room in the journey.
Yeah, okay. No, that's a really good point you brought up. So this is probably sort of moving along to psychology a little bit. And I listened to a recent interview you did with StockTwits, and you spoke in great detail about meditation, which was pretty interesting. So while we won't go into it anywhere as near as much detail as you did then, what are your views on meditation? Like, how do you go about this? And does it actually have a positive impact on your trading?
Well, I think it's a powerful tool. And, I've written and talked a lot about meditation and hypnosis. Those are two different things, but they're both tools that people can use to kind of rewire themselves in some ways. You can increase your learning capacity. You can decrease your need for sleep. You can modify your behavior. You can, for instance, it's possible with hypnosis, and I know the question was on meditation, but it's possible to have somebody, let's say you're a day trader and you can't execute at your stop. So it's possible to hypnotize that person and to put them in the experience where they see the market coming down to their stop, and they have the emotional reaction, they have the panic, and then they do the right thing. So you actually have that experience as a learning experience in hypnosis. And then you can say, do it again, and do it again. And then you can say, time is kind of strange. So you can say, in the next 60 seconds, you're now going to have this learning process 1,000 times. You're going to, and the thing that is amazing, I know if you've never experienced that, you're thinking I'm talking utter nonsense, but it works. And it is a powerful tool for affecting change and for, building new behavioral connections. Meditation, and again, I would also point out that these are powerful tools and they can have bad effects too. So you definitely need to educate yourself. You need to go into them with a good deal of respect. They're not cure-alls, and you use poorly or for the wrong thing, you will be unhappy with the results. But meditation can definitely lead to a kind of clarity, at the very least. Maybe it does a lot more, but what it certainly can do is can help you understand who you are, understand what's driving you, understand your emotions, and help you understand the kind of spider web of connections and influences that play on you constantly. And I think it can lead to a kind of clarity and control that can be very useful for a trader. None of this is a magical cure. Nothing is a silver bullet. But they are tools. Now they're powerful tools that probably more traders could be making better use of.
Okay, right. And I know you've got a lot more to say on that topic, so I might put a link to that interview if anyone's interested to hearing more about that in the show notes at chatwithtraders.com.
Okay, thank you. Please do. Also, I have on one of my websites, I have a guided meditation experience, which if somebody has never meditated, was very pleased with how this worked out, but it's just a series of very short recordings each day, a very, very short lesson, 30 seconds to a minute and a half, and then a very reasonable amount of time, 5 to 10 minutes spent in meditation. It's a good way for somebody to experience it. We touch on a lot of different techniques. So I've had several thousand people go through that experience, and the feedback has just been overwhelmingly positive. Everybody from, I had a Buddhist monk contact me and just raving about what I had put into this experience, and said he'd sat in meditation for many hours every day for the past 30 years of his life, and somehow he found. So with all humility, I do think this is something that has been able to make a difference for some people. So it's I'll give you the link for that too. It might be something people want to check out.
Yeah, for sure. We'll put that in the show notes. I can't say it's something I've ever done, but I'm interested to read a little bit more about it. So yeah, for sure. We'll add that link into the show notes.
Thank you. So
we should probably start to wind things down, but this has been incredible. So let's just do 2 last questions to take us out. So
sure.
In your mind, what's the number one reason you believe why such a large majority of traders never reach the high level of success they originally intend on?
False expectations. I could just leave it there. I think when most people go into this, they don't understand what success looks like. They don't understand what success looks like along the way or their ultimate success. They go into it expecting something other than what they're going to get. They go into it maybe for the wrong reasons, but I think the number one reason is just false expectations.
False expectations, I like it. That's great advice. So is there one final piece of advice you'd like to leave with anyone who's listening to this? I don't mean to put you on the spot.
Well, I mean, it's the nature of the interview to be put on the spot. It's a very good question. I always think that, like, when people say, what's the most important thing? It's a very hard question. It's kind of an artificial question, right? Because it's like, what's the most important part of an airplane? Do you want the wings, the engine, the door, the fuel? It's like you kind of have to have it all. And I guess maybe the answer is there. Maybe what you have to realize is that this is a process of growing, that your success depends very much on you having the right tools. Most of the things you're looking at that people tell you work probably do not work, but ultimately your success is really going to depend on a combination of all of these things. You are an important part of that. Your psychology is an important part of that, but focusing too much on any one of these things is probably a dead end. For instance, focusing only on trading psychology, the answers aren't there. Focusing only on statistics, the answers aren't there. Focusing only on money management, same thing, but you have to have all of these things. You have to have all these things working together, and ultimately, this is why people say, and it's true, you have to develop a trading style that really fits you, because it won't work unless all these pieces work together and they're all working in the same direction.
Yeah, that's great. I think that's very well said, Adam. So thank you. Let's wrap this up. Before you go, do you want to share with listeners where they can find out more about you? Because I know you've got your own podcast, you've got a book, you've got a lot going on. So tell us where we can find out more about you.
Certainly. Okay, so I will do my little elevator speech here. So do check out my blog, www.adamhgrimes.com. I write there. I try to put out anywhere from 3 to 6 things a week. I do have a mailing list in the upper right-hand corner. If you could put your email address in there, I will send you a PDF of the latest little book I wrote, which is basically taking somebody from the very beginning to having early tools for looking at markets in a quantitative way. It's a book I really wished I had when I started trading, and it's free. It's also, if you want a hard copy, you can get that, but I can't give you that for free. But I have links, you can look at that. Also, I did write a book, The Art and Science of Technical Analysis, published by Wiley in 2012, and I know that book has been very well received and has certainly helped a lot of traders think about putting all of these pieces together. And when I wrote that book, I knew I wanted to write a book. I didn't know what kind of book I wanted to write. And Mike Bellafiore told me, Adam, the only way it makes sense for you to write a book is if you end up with a book that you can look at as a gift to the trading community. And so that's some of the best advice I ever got. And I let that advice shape my approach to the book. And it's a part of my journey, but it's very much something that I wished I had had many, many years ago. So, do check that out. Also, as you mentioned, I have a podcast that's a lot of fun, and that's kind of been a growing experience for me. So I've certainly like to have people check that out. And also follow me on Twitter at Adam H. Grimes. I guess I should also mention I have a firm, Waverly Advisors, www.waverlyadvisors.com. We publish daily market research and notes. So it's a lot of these things that I talk about kind of in the abstract. We offer a pretty extensive free trial, and I get on the phone and have a chat with people at some point during that. But it's interesting to see how these tools apply to. I look at it as kind of like the active laboratory version of these abstract concepts applied to real markets in real time, and that's a lot of fun and kind of interesting too.
Awesome. So there's a lot there, and I'll make sure that links to all of that with this interview at chatwithtraders.com/Adam. So if you just go there, you can find links to everything you mentioned. And I just want to point out that your book, The Art and Science of Technical Analysis, was also strongly recommended as a must-read by Lance Beggs, who was an awesome guest on, I think it was episode number 13. So,
thank you, yes.
Yeah, all right. Well, this has been incredible speaking with you, Adam. And so, again, thanks so much for coming on. So take care, and let's talk soon.
Thanks for having me. A lot of fun.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Chat with Traders, episode 61.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
This episode is sponsored by Wonder Capital, a fintech company in Boulder, Colorado, making waves in the solar industry. Wonder's online investment platform gives accredited investors an easy and efficient way to invest in large-scale commercial solar projects with earning potential of up to 11% annually with zero fees. To learn more, visit wondercapital.com/traders and create a free account. I should also point out that's Wonder spelt with a U. Hey there, what's up? How you doing? You're listening to episode number 60, and my guest this week is Ari Pine. Ari has been trading for many, many years. I'm not sure on the exact number, but during this time, he's filled a whole range of roles and positions. Some of those include working at JP Morgan, developing risk management software, trading for a long volatility hedge fund, making markets in gold and silver options, and even giving presentations to the Chinese Stock Exchange. But moving forward to current times, Ari is now in charge of building out a quantitative trading group, approaching the markets from a scientific perspective. Our conversation includes all of the above, plus some really valuable info about positive expectations, the law of large numbers, and process over outcome. Now, guys, I just want to point out to you quickly, The trading group Ari is involved with, Tradeco Global, is a subsidiary of Trading Technologies. Now, even though TT were a recent sponsor of this podcast, this interview is completely separate from our sponsorship arrangement. So just so you know, I was not paid to do this interview. It was totally organic. All right, I think that's all for now. You're listening to the Chat with Traders podcast. Here's my interview with Ari Pine. Hey, Ari, what's up, man? How you doing?
Good evening. Very nice to talk with you. Thank you very much for having a talk with me. You're putting me in some pretty good company.
No trouble, man. Now, you're in New York. How is everything there? Is it all back to normal after the huge amounts of snow that came through the city?
There's got to be people that are in the Midwest that just look at us like, what a bunch of whiny kids. Because, it was a pretty good dump. We had 20 inches, but you'd barely know it now. We had quite a few warm days, and much of it is gone.
Okay. Yeah, because it was, it was all over the news here. Well, not all over the news. It wasn't breaking news, but it was on pretty much every night for about a week. So,
so you're saying you have no real news?
Yeah, pretty much, but as expected. So anyway, Ari, thank you very much for coming on the podcast. Let's start with the first question I have for you, and that is, what was your very first involvement with markets and trading?
So when I was in college, I was very fortunate. I was in engineering school out on the West Coast, and I'd been looking at computer and electrical engineering, and somehow I stumbled upon neural networks. And now I think there's basically, they call it deep learning now. But at the time, it was pretty exciting. There were some big hitters in the field where I was. And I got pretty excited about it. And another student and myself started to try to take a look at using neural networks to look at stock prices. And stock prices were really the only exposure that I had at that point. I didn't really know really anything else, or really had a sophisticated idea about either economics or trading or really even stocks. But beyond that, nothing. And I was also fortunate to get recruited to JP Morgan right from school, which I thought might be fun, even though I was going to leave the California coast. But I figured maybe going to Manhattan for a year wouldn't be so bad. So when I got to Morgan, I thought that, or I should say, I didn't even know what a bond was. That's how little I knew at the time that I came into New York and into Wall Street, is I really knew so little. And fortunately, they had a very good training program. And the moment I walked in, I remember it was Jeremy Siegel showing up with some slides from the Bloomberg bond quote. And something in my head clicked, and I said right at that moment, this is really what I want to do. I just loved it. I wanted to be involved with it. And it was really right from that get-go right there. And so that's kind of where I started. I began actually in a technology group and found that wasn't the path that I wanted to go down. So I requested to move over to the fixed income floor. And this was quite a bit of time ago. This was 92. And so fixed income was, at that time, was huge. It had just come off the time when, if you have listeners out there that remember the Michael Lewis book, Liar's Poker, this was really just after that. And it was kind of funny to put it all in perspective, because it had quite a bit of reality of how things really, like people's attitudes at that time. So I ended up going to the fixed income floor right as equities were about to eclipse fixed income as the leading product of the time. But that was basically my start.
Okay, very good. So I believe before you went to fixed income trading, you also had another position before that at JP Morgan. Could you tell us a little bit more about that?
Yeah, that's kind of a probably a far too familiar refrain from either Wall Street or just big companies in general. So as I said, I had a lot of experience, or a reasonable amount of experience in neural networks. I was literally writing software for some Intel chips that were supposed to be analog neural network chips, which is getting a little deep into it. But the point being that I had a pretty decent knowledge of this field by the standards of the day. And I came to Morgan into this advanced technology research group, which was supposed to look for new and exciting technologies and see what could be applicable at the bank, which is really quite a good idea. When you're talking about a bank like JP Morgan or one of the big banks, it's kind of it's basically sort of an incubator kind of situation. Well, at the time that I was there, they had a neural network group, but the irony was none of them had any background in neural networks other than what the software vendors had told them about neural networks themselves. In typical sort of corporate fashion, here I was on the other side of the fence, and nobody really wanted anything to do with me as far as neural networks went. And I guess ultimately that sort of fizzled out on their side. On my end, I was actually kind of fortunate because they had me working on data visualization, which I think is something in the way that we looked at it at the time is sort of underappreciated, I think. And it's something, it kind of gave me at that time, both the data visualization and my original interest in neural networks I'd always wanted to combine that technology viewpoint into a proprietary trading framework. But what happened in my trading career was both at Morgan and then when I went on to the exchange floors, I really spent much of the time making markets, which didn't really lend itself to doing that sort of research in either neural networks or data visualization or just, I guess, really hardcore data analysis at the time.
Okay, so let's just take a second to explain what are neural networks, just for those who are unfamiliar.
Well, basically, I mean, this is, I guess this is pretty good timing. I don't know whether your readers are aware of a pioneer in the field, a gentleman named Marvin Minsky, who happened to have passed away 5 days ago. And there's some very nice things put up in his memory that are on the web that I was just reading the other day. But basically the idea behind a neural network in a very simple, high scale view is that it looks to replicate the way that the mind works. In other words, it tries to create very simple parallels to a neuron and then basically connect them in a myriad of ways to mimic the connections in the brain. And then it looks to, you train the neural network. You basically, rather than say, these are the, this is how it should all work, you have the neural network, quote unquote, learn by experience. In other words, you keep showing it new data and you tell it what it should learn from it. And there's an algorithm that feeds back into it and has it optimize the weights. From a analysis perspective, it is essentially an incremental regression. So if you're familiar with regression analysis and statistics, rather than doing everything all at once and getting your numbers in the neural network, essentially what's happening is you're going incrementally, and it can look at very complex nonlinear relationships as well.
Okay, so it's essentially machine learning. Is that another word for it, or are they two different things?
Yeah, that's the popular term for it now. Yeah, I probably should have brought that up when you first mentioned it. But yes, that's exactly right. So, yeah.
Excellent. Okay. All right, Ari, well, let's continue moving forward and jump back to your time on the floor of the exchange. So you mentioned that you were trading fixed income. Were there any other products you were also trading? And what was your experience like just in general while trading on the floor?
my first experience trading on the floor was going out to San Francisco onto the Pacific Exchange, where I traded stock options. And, that's another situation where I really, even when I was at JP Morgan, I kind of knew that, I would talk to the CME to hedge in Eurodollar futures at times, but it didn't hit me that there were other people on the other end making markets and what their lives might be like. And so I didn't really get a sense of that until I went out to the Pacific Exchange. And, it's a very, different world. The people that you meet on the floor are, they often get a bad rap. And I happened to go when, in the 90s, when the stock market was going crazy, really a good time where there were a lot of traders that didn't really necessarily know as much about what they were doing as maybe you'd expect. But by and large, these were, very bright people who either weren't, looking or fit for your traditional suit and tie corporate kind of jobs. And but they are very bright and usually quite creative and can be quite aggressive at times. And that's one of the things from the exchange floor that makes it that it's not for everybody. It's a very, very aggressive place, even when people are, decent people.
Okay, Ari, so how long were you on the floor trading or making markets? And then what led to your decision to leave?
So I spent about 3 years on the exchange floor on the Pacific Exchange. And I was getting to the point, what I'd actually done was every evening I would come home and I would practice, in a sense. I created these sheets where I would write down all of the relevant market data from the day, in the sense that I would write down all the closing straddles and strangles and relevant sort of spreads to me as an options trader. And what that would end up doing would have me practice my fraction adding and subtracting. That sounds like an odd thing to want to practice as a trader, but it turned out that despite my years of school, hopefully some trading acumen and overall trading experience, what really could pay the bills was if you could add and subtract fractions really quickly. And I was very fortunate that I was able to do that pretty quickly. But I would take notes and I would try to keep track of, how straddles traded. And I would at times go back and refer to them. So I would use this to look at when earnings would come up in, say, Microsoft, which I had traded for a while. And I would look at the range of the straddle, which would be the closest, the option struck closest to the current trading price of Microsoft, and look at how low it got and look for an opportunity potentially to buy into the straddle or sell the straddle if it got too rich, and use this as a basis for historical data analysis. And this was all done in writing. And so come around 1999, which at that time was when the exchanges started to list everybody else's products. So I need to explain that a little bit. But way back in the day, there were 4 options exchanges in the US. And each of those exchanges had their own products. If you wanted to trade Microsoft options, you only could go to the Pacific Exchange. Likewise, if you wanted to trade IBM options, those only traded at the CBOE. Well, what happened in 99 was everybody started listing everybody else's options. And this, unsurprisingly, was clearly having an impact on trader margins. At that time, I got more interested in using this historical data. And along with a friend of mine, what we did was we started collecting the data. We formed our own company, started collecting this data, putting it into a database, and calculating all of the implied volatilities on the 3,500 odd US stocks that were optionable, that had options that traded. Now, if that might seem like something that's pretty common now, there are sites like iVolatility and Option Metrics and so on, but at the time that we were doing it, nobody else was, at least not for external consumption. So I know that at least one or two of the banks had exactly this sort of thing. I know that others did not too, but it was not publicly available. And so we decided that we were going to focus our effort on that, partially because we thought that was a way for us to find edge in our trading. But it was also 1999. And for those of you old enough to remember, that was the dot-com boom. And we happened to be in San Francisco. And so our thinking went along the lines of, if some guy with a sock puppet can get a valuation of hundreds of millions of dollars, well, we've got a real product. It just turned out that people were more interested in the not so real products versus the sort of practical, down to earth, and potentially more niche products like option volatilities. So that's where he and I went next. And unfortunately, our timing was fairly poor, as soon after that, soon after the dot-com boom came the dot-com bust. And we were pretty squarely in the timing of the dot-com bust. So that didn't really work out. But what did end up working out is that one of the hedge funds that were using our tool called me up and said, listen, we really wish you the best. We hope you make billions on what you're doing. If it doesn't work out, we'd love to have you over here to trade in our long volatility fund. And at that time, which was 2001-ish, my wife was pregnant with our first child. We wanted to get back to the East Coast, and this sort of fit everything along with the whole not making money thing. So it seemed like a pretty reasonable decision. And so we moved back to the East Coast, and I was fortunate enough to join up with a couple of extremely bright and very down-to-earth traders in, unsurprisingly, Greenwich, Connecticut.
Okay. So what were some of the things that you picked up from those two long-time traders that you'd been put with?
Quite a few things, one of which is integrity. And I think my saying that would make them both quite proud. They're both very, very bright guys. A couple of Greek guys. I really think the world of them. And so I started learning how to think about taking proprietary positions rather than merely being a market maker. So this was a long volatility hedge fund, meaning that they invested in long option positions. So they would own options rather than either doing some long and some short, or doing short options, or sort of picking. They were meant to be, at that time, before the VIX was tradable, I might add, they were looking to fill that role. So they viewed themselves as something that you could put in as part of your portfolio, and they would have a smart investment into options, and it would work well with the rest of your portfolio. So you start at that point, you start thinking about what causes volatility, about which positions should you get based on a variety of inputs. So you may not always choose necessarily the one with the lowest implied volatility, but there are multiple factors when you're trading options. It's one of the things that makes options trading so interesting and yet so challenging. And just overall, the difference between making money for yourself and doing the best you can for your investors. And these two gentlemen really focused on trying to deliver the best for their investors. So you'd think that a couple of guys that had graduated also from different Wall Street banks, so they had come from a couple of other top-tier banks, that they might be interested in structured products, complex derivatives, and so on. And they knew that that sort of structure was not generally accretive to their investors, that it tended to benefit the sell side or the professional traders that were selling it. And so they avoided that. And they went out of their way to do so, even though that probably would have made them more popular with the banks and with other order flow providers. We also happen to share a building with the Bayou Fund. And you probably have no recollection of the Bayou Fund, but what would happen is there was this hedge fund that was located in the same building, more or less, and they would come in, their accountant was downstairs, and every month there would be this huge argument over how to mark stuff to market. And I didn't really pay much attention to it until one day that one of the two partners said to me, he said, "There's something wrong. This shouldn't be so difficult to figure out how to mark to market things. If this is what's going on," he's like, "something's not right." I thought that was really significant for a couple of reasons. One, it means essentially what you might call, if you ever listen to, let's say, Strat 4, is they'll talk about situational awareness. In other words, paying attention to what's going on around you and trying to find those things that just don't seem right. And so I started to pick up on that, and I started to think that that was a deficiency that I really needed to work on in my own both life and trading, is to start catching those things that don't make sense. So I thought that was very significant in and of itself. It also turned out that he was absolutely right. And in about a few months afterwards, if you go look up Bayou Fund, these guys had been cooking the books. They had been, it was basically one of the first Ponzi schemes that had sort of, not first, but around that time that it started to unravel. And it ended up, a few of them went to jail. So that had a big impact, at least intellectually, on me, and I have not obviously forgotten that.
Interesting. Okay. So you mentioned there was obviously a big argument every month about how to mark to market. What's that referring to?
So most of your listeners are probably familiar with the listed markets. And by listed markets, that means listed on an exchange. So if you're trading, let's say, Aussie stocks, I'm probably going to embarrass myself by thinking I'm going to name an Aussie stock, and it won't be, but I'm thinking Freeport McMoran. Is that right?
Not sure. Let's just say Apple.
Of course. So let's say you're trading Apple. When you're trading Apple, you know exactly where it's trading. You can see it. It's got a very tight bid-ask spread. There's a settlement price that's given by the exchange and generally agreed upon, and there's really no discussion on it. If you have your statement from your broker, it says Apple settled at $97.27. It's that simple. However, if you're trading something that trades OTC, something that might have a wide bid-ask spread, that is a convertible bond, that may not trade that frequently, generally what's done is people construct a model and try to value it. Now, if you are what one of my later partners would say, if you invested in intellectual honesty, you will tend to mark that conservatively, because you will naturally assume that if you're able to buy at a certain price, there's a reason why, or sell, there's a reason why, namely that somebody probably knows more than you. But nevertheless, these things are not very liquid, so you have to come up with some price. What they would do, even though they're securities ended up going further and further underwater or going against them, they'd be losing money, they would try to mark them as much as they could to show that they were making money. And trying to figure out what assumptions that you put on your modeling in order to price these is where the arguments would come in. And so there was a level of discomfort between the accountant who had to file the documents, meaning the end of month or end of quarter statements that would go out to investors, and the partners of the fund that were looking to show results as good as possible to continue money coming into the fund. So I don't know the exact details, but the point being is that if you're comfortable with your trading, you shouldn't worry about where things are settling or where the mark to market is, what price you put on it. You should be comfortable with the value and how it's going to turn out over time. Did that help?
Yeah, so what are these unlisted products or securities that you're referring to, though? Are they bonds or are they something else?
I don't know the particulars of what they were looking at, but in general, it might be something like an exotic derivative. It could be a convertible bond that doesn't trade very frequently, or some sort of distressed loan or note, or some other type of OTC option that might not have transacted on an exchange or might be on a product that does not trade on an exchange. So if you could imagine that there might be an option that is on a bond that doesn't trade very frequently, you can imagine that the option itself would have quite a bit of leeway as to where it should be valued. So that's where some of the difficulties in actually coming up, the legitimate difficulties of coming up with a price that should be on the securities that you have in one's portfolio. So that's where it comes about. It's really anything that isn't on an exchange. The things that most of your listeners are familiar with, stocks, listed options, futures, these are all exchange listed. You can see right where the pricing is. There are definitely some futures products for which there might be a wide market. They might have perhaps a 10-year crude future. That might not have, that might move around quite a bit on their statement, but it's still relatively well known where a fair value is. There might be an OTC forward, which is the equivalent of a future, on some obscure variant of crude oil from a particular area of the United States. And for that, it's very difficult to value. So it really can be any sort of product.
Got it. Okay. So I'm not sure if this was your next move directly from the hedge fund, but I understand that you spent some time in China. What was it that led you over there?
Well, I had left, just by way of creating a segue, I had left the hedge fund in 2003 to go to the commodity exchange, which is where gold and silver futures and options are traded, amongst other things. But that was what I was interested in. And I traded there for about 9 years until about 2012, till the end of 2012, when I just felt as though it was time to move on. I had left, and I'd actually decided that I wanted to leave trading and had become interested in writing some internet privacy software, when my friend from the COMEX, who I had traded gold options with for quite a few years, reached out to me, said that he had just returned from China, and explained that in China, there were no options. I mean, literally no options. And he said that they were going to be launched sometime in 2015, and that he was trying to negotiate to give a seminar to the Shanghai Futures Exchange. Would I be interested? Well, that seemed like an opportunity not to miss, even if the only outcome was getting a trip to China and seeing what this incredible country and what's going on in its financial markets was really all about. So I was extremely excited about that. And it, blossomed into quite a bit of travel. And it was really been very good for me overall.
Sure. Okay. So what were you doing there? You were hosting a few seminars explaining options to traders in China?
Well, what the Shanghai Futures Exchange does is they have periodic seminars for their members where their members can come and learn about different things, just like you'd imagine here in the United States, whether it might be new regulations or in this case, it was about options. So we were very honored to give a talk. It was actually a 3-day seminar on options trading, options risk management, and how to hedge using the options market. And I think it was pretty well received. And it was, turned out to be quite a bit more work than I had anticipated originally. But it was very interesting. And the Chinese futures companies were extremely interested to get as much knowledge about options trading from what they perceived to be the experts from the United States, which ostensibly was myself and my partner, Paul.
Right. Okay. Very cool. Well, let's bring things up to speed now. So you've experienced a lot, Ari. You've clearly had many different roles over the years. Tell us about what you're doing these days.
Well, part of what came as the outcome of going to China was that the good people at Trading Technologies, a couple of which I knew, reached out to me and said, hey, I know you're busy with this stuff in China, but we have this trading group and we're trying to rebuild it. Would you have any interest in getting involved? And so it turned out to be a really nice opportunity. I hope they feel the same way. But it's been very good for me. What we work on I run a subsidiary of TT, so it's not TT per se, but I run a company called Tradeco Global. And at Tradeco Global, what I am building is a quantitative trading group. And by quantitative, I don't necessarily mean fully automated or strictly systematic, but really disciplined and rigorous, so that we're going to use all of the tools that are available to us in terms of data analysis. I'd like to get involved in machine learning, but we haven't done that yet. And to approach the market from, I guess you would call it, a scientific perspective, that we're going to try to find regularities, try to make intelligent decisions, and just really be very rigorous about what we do.
Okay, and what's the size of that group? Just to give us a bit more context about what you're working on.
Well, in the past, it had been quite big because it was very oriented around having each person as their own business. I like having a smaller group. I like to have tight-knit and very research-focused. So we are a group of 5 and soon to be 6 once my new hire comes on board, hopefully this month. So we're not a very large group, but we're kind of divided between a couple of people that are dedicated toward research, a couple of people that are dedicated towards execution. The new guy is going to be primarily developer, so programming strength. And then my role is to synthesize it all together and try to take advantage of the experience that I do have to try to guide things intelligently and to blend it all together. So that's really what we're trying to do.
Okay, excellent. Now, in the past, we've spoken before this call. You've described this group as having an emphasis on a top-down and a bottom-up approach. Could you share a little more insight on what you mean by this?
Yeah. So thanks for bringing it up, because I think that is important for our trading group, because we do have experience on the trading side, which I would consider sort of the bottom up, right? We are watching the markets. We are, trying to be experts in what we do, in how our strategies are working, what potential regularities that work or don't work. And most importantly, regardless of who's coming up with it, I always want to make sure that everybody is trying to ask good questions about what's going on. So that actually links back to that whole situational awareness that I started learning when I was at Beaver Creek, which is the hedge fund then. So that's the bottom up. The person who's executing, that's at the low level of the market and is making the observations and sees what's going on. So I would like them to come and ask good questions that as a group, we're going to try to answer, probably from the research side. So we'll go back and say, oh, I noticed this. Does this actually hold up over time? Okay, so now we go research that. That's bottom up. Top down to me is, we think that there might be an opportunity in X. Okay, now we research it. We come up with something that you might think of as being somewhat academic. We might even take an academic paper and want to pursue it, right? That's from the top down. So then we come up and we sort of dictate that, hey, we should do the following strategy. This is what we're looking at. These are the instruments. This is how we should trade it. But ultimately, neither one of them is going to be the best route without the other. An observation needs the disciplined research as the follow-up, and the research needs the feedback from the actual execution to make it work properly and to turn what looks like a regularity into a profit.
Okay, excellent. Yeah, and I think we might speak more about that process side of things in just a moment. I would like to ask you that you mentioned with the group, it's not a purely automated or systematic approach to markets. So what aspects are discretionary and what aspects will be automated to some extent?
That depends on the situation, and that's a little bit of human judgment as we go along. So there may be some strategies that we run that might be fully automated. And it also depends, if you think about the different products that are out there. If you're trading something that is very liquid, such as 10-year note futures or Eurodollar futures, that's something that probably can be very automated, that you found some, hopefully you found some real regularity, you found a real edge, and you want to pursue it. It's relatively easy, because of the liquidity in these products, to execute, to provide stop losses, and so on. And the execution part of it, because bid-ask spreads are so tight, or you can buy on the bid or sell on the offer at times, it means that the value added by the trader or the execution person, there isn't that much added. As compared with, say, a far less liquid future, on the extreme might be that you've come up with a model for how milk futures should trade, right? And there, it's probably somewhere where a human being is going to have far more to add. Probably a better example might be in options. Some of my friends that are still on the Pacific Exchange, they don't go compete so much, at least in a market-making sense, in Cisco options, which are super, super liquid, or Apple options, right? Apple options might be better because the dollar prices are large. But overall, there may not be that edge for a human being to go from eye to hand, or, to not intervene at some point, right? It may make sense to be very automated in what you're doing. On the other hand, if you're trading a deal stock or a biotech stock, these are things where there's either bipolar output, if it's earnings coming up, or an FDA approval, meaning a regulatory approval for a drug that might be coming up, or an approval for a merger or acquisition. These are things that machines don't really do well. They can't deal with some of these externalities or irregularities. So I view each particular situation as being somewhere on a continuum between where is it a algorithmic edge and where is it a more creative edge.
Let's jump to a quick break here to thank our sponsor for this week's episode, Wonder Capital. Wonder Capital makes it possible and very convenient for accredited investors to catch strong returns by investing in diversified funds which are backed by large-scale solar projects, not the market. So here's how it works. It's pretty straightforward. Wonder Capital, with the help of industry pros, offers simple financing loans to fund commercial solar projects. They then take those asset-backed loans, package them into a solar fund, and open the doors to accredited investors to earn targeted returns of up to 11% annually. The part that makes this really sweet is Wonder Capital don't take any fees from investors, and funds are fully managed by solar specialists. To learn more about how you can benefit from impact investing and join thousands who already have, visit wondercapital.com/trading now and create a free account. But just remember, that's Wonder spelt with a U, and please do your own due diligence before making any investment decisions. Now, there's a few areas I'd like to explore a little more with you. Those being probabilities and process, trade management, and also some more about options. But let's start with probabilities and process. So one of the things you've expressed to me in past conversations is the process is more important than the outcome. Would you mind elaborating on this and maybe explaining why you feel that way?
Yeah, this is one of those things that, if you really do believe in process over outcome, you can feel like a long-suffering person trying to tilt at windmills. Most people will judge decisions based on the outcome. In other words, actually there was, I was watching, I don't know if you follow hockey or not, but there was the NHL All-Star game on earlier, and they were talking about a player, Ryan McDonough, who now plays for the Rangers. And I'm going to mangle part of this story because I like watching hockey, but I don't follow it to that extreme. And they said, and you know what? I even forgot what team traded him. I think it was Buffalo. The point being is some team traded him. He's a great defenseman. And, it was Montreal. They said, Montreal will look at that as the worst trade. Yeah, but you can't judge it based on the outcome. Nobody knew at the time. If they knew at the time that Ryan McDonough was going to be one of the great defensemen in the league, of course it would be a bad decision. But it wasn't clear at that point that he was. And so you have to evaluate your decision-making process based on how you made your decision, not on the outcome. Because if you think about it, you're going to end up with a box. And unfortunately, we don't have video here. And there's Michael Mauboussin has written a great book called More Than You Know. And he's used this grid from, I think, somebody else. But the basic idea is that you are either going to have a good decision or a poor decision. And then if you think about it as being a grid, then there's also going to be a good outcome or a bad outcome. So you can make a good decision and have a good outcome. And so they call that earned reward, right? You made a good decision and you got a good outcome, deserved reward. And you can also think that you can make a good decision, that you've got a 90% chance of making a ton of dough and a 10% chance of losing a little bit, and you can still lose a little bit. Okay? That's just the way that it goes. And I think we've all had trades where we felt that we've made either a good or a bad decision and had an outcome, either good or bad, along with it. And if you want, I can go into an illustration of two trades I happened to do at the same time where I felt like one was a good decision, one was a bad decision, and the outcomes were sort of independent of that. And that's really how you have to look at it, that there's a good way to make a decision and a bad way, and the outcomes are what they are. But you need to keep focus on making good decisions, and hopefully over time, the law of large numbers will work in your way, in your favor, I should say.
Yeah, that's a really cool analogy, and I think it actually helps to make that saying quite a lot clearer, because I mean, we do often hear the process is more important than the outcome, but you know, sometimes we can really just question that. So yeah, I think that actually made it a little clearer. So no, that was good. Thank you very much. Now, would you be able to share an outline of the process your group actually goes through to discovering potential trading ideas? Like from the point where you mentioned earlier that someone might ask, you know, a good question, how do you go about finding the answer to that? What's your process for that?
Well, part of the idea of having a good question is that you phrase it in such a way that you have a shot at getting an answer, right? Your question can't be, how do I make more money, right? That's very vague. You know, it might be that I notice that the market is 4 times more volatile on a non-farm payroll day than it is otherwise. Can I confirm that? How consistent is that? And let's investigate that further. Or you might, and I don't know whether this is true or not, but you might say, the first direction, I've noticed ad hoc, you know, from watching stuff, it seems to me, which by the way, I should say that more likely than not, your observations due to behavioral biases, right? There's plenty to read about that, but your anecdotal may not be right, which is why you have to go and verify it afterwards. But let's say that you've looked at the past few non-farm payroll numbers and you say the first move in 10-year notes right afterwards, you want to fade. In other words, take the other side of it. Rises, you want to sell it right away. Because eventually, like after a few minutes, it's going to come back hard the other way. Whether it's, you know, first it goes up, then you want to sell it, or first it goes down and you want to buy it. So then you'd go back and you want to go find the data and verify whether in fact, one, does that in fact occur? Is this a real regularity? Is it a real observable fact? And if so, what can I say about it? And by what can I say about it is what is the magnitude? You know, what are all of the factors? Think about all of the factors that might go into a trade. Do I put in a stop loss? Well, how does that figure into analysis? Well, what is the typical size? Does the size of the move after a number impact how it might react after? So you continually, even when you're doing the research, you should be paying attention and asking questions and, you know, taking very careful notes. It's really one of the important aspects of trading is being organized and, you know, dotting all your I's and crossing all your T's. It's not really terribly glamorous. It just may seem that way sometimes because you'll see some people who, you know, for some period of time just seem to be on top of it. But my experience is that the successful traders in terms of risk-adjusted returns are the grinders. Now, that might be because of my particular experience in making markets, but I tend to think that even in the sort of Stanley Druckenmiller crowd, and not that I have personal experience speaking with him or of the heavy hitters, but I would think that they spend a lot of time doing research. And if you listen to Warren Buffett or Charlie Munger, what they say, they talk about reading an awful lot, spending 5 to 8 hours a day reading, which, you know, in the case of a quantitative trader might not necessarily be the same reading, but it might be data analysis, or it might be, in fact, taking, you know, some course online to try and learn something else, or even, you know, taking some sort of just learning something about a different field that might give you some insight about slicing data in a slightly different way.
Yeah, you hit on a lot of really valuable points there. I like that answer. So I think this probably leads on from the outcome. So again, referring to something you mentioned to me off air, you were talking about how you aim to be in a position of positive expectation. What does a positive expectation look like, and how would someone know if they have one?
I guess we can start with the definition of a positive expectation. And again, I happen to be reading Michael, and I'm probably mangling his name, so apologies to him because he's done a great job, and I think quite highly of him. Michael Mauboussin. The book is More Than You Know, and I'm not trying to plug his book. It just happens that I'm reading it. And he talks a lot about how great investors focus on positive expectations. And a positive expectation means that you're not merely looking at either the probability of gain or merely the magnitude of gain. It's that you take the probability of gain and you multiply that times the magnitude of the gain, and you do the same for the probability of loss and the projected magnitude of loss. And when you take the probability weighted gain less the probability weighted loss, if that number is positive, that's a positive expectation. In other words, based on the probabilities as I see them right now, there's positive expectation of a profit. Okay? Now, of course, the natural question is, yeah, but I don't know any of those numbers. And that's absolutely the case. We don't. So how do we go back and take a look at that? Well, we can start making pretty good guesses based on some historical either rules of thumb. So if you're investing in credit, maybe you have a pretty good idea of if something goes into bankruptcy, if a company goes into bankruptcy, that a certain type of payout can be thought of as being expected. And then you can figure out what the magnitude will be, which is fairly easy if it's a note, meaning debt, because it's either going to be anywhere from 0 to 100. On the other hand, it's much harder to figure out what your magnitude of loss might be in a 15-minute period for gold futures. That's rather difficult. But what you can do is you can make certain guesses based on, and this is really where your research comes into play, is that you're going to make guesses based on your research, and then you need to take into account that you're not always going to be correct, right? There's uncertainty in everything that you're doing, and that uncertainty may play in your direction or against you. Often it tends to be against you because there's what is called adverse selection, but that's a different topic. So you do the best you can, and you try to have as many, like if you have a situation where you have a positive expectation, you don't want to bet just once, right? If you're the house at the blackjack table and you know that you have a 2% edge on your players coming in, you don't want to have just one player betting large amounts. You want lots and lots and lots and lots and lots of betting going on in small amounts so that you can reap that 2% on average. That's what you want. And that's what I want when I'm trading. I want to find these positive expectations games. I want to bet relatively small amounts each time, and I want to do it as many times as I can. I want to go continually having people coming into my casino. And, that is kind of how I look at the world, right? So, and it doesn't have to necessarily be as a market maker, although it's relatively easy to understand where a market maker obtains his edge. That's relatively well understood. As a proprietary trader, it's much more difficult to estimate probabilities on what the FDA might do or what other investors might do after an earnings release, even if you know what the earnings are going to be for a particular company.
So I was just going to add on to that. I mean, would you say it was trading options and your experience of making markets that actually got you into the habit of thinking this way and thinking in terms of probabilities?
Absolutely. That's one. I don't think it's an accident that Nassim Taleb is the author of The Black Swan. He's an options trader by training. And I think that, quite frankly, if you have that experience, either as a poker player or some other probability business, that it is extremely helpful in the way that you look at all aspects of your life and in looking at the world. So yeah, I think that being an options trader has had a very profound effect on me. I'd also say having a relatively long career has also done that. When we gave that talk to the Shanghai Futures Exchange, my partner said that one of his favorite slides was how if you look at the standard deviation, right? People say, oh, this was a 1 in 1,000-year event. They said, I'm sure you heard plenty of that coming out of 2008. We couldn't predict it. Well, if you go through and look, there's about a 1 in 1,000-year event that occurs in finance like every year or so. So it's not really that credible to think in those terms. And obviously, there's more to it than it merely being a 1 in 1,000 year event. There are fat tails in finance. And actually, I remember reading very distinctly in 1990, after 1998 and long-term capital blew up, that I think it was Lawrence Hillenbrand was quoted as saying, trading in finance is not, and selling options is not the same as selling insurance. The fact that you've written a lot of hurricane insurance does not impact the likelihood of a hurricane reaching ground. On the other hand, the fact that you've got a very large position in finance does impact your probability of gain or loss, right? Which is, I guess, linking back to a Heisenberg uncertainty principle, which is to say that the moment you're observing it or the moment that you're part of it, it changes the actual it.
Yeah, and you mentioned Nassim Taleb in there, and that's actually the third time his name's come up on the podcast. So I'm actually thinking he might make a good guest, and I might actually try and get him on. I haven't read The Black Swan or what's his other one, Anti-Fragile. I haven't read those books, but I'm actually very keen to. So yeah, he might be someone I reach out to in the future. But let's move on to the more of the trade management aspect. Share with us your rule for half, your rule of half, and how it's been helpful to you.
Yeah, I don't think that I'm unique in that, and it certainly isn't scientific. I should probably be embarrassed by it, but because it's kind of simple and after all of my talk about rigor, my rule of half doesn't really sound that rigorous or disciplined, or I should say rigorous. But what I found is that when I do have a position that makes me particularly uncomfortable, that ultimately we are just human beings. And a certain amount of how we perform is impacted by our emotions. And so what I found is that when I've put on a position that even if I think is correct, I will find myself doubting it because the price action is marking it against me, or I just feel very uncomfortable in some way, that I will begin by taking off half or some reasonable proportion of the trade so that I can feel as though I've done something about it, which I actually have. I've lessened the potential for loss, even though I've locked in some loss. But it makes me feel more comfortable, and I can go back to doing what it is collecting those positive expectations. Because ultimately, that is actually the biggest lesson that I learned from making markets is I'm in a positive expectation game. You can't put yourself in a situation to end that game. Not every trade you're going to do or series of trades is going to work out, but you need to be in a position that you can get back to making those positive expectation trades. And so my rule of half is just a way of taming something that's going awry, making it more controllable, and allowing myself to feel more comfortable. And maybe, now that I felt like I've done something about it, that I can think more clearly about the situation that I'm in, and maybe even put it right back on.
Okay, and even with the rule of half, I presume you still know where you are going to exit the full position if things go bad.
Yeah, sometimes, like in what we currently do, sometimes it's a question of, just based on time, because that might be what our analysis is based on. It is what it is. It's up or down. And, we've done some analysis that's time-based. So just get the heck out. Now, when you're making markets, sometimes you don't have that luxury. There is, where are you now, right? So you ask, what's your market in X? You give a market. They say, okay, sold all your size that you've got there. Where are you now? And so you're stuck in a position of obligation where if you wish to continue trading, you have to keep quoting. And in those situations, it can get particularly scary because you're a leveraged player and you don't really know where your exit is going to be. So if I decide that I want to go long 10-year note futures and I'm a proprietary trader, I know that I can be limited to 5 lots or 50 lots or 500, whatever my limit is, because I can stop. But if I'm a 10-year note market maker, I don't know where I'm going to stop exactly. Now, it might be that the clearing firm will stop for me, but things can get pretty scary along the way. And I think that's a little bit underappreciated by the general public these days in many of the criticisms, but not all, of what people are vaguely calling, usually misunderstood, with a misunderstanding towards HFT. So I kind of went all over the map there, but I just wanted to address a little bit that as a market maker, you don't always get to choose what your position is.
Right, okay. No, that's really good. Now, there's one last thing I'd like to ask you, and then we'll probably bring this to a close. But having spent pretty much your entire trading career in the professional arena, and you've traded many products, you've traded many instruments that the retail will never touch. Is there anything that independent retail traders could adapt from the pros which would be beneficial, whether that's just how they view markets, how they view risk, anything along those lines?
So I think that one of the biggest, I guess my perceptions of the difference between a professional, trader, from Wall Street is that you're really thinking as much as possible about those positive expectation trades. You're not, and you're in, and it's work. I mean, that's basically the difference, is that most of the time on Wall Street, people become experts in a certain relatively narrow field, and they parlay that expertise into their trading success. And I think one thing that also ought to be noted about, even on the professional side, is that for every trader that you do see that has been successful, there's, I'd say, at least a minimum of 99 bodies behind him, or her, I should say, behind him or her, that never made it. So it's often thought that, oh, trading is very glamorous and so on. But many people just don't make the cut, either because they never are able to show enough to get into the seat in the first place, or because they're unsuccessful at what they're doing, perhaps because of the difference between process and outcome, or it may be just that they don't have what it takes to become a trader. I think the fundamental attitude of a professional over a retail trader is that a retail, in my mind anyway, tends to look, and I am guilty of this as well, tends to look at a single instrument and think that without a lot of research and effort, that they're going to have some edge over what they're doing, or that they have not put a sufficient amount of effort into verifying that they do in fact have an edge, and what their edge is, and how that translates into a positive expectation, let alone the probability distribution of that potential positive expectation. And I think that, I'm fortunate enough to have two great kids, and I've had my kids come up and say, oh, I want to learn how to trade. And so I sat my son down and I said, well, the first thing that a professional learns is arbitrage, right? We're looking at, can we make money by finding very alike things and, take advantage of making money there. The idea, meaning really essentially that the idea isn't to come up with a super great idea or to have something that's very, quote, sexy to look at or explain, or something that's very complicated. A professional trader is here to make money. That's it. If it's dumb and, there's a very easy rote way of how to do it, then that's how you do it. It's not, and you don't have to do it in big size. A lot of money has been made trading very modest contract amounts. So maybe that helps a little bit.
Absolutely. I loved that answer. And I think that, really takes us out with a bang. So thank you very much, Ari. It's been awesome to have you on the podcast. Before you go, can you share with listeners where they can go to find out more about you? I don't know if you're active on Twitter. I know you had a blog at one point. Is there anywhere listeners can go to reach you and find out more?
Yeah, well, you can go to Trading Technologies and find my email there. It's pretty straightforward. It's my name, and reach out to me. And I guess, I have a website, pinert.com, that I haven't really updated that much. And I'm hoping to become more active on TT's blog going forward. And that could probably cover it.
Yeah, no, that's excellent. All right, well, I'll be sure to include those links to your own blog as well in the show notes at chatwithtraders.com. So again, Ari, thank you very much for doing this. It's been awesome to get your insight, and let's talk again soon.
You're very kind. Thank you.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Chat with Traders, episode 28.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey there, what's up everybody? Welcome back to a brand new episode of the Chat with Traders podcast. This is episode number 28. And before we go any further, let me just say a huge thank you to everybody who listened, tweeted, shared last week's interview with Jack Schwager. I was thrilled to have him on the show, and it sounds like you guys all really enjoyed it. So thanks so much for listening. Now, let me tell you a little bit about this week's guest. And he originally was attracted by the fact that traders can make money in both rising and falling markets. So this week's guest, Andrew Fordy, left a career in commercial real estate when the GFC hit in 2008 to focus his attention on becoming a trader. A few years on, Andrew has carved a profitable niche for himself, trading options and designing systems, both topics which are covered in depth during this interview. But some of the highlights from this discussion would have to be the way in which Andrew avoids trying to predict the market and instead thinks of trades as a series of if-then scenarios. Also, the purpose of why the options market even exists is really interesting, as well as the important factors one should consider when designing a system. I also like how Andrew applies a blend of systematic and discretionary aspects to his own trading, which we go into during this interview also. And if you have any questions, so if there's something you're challenged with or something you want to know more about, then take this opportunity to ask Andrew a question. Whether it's in regards to trading options, designing systems, or just trading in general, Andrew's your man. So leave a question for him in the comments at chatwithtraders.com/28. Just scroll to the bottom of the page and leave a comment and Andrew will get back to you. All right, guys, I'm your host, Aaron Fifield. This is Chat with Traders, and here is this week's guest, Andrew Fordy. Andrew, welcome to the podcast, man. How's it going?
Doing great. Thanks for having me on.
No, thanks a lot for coming on the show. I really appreciate it. And there's a few things I'd like to cover with you today. So, of course, we'll begin with how you got into the world of trading and what your early experiences were like. But from there, we'll get into some discussion about options and sort of systematic trading. And seeing as you're very clued up on options, where as I'm almost a complete novice in this area when it comes to options, but listeners will probably recall me saying that from previous episodes. But feel free to add to your answers with anything that may be valuable, even if I don't necessarily prompt you with my questions. So
okay, sure.
I can do that. Plan?
Yeah, sounds great.
All right, cool. So let's start from the start. And if you don't mind, share with us, what were you doing before you got into trading? And then what actually sparked your interest in the markets?
Well, before I became a trader, I was a full-time commercial real estate broker in Florida. And when I was kind of developing my career there and I was working on teams, and through unfortunate timing, my career was just starting to grow when the Great Recession hit. And Florida specifically was kind of the epicenter for the real estate crisis, where a lot of the United States real estate values dropped 10, 15, 20%. And in the area where I live, things dropped by closer to 50 and 60%. And so our local market went to more of a depression, whereas the rest of the country went into a recession. And at that time, so it was challenging, and it looked like it was going to be very difficult for several years. And one of my mentors that I've known ever since I was a teenager, he also had a lot of commercial real estate holdings, and we were involved in the business together. And we were discussing it, and he had some investments with a hedge fund that was trading options, and they were doing very well. And so we said, well, this is great. The market's going down, and they're they're profitable. It just was totally counterintuitive. We did not understand how that was working. How are these guys trading options, which is, part of the stock market? They're trading S&P 500 options, and, the market's crashing and everything's bad and the economy's going in the toilet, and these guys are making money, and they were making a lot of money. And we're like, we have to figure out what's going on. We have to know what's happening. And so we both kind of parallel went into this education process of kind of self-teaching and exploring what was going on. And so that was back in 2007, 2008. And we're going through that process and a lot of studying, and one thing led to another that I just decided that I didn't want to tie myself to a local economy. I didn't want to tie myself to one industry and one sector, and that by trading the markets, I was going to have the ability to be in any market that I wanted to be in and anywhere in the world, and I could do it from anywhere in the world, and that I could actually profit like these guys, whether the market went up or down. And I said, that's the path I need. I need to be on that path. I need to have that opportunity where I'm not dependent on a strong economy. I'm not dependent on economic growth for how I'm going to do each year. So that's kind of what spurred everything and how I became attracted to the trading world. And then one thing led to another, and just through my natural instinct to network and work with traders and work with business contacts and really just get out there and not just live in a bubble. I got to know a lot of great people and got connected with SMB Capital in New York, and really was able to expand and get my trading up and running and go full time. Okay, that's kind of the background.
Right. Yeah, that's a really good answer. So let's get into that sort of education process, which you briefly touched on there. What was that like? Like, what was the process you went through, and what was that education that you were sort of absorbing right at the very beginning there?
Right. Everybody starts probably in a similar place where they're gonna absorb all the free information that's available. So, there was lots of hours on YouTube and lots of time on blogs and social media and trying to find videos. And then you go buy the stack of books from Amazon and you get them and you start reading all of them. And, that kind of orients you to what's going on in the lingo. But it really, the unfortunate part of that is it can lead you down a challenging path, because you may start to learn the language of trading. You understand the concepts of what the different tools are and what the different instruments are. And maybe they talk about strategy, but they don't tell you what to do. They don't guide you either from liability, or they just don't know what they're doing and they just know how to explain the market. They might just be a financial publisher and not really a trader. And so you don't really get the tool. You understand about it, but you don't understand what to do or how to do it. So it was kind of like a struggle. There's a lot of excitement about the possibilities, but really just not having any guidance made it kind of challenging. And then little by little, I realized, and then the other traders I work with realize this even quicker than me, is you have to, if you really want the best information, best education, and you want to accelerate your knowledge, accelerate the growth of understanding and your personal growth, you got to hire people. You have to hire the experts to teach you. And so we went down that path, and many tens of thousands of dollars later of educating ourselves, that's really what it took. It really took that for us some people say, and I've heard this by educators that I've worked with and respect very much, because I know they're excellent traders and they also teach, is when they tell somebody about trading and they give them a strategy and they tell them what not to do and give them guidance on what they should be focusing on. If they give that away for free, the person never follows through. And they could charge $1,000 for the same conversation, and the person that pays $1,000 is going to pay attention. They're going to take notes, and they're going to hold themselves accountable for a period of time, because they put money on the line that they're going to take that knowledge and apply it. So that's what happened for us. We spent lots of money, different service providers, and the best education I've ever received was through SMB training, and that's why I stuck with them and really started to develop a relationship there, so that I could take that information and kind of help share it with other people and help other people learn the way I did. Hopefully the right way, not spending too much time trying to consume free information and think that's going to help them grow their trading business.
Yeah, sure. I mean, I have actually heard that in the past, that when you do pay for something, you do tend to, in most cases, pay more attention to it and actually benefit from it more so. I mean, that's probably like a, marketer's favorite phrase as well, but it does actually, it genuinely holds weight in most cases. So that's a good point that you brought up. And you also spoke about, in your answer there, about he spent tens of thousands of dollars on education. I mean, surely no one actually wants to pay that much. In hindsight, how could you have maybe not spent so much on education? Like, how could you have?
I'd say, I could probably go through and pick out 20,000 of that we could have skipped, in hindsight. But you don't know which thousands of dollars and which courses and what instructors and what online programs. In hindsight, we know that some of those, it probably gave us more of the tools and taught us about the market in a way. And by having the cost involved, we really had to absorb it. And that helped us probably at some level. But the parts that mattered, it's probably $3,000 or $4,000 worth of education after knowing the basics that really gave the tools that hard and fast, here's your training wheels. Just follow these guidelines, do exactly these steps from day to day. And, most people's personality, most traders' personalities aren't going to be able to live, following a very specific set of rules from day to day. But by starting that way, by doing it that way and letting a system work, you can realize that it's not about your intuition in the market. It really is about strategy. It's really about using things, doing things that make sense, doing things that work. And it's not about your ability to predict. Once you get past that and you stop thinking that the only way you're going to deserve a profit is by predicting, then that kind of frees you of that responsibility, and you know that you can just apply things that work in the right circumstances. So that, that's probably, tens of thousands is not I'm not going to say that's what it takes. That's not true at all. But I think it does take a few $1,000s of education to at least accelerate your process. Take somebody else's 10 years of experience and pain of developing how it works and let them teach you in a few hours. Let them show you or let them mentor you over a couple of months and just shortcut all of the trial and error and get to what works. Generate profits from it and then go from there and start developing your own ideas. But just trial and error alone that's how it becomes, or you're going to be going against the odds for your success. Because most people aren't willing to pay for somebody to help them. Most people think you have to predict what the market's going to do to have a profit, and that's just simply not the case.
Sure. Okay. So even for you in the sort of the first few years of your journey, if you had to put it down to maybe one or two things, what would you say were the biggest challenges that you had to push through when you were coming up? So challenges that essentially impacted your P&L in a negative way.
Right. So thinking I have to predict is where it stems from. And then the second part of that is when you're wrong, then you have no plan because you say, well, I made the prediction. And I really feel in looking back at the early struggles, I really feel like I thought that if I didn't predict it right, I didn't deserve to change my mind and then, stop losing money. Like I had to take that pain from being wrong and I had to wait until the market agreed with me to get out of the position. And that was probably the worst and most stressful times where I went through a few different mouses where they'd get smashed and I have to go get another one and all that stuff. But now knowing that it has nothing to do with predicting and I don't have to feel like I earned a profit by guessing what was going to happen correctly, that now it's more about adapting to what's going on and knowing the two different probabilities in every market, which is the trend and the range. If the trend is identified, then you can expect continuation in that trend. However, you have to respect the range as well. So if you're a little bit overbought in a bullish trend, you can't just say I have to be bullish because it's bullish. You can either be flat or a little bit less long, or maybe even a tiny bit short if you want. But really getting past thinking, well, we're overbought, the market has to go down, and that's the only way I'm going to make a profit this week. That there's a lot more ways to do that. So I want to make sure I answer the question fully. Early struggles, is that kind of what we're getting at?
Absolutely, yeah.
Challenges. So thinking I had to predict, not being willing to admit when I was wrong and get in the right direction again. Poor strategies, the wrong strategies on the wrong instruments. That's a big one. So frequently managed income trading styles on low-priced ETFs, that's just a recipe for disaster. So, if you have an iron condor or butterfly management strategy and you trade that on an ETF and you hear people talk about fixing and adjusting and managing their profiles, you say, okay, I get it. I'm going to use ETFs and I'm going to use an income strategy and I'm going to manage it frequently to make sure I keep it under control and wait till I trap the market. Well, you got two things right and one thing wrong. And the one thing wrong is you're using it on the wrong instrument, which means your commissions are going to be 1,000% more, give or take, whatever the exact number is. But you're spending 10 times as much on commissions for frequent management, which means you're running uphill with the wind in your face because you have to overcome very expensive commissions on that strategy. Whereas the same strategy on an index option has a better chance because your commissions are less. Or contrarian trading without risk management. That's, it's a, public, your show's heard by a lot of people, so I won't mention any names, but receiving guidance from people that were really more in the entertainment business than the trading business, that just expressing their opinions all the time and saying, I have the experience, I've done this for so long, and the market has to go down. And so it's just be short. That's it. That's the whole strategy. Is be short because the market has to go down. And when it doesn't go down, they're silent. They have nothing, no more guidance for you. And you're left to say, well, what am I supposed to do? And if you don't have the right strategy and you don't have somebody that is showing you whether or not they were even in that position, then you're left on your own. Now you're out there with, frustrated and you're waiting until you're right. So, being in the right strategies, having people that are actually showing you that they're doing what they're saying they think is going to happen, and giving you guidance as far as day-to-day how to get out of it and what to do if things don't go the way they think. The best traders I know, they aren't, I'm not saying they're the best traders in the world, but the best traders that I know at SMB, none of them think that they are going to be right. That's just it. That's all there is to it. They have an idea and they have a belief that they are skilled and have a good knowledge of the markets and that they're going to be right more than half the time. And really, it's going to be a number quite bigger than half of the time. But it's still, when they're wrong, they know it's like, I'm wrong. I'm done. I'm out of that one. And it doesn't mean I'm flipping my position. It means I'm wrong and I'm done. I'm out of that one. And you keep the loss small and you move on to the next one where when you're right, you can have the big win. So it's just some of those kind of psychological things and strategic things where there's so many ways to approach the market that if you just have the wrong combination, you're going to be struggling. So just having the right combination of strategies and psychology to make sure that you have the ability to control your losses when you're wrong and, have the good sized wins when you're right.
Sure. Okay. No, that's a really great answer, Andrew. And something I'd like to go into a little bit deeper on what you mentioned there. And it comes up now and then is why you shouldn't predict. You shouldn't try and predict the market. But I mean, no one knows what the next one or X number of bars on the right-hand side of their chart are going to be. So what do you mean by you shouldn't try to predict? Because obviously when you execute an order, you're either anticipating that it's going to go up or it's going to go down, and hopefully in your favor, either direction. Could you just expand on that, the reasoning on and the mindset of predicting?
Sure. If it feel, and this is going to get into just semantics, but hopefully that by going through that, maybe the psychology will come through. If you feel like you're constantly predicting, or if it sounds like predicting, like the market's currently wrong and it has to do this, or this announcement's going to come out and this is what's going to happen. And you basically position yourself with one scenario. If I'm right, I'll be profitable. If I'm wrong, I will lose. If that's the case, then you're going to, especially, and some people don't even go as far to say if I'm wrong, because they just don't think it's possible. They say there's just no logical way that I'm wrong about this, and this is what has to happen, and I have to be in that direction because it's the only thing that makes sense, and they go for it. And if it doesn't work out, it's like their world falls apart, and they don't they freeze. It doesn't make any sense why it didn't happen the way they thought. Then they have no plan of what to do after that. Now we'll go into the part where you're saying you do have to have some kind of bias. You do have to make some kind of assumption about what's going to happen. Well, in options trading, you don't have to make that distinction. You literally can have no directional opinion in options trading and go from that point. Your only opinion may be whether or not volatility will expand or contract in the short term. But even that is not going to be, that's only going to impact in the short term, but not the trade itself. So that's one way that you can remove predictions. And I found that options traders that find good guidance and have discipline have a higher probability of success than directional traders. And that's just from my own personal experience. I don't have some kind of deep, 1,000 person survey to prove that or anything. But my observation and working with a lot of traders and seeing the success rate with the types of traders and seeing traders that failed at directional trading and then learned about non-directional options trading, that they have number one, they have a great chance that they will stop losing money if they have good guidance on the types of strategies and instruments to trade. And then secondly, they have an increased chance of generating some type of positive results by using a systematic non-directional options trade and with the right management strategies. And that's not saying that they're going to make money every month, but if they stick with it for 6 months, in most market conditions, they're going to come out ahead by following those strategies. And they're not going to be home runs, and you're not going to, triple your account this year, but you can make decent income on a decent sized account. So now I'm going to finish the thought process by saying, now when you do a directional trader, where does that leave them? They are a directional trader, and I said that they can't predict, but they have to have an assumption. The psychology that I would encourage, rather than feeling like a prediction, I would rather have a series of if-then scenarios and several of them. So I would say, if we trade back to this level, then I would consider that a great long opportunity, because it would be a dip in the direction of the trend. Just very simple if-then scenario. If we were to have a dip in the direction of the trend to this level, I think the risk reward would be favorable for a directional trade back to the top of the range or to a new breakout, and then I would close it when everybody else is buying the breakout. So that's my if-then scenario. Say, well, I don't have to that's not the only way I need to I could make profits on that instrument. I can have a second if-then scenario. If we don't pull back and we break out and we hold, then I can buy a held bid above that level, or if we consolidate above that level for 5 or 6 bars and the bars are getting smaller, then I would also consider that a long opportunity. I don't need the market to come down to my level. I can take advantage of it another way. And I've eliminated predicting what is going to happen. I've given myself 2 ways to profit. I can say if that first one happens and I buy it and then it breaks the level that I thought was going to hold, now I can have a whole nother series of if-then scenarios. If it holds below that and consolidates, now it's a short opportunity. If it trades back above and consolidates, it's a long opportunity. If it trades back above and takes off, I'm going to skip it. It's not trading in a way that I want to trade, and I'm just going to go on to something else. Those are a number of scenarios where you say, here's, in this scenario, I'm going to have a small loss. In this scenario, I might change my mind and go the other direction. In this scenario, I have a lower probability trade, but I might be able to hold it longer. And you give yourself a number of ways to be in that without needing to say, you know, get in some chat room or get on Twitter and say, XYZ is going to drop 50 cents and I'm going to buy it and it's going to make a new high. And now, because you've made some public proclamation, you feel like that has to happen for you to have any dignity in the world. Rather than that, just say, here's some if-then scenarios. If it gets here, I would try this. And it's a more humble attitude. It's a more adaptive attitude. And you don't feel like you have your pride tied up in what happens next in that stock or ETF or index or anything else.
Yeah, that's really good. I like the idea of the if-then scenario. That's definitely a way to overcome that predicting kind of mindset for sure. And just before we get into a few more of the specifics about how you trade these days, I'd just like to ask you, from the point you started to the point where you reached some sort of level of consistent profitability, what sort of time frame was that period?
There was probably a year and a half that was heavy bleeding and painful and stressful. And then probably a 6-month period of kind of turning away from that. And then, I mean, what year is it now? 7 years. So, and then after that, just kind of slowly, and it's been a progressively steeper incline from that. So call it a year and a half of kind of poor results and non-results. And then until I was moving into something that was more sustainable. And then now at this point where, you know, achieving levels as an active trader that you don't hear about in the news and from hedge funds and things like that, just because it's more active and for smaller accounts than these big institutions.
Sure. Okay. No, that's really good. And during that time, like the first 18 months, how active were you trading and how intensively were you studying?
My study was off the charts. Every waking moment that I had, I was reading and studying and back testing and creating charts and creating studies, just going through and watching webinars and reading books and reading information. It really was, 6 a.m. to midnight every day. It was like, that's all I lived and breathed was the markets. And that's just what I felt like I had to do. And I learned a lot in that process, but I was also not consuming the correct information. So I had information overload from bad sources. So from all of that free information that was out there from entertainers rather than, traders that were actually trading professionally and getting real results and sharing their results that they were getting. So I don't think that's the process everybody should go through. I think I worked too hard and looked in all the wrong places, and was looking for people that were going to show me how to predict the market or depending on them to predict it and feeling like I could follow blindly along with them. That just, none of that worked out very well. The study was very intensive and the activity was pretty active, probably 5 to 15 trades a day, sometimes more than that, which would have been a bad thing because I would not have been trading strategically. So moderate amount of trading. I wasn't trying to scalp or day trade or find the hot stock of the day or anything like that. I was just probably over managing options trades in the wrong instruments. The commissions were through the roof, really eating into any chance I would have had of making profit, even if I knew what I was doing. All those mistakes, that's kind of what it looked like. So while I was working hard and feeling like the harder I worked, the worse it got. And so at some point I kind of backed off and said, I'm looking around, and as I was getting into the SMB world and I started seeing these traders that had full-time careers and were basically bought 3 courses and learned for a few months, that they got to the point of profitability. I said, well, what's going on here? These guys, they trade like 3 times a week and they're doing well. I don't understand this. So that's when I kind of adapted that mentality and got into a little bit calmer state and learning how to trade that way, and it was doing well.
Okay, sure. And just real quick before we move on, while you're studying from say 6 a.m. till midnight most days, you obviously didn't have a job during that period. So what were you doing for an income?
So that was with the group. I was doing some other consulting, and because my background is marketing, so I would do marketing consulting. I did some real estate consulting, and I had some real estate deals that were left over from the brokerage company because commercial real estate deals specifically, a lot of them take, 6 months, 18 months to happen. So I had a lot of deals that were kind of pending that I still had a commission coming on. So those checks were coming on occasion. So it was enough. It was pretty thin, though. There wasn't really a lot of income. And, there was more nights where I was buying ramen noodles and, keeping things nice and easy. But thankfully those days are behind, at least for now. I'm thankful for it, but it's not like that anymore. But I think more importantly, I'm grateful for. I don't even care about what a little extra money coming in does. Mike Bellafiore says he talks to young traders and developing traders and says, "What do you think the greatest part of trading is? Why do you think we do this?" And they say, "The money." And they try to come up with like a deeper answer because they know that's what he's getting at. So like financial freedom and taking care of your family and things like that. He's like, yes, all of that's good. All of that's great. But you could do that anything. You could go out and get a master's degree and be an engineer and do something else. You could get all of that in some other job and industry. So why is it trading though? Why is it trading? And like, it's freedom and you can make more money and this and that. And Mike, he lets them go on and give all their answers, and he's very consistent in his responses. This is something where it's very challenging and most people don't make it. So when you can achieve and you can get to that point where you say, I went through the rigors and I went through that process and the learning process, and now I can actually do it. And there's that achievement level. It's more of an analogy for a professional athlete that has to work hard to get to a certain level. And, some people call it, you can almost call it like the gamification or the sport of it. That's the part that I'm really enjoying right now, is that confidence. That's something I used to look at and have no clue and used to kind of pound back on me and was challenging. Now I can navigate it from day to day and actually feel like I'm on the right side of things. And it took a long time to get there, but I really enjoy that.
Okay, Andrew. So let's move along a little bit and shift into some discussion about more about the way in which you trade nowadays. So how would you define your trading method?
The core positions that I'm in are income oriented, and income some kind of has the connotation that it's lower returns, and it can be. You're definitely not going to hit big home runs, but it's definitely better than typical investment returns. But income oriented, market neutral trading of options on the indexes. So that is the core position. Probably, I'm just going to think about the numbers and try to do quick math in my head. Probably 80% of the portfolio is in that style of trading. And then the rest is semi-directional, still has an income approach. Often, probably 90 to 95% of my trades are options, a combination of buying and selling, net short, net long, mostly short options, and then a little bit of futures trading for hedging and for opportunistic swing trades, and a little bit of just more recently in the last few months actually been diving deeper into the SMB equities programs. They have a program now called Trader 90 that's where they have all their tools combined, multiple meetings throughout the day talking about equity directional setups. So I've been getting into more of that since the income trading is going well, and want to diversify further. But with the income trading, that's oriented to selling market premium in the options market. You have the edge of time decay, which is the one component to options trading that kind of allows you to trade with the wind at your back. If you believe in trend following, you can believe in the trend following of premium decay, which is that it's a constant in the market, and then you just have to mitigate the other risks in that trading. And that's where I orient a lot of my trading to, and that is a probably a steeper learning curve to understand initially, but ultimately when you get through that little bit longer learning curve of how those different aspects work together, options trading is very much 3 and 4 dimensional rather than directional trading, which is 2 dimensional. You can always call it 3 dimensional. You have up, down, and then over time. With options trading, you have volatility and implied volatility considerations and different Greek measurements and things like that. But once you get through that learning curve, then options allows you to have a higher probability of success as you trade from day to day and month to month. So that is basically the style I'm in. I do sell a lot of weekly premium. That took a long time to master because it is a very volatile market. So I do not recommend you hop 2 feet first into the weekly options market without a lot of experience in trading, probably starting with monthlies. Prefer liquid instruments that I can manage actively, but making sure I get enough premium. So there's a lot of criteria involved in making sure you find the right opportunities in the weekly selling market. With individual stocks, I buy options because they are a little bit more erratic and can move faster and further than an index. So I like to buy weeklies on individual stocks based on the defined trend, pullbacks in the trend, consolidations within a trend, things like that. So that's kind of the mix that I have going on right now, but mostly that monthly contracts, index, options trading right now.
Okay, sure. So if you could, for those who might have no idea about the income aspect of options trading, how would you sort of just describe that and just explain that to someone?
It's good timing you asked me that, because just earlier today I was talking to Seth and then a gentleman, Mike Eisner at SMB. We had a conference call. We were discussing that exact topic because we want to bring some of our newer options programs that are really based on I'm going to call them simple strategies, and it's not because they have a lower probability of success or any other factor that makes them less attractive. They're just simple to understand. And we were just discussing on how do you describe this to somebody that doesn't know the options market. And the idea is there's the options market is an insurance market. If you look at the fundamentals of it, and I'll just describe it also by paralleling the futures market. The futures market is originally designed, and the purpose of it is for hedging. So if you own a bunch of stocks and you want to short-term lock in the price of those stocks, but you don't want to, say you have a basket of 100 stocks, and they're all different places, and let's say this is back in the old days when they were actually stock certificates, and it was a big to-do to go figure out how to sell all your stock because you thought the market was due for a correction, it was crashing, maybe it was up a lot, so you want to hedge. Whatever that circumstance is, the process of selling was so cumbersome that it was easier to go to the futures market and sell a few futures contracts and have a synthetic hedge. You synthetically reduced your exposure to directional conditions in the market. The options market comes a step further and uses a variety of contracts, calls and puts, that you can buy or sell, and then combinations of those. And it basically creates that same hedging opportunity. You can sell calls, which would limit your upside, but it says if the stock or index rises above this price at or before expiration, then I would have the obligation to dispose of this asset at that price to the person that bought the call from me. And then if you buy the put, or if you sell a put, if the market drops below the put contract at or before expiration, then you could be under the obligation to buy the stock or asset at that price from the person that bought the put from you. So, and then you can be on the other end, you can buy. So you'd have the right to execute that contract, but you wouldn't be obligated to do that. So once you get past, that's where the learning curve is. You have to get all of these contracts and long and short puts and calls, premium, buying premium versus selling premium. Once you get through all that, the simpler analogy is it's just like an insurance company. There's the insurer and then there's the insured. The insurance company is selling insurance premium. They are the ones taking on an outsized risk for something that is not necessarily likely to happen. And they do it in the right amount of size, and they do it in a diversified way that they have an edge and they have a good business model. And in fact, as the insurance buyer, you hope they do. You hope they have the capability to fulfill their obligations because you need to be protected in your specific circumstance. So maybe a trader, maybe a highly leveraged investor can own a lot of shares of certain companies that they feel strongly about fundamentally on the long side. However, earnings announcements are coming up, or there's just maybe they have a nice profits kind of run away from the mean in their favor, and they want to defend the position, but fundamentally they have no reason to sell it. So they can go to the options market and buy puts. And they can put a floor on how much risk they have. And that floor is not a stop loss. A stop loss, if it touches that price, you're out. It's done. Your stock is taken away from you. The position is closed, and if it immediately spikes back up in your direction, you're out of the position. You've lost it. So your way of defining risk is a limited opportunity, because if it touches that point any time while the trade is open, you're out of the stock. But if you buy a put, you can own the right to sell it at that price, but you don't have to sell it at that price until expiration. And at expiration, you can either exercise your right, or you can roll the contract, meaning you close that month because it's expiring and you go buy a put in a different month. And that's a way to defend your position without using a stop loss. And it's very common to do that because it adds a little more flexibility. Now, all the benefits of that, the other side of the coin is that happens at a premium. You have to pay a premium value. When you study, it's called extrinsic value. It's called options premium. In that, it's just like insurance premium. You have to pay for the right to be covered. And so you pay that extra value. So if you don't use it, that premium goes away. It goes to zero at expiration. So if you buy a 1 month put, it expires a month from now, and you pay $1 per share for that put for a $150 stock, you're going to lose 0.75% on that stock value to defend that position. But if it drops 20% overnight, you're going to lock in, you're going to minimize, and you're going to reduce your exposure. Say the put you bought was 5% below the stock price, and it opens up down 20%. You are capped. You do not lose more than 5% plus the cost of the put. So you would lose 5.75% instead of 20%. And that's the purpose of the options market. Now, if you go in and you are an options seller and you know how to combine various options positions and hedge those, you can actually bet in both directions of the market at the same time, and you have the middle of that position, which is premium decay in both directions, where you either own puts and sell more premium below it, or you can sell calls and sell puts. That increases your odds because usually an options buyer is going to buy in one direction or the other. But if you bought in both directions, you'd be over-insuring, statistically speaking. So you'd have too much premium paid. Well, if you go as a seller, you want to sell too much. You want to sell more than is probably going to be needed to insure those positions. And then you use other management techniques, management from day to day. You can look at your risk and make adjustments when things are changing, or if volatility gets to a certain level, you reduce your exposure. There's a lot of management techniques beyond that. And you can see that from there, it's entirely different. It's a completely different market than stock trading, where you just have a variety of setups that have a probability of either going up or going down. And then that's your directional exposure. It's a very 50-50. When you look over 1,000 trades and 1,000 traders, it's a 50-50 game. Whereas a trader with excellent experience and guidance and using a good system or good strategy is going to be better than 50%. An options trader can pretty much day one with a good system can become 60 or 70% profitable. And they can use management techniques that keep their risk reward very favorable as well. But you have to get through that learning curve of how the options market works. And without the proper learning curve, you have a lot going against you, because there is an outsized risk involved in the options market that the brokers, the market allows you to take amounts of risk that they would not allow you to take on a pure stock trade. So that's a risk that has to be understood and has to be studied very well, or else you could be walking into a lot of pain in the options market.
Okay, that's excellent, Andrew. Thanks for really expanding on that. That's excellent. So while options are, of course, your weapon of choice, the way in which you trade options, I believe, is fairly systematic. So if you could, describe to us, what extent is your approach systematic, and are there still any discretionary aspects to this?
I worked for a very long time to develop systems through a combination of underlying market statistics and signals for both the trend as well as mean reversion. And then I also did a lot of systematic study of option strategies, so different management techniques, selling different strikes with different times expiration, different frequency of management, different ways of looking at directional risk and hedging that from day to day. And my first experience with SMB was as a student, and I was actually taking a course. I'm going to call it a course, but at the time I took it was not a course. It was actually, I asked them, I called up and I talked to Steve Spencer, co-founder, and I said, is anybody there? Could they train me on developing trading algorithms? And he said, let me get back with you. So, and then he got back with me and said, we have an algorithm trader here. He develops systems, and he is developing systems and signals and indicators for the firm, and he would be willing to do a training. So I actually went up to SMB, and this is part of where my, that adding up to my, a little bit more expensive learning experience than most traders go through. But I think it was 10 days I actually spent there the first time on the desk working with Rick Martin, their algorithm and systems trader and trading developer. And that's where I started to learn a lot about the systematic approaches, very rule-based, combining a lot of the tools that you see. So if you see an indicator and you see a system, you can actually just take all of that information and combine it into one set of rules and automate a back test, automate a report that would tell you how well that would do and what the statistics behind it were. And there are some very excellent algorithms and systems out there. To me, there's a lot of systems that you can develop a back test that has extremely great results, high probabilities of the historic trades working out, excellent equity curves, low drawdowns, big run-ups, doing very well. But when you dig down and you either randomize the information or you move it into the forward market, a lot of those systems break down and don't work. So as far as high probability trading, to be able to develop a fully automated directional system, to me it's just not my psychology. I spent a lot of time working on that, and I got a lot of benefits from it that I'll talk about in a second. But just as far as the study of it and applying it, to answer your question, do I use discretion? Discretion is a huge part of my execution trading and my trading decisions. I use systems to guide what I look at I get signals and alerts on things that are worth trading for a variety of reasons, either pullbacks in the direction of the trend, liquidity, relative implied volatility, things like that, relative strength to the market, a lot of those things, general trendiness signals, consolidation signals on all instruments that I really like that work well and continue from back testing statistics all the way into taking those signals as a discretionary trade, seeing that the wind is really at my back. The trades get easier, the profits are more easy. I don't have to wonder about what's going to happen in the trade. I just know I have a good probability. I put the trade on. I have a reason to exit. I have a reason to take profit. And that's it. So on systems, I believe that studying systematic trading is very valuable. It's actually very valuable for an investor, somebody that's looking for much longer term holds using a systematic approach. Maybe it could even be a fundamental way of looking at the market and picking a portfolio. There's still a systematic way that Rick taught me, and then together, actually, a couple years later, we then developed a course together to kind of formalize that experience that I went through, which was kind of off the cuff, scheduled. He designed it. We got together and we had a 10-day one-on-one experience to study and learn all of this. And I got to absorb his decades of experience on Wall Street and in Chicago and absorb all that information, process it, stay in communication, develop a lot of systems, did a lot of correspondence and work together, phone calls, went back and visited. And then ultimately it came down to saying, let's formalize this, make it a more of a video series that's a little easier to intake, more affordable because it's recorded. So we put that together. And in that, we actually, in that course, we had a couple-minute period that we talked about what we call the 7 steps to system success, which is whether it's a discretionary, really you can use it to analyze your own discretionary trading is one thing you can do with it. So you're basically analyzing yourself as the system, or you can analyze an indicator. You can analyze a management technique, a filtering system. Say if a filter generates that this is a stock we're trading for the day, and you can just see what the ending result for that day would be on each of those. But whatever it came out to be, these 7 steps are very useful for kind of measuring any type of trading, any style of trading.
Yeah, okay. So those 7 steps which you just mentioned there, I've actually seen that video series and it was really well done. So would it be possible to ask you to briefly run through those 7 steps, just mentioning what each one is, along with just 1 or 2 real quick points?
Yes, got it. The first, there's the 7 steps, and we have them in a specific order. And one of the first things I like to mention is when looking at this, and you can do this for a lot of any type of education, when somebody's giving you a list or a bullet point or a summary, you can say, why isn't something in this? And in this circumstance, I always like to point out the fact that the one that we have listed last is last for a reason. And it's without fail. Any system I talk about, one of the most common questions at the very beginning is accuracy. It actually just today, we have the Options Tribe premium chat room. And the question came up today. We're talking about ratio straddles where I sell premium at a ratio. So I have a directional opinion, but I also have a market neutral opinion, premium decay, stop losses, automated management, things like that. They're saying the first question, we're kind of bringing up that conversation again. And one of the first questions that got popped in was, and I'll kind of leave some suspense. I won't even tell you, but it was this last point. It's the without fail. It's so common to see the first question be asked is what we feel is one of the least important things to be concerned with in trading. So there's your suspense. So I'll save it for the end. The first one is risk. That is absolutely the first and most important thing. The first is the one at the end, but one of the top ones that's often discussed is what's the return? How much did it make? How much did it make last year? What's the average annual return? How much did it make per week? That's often the first question is how much did it make? But we like to look at what is the risk? And there's multiple forms of risk. And the series is free. If you go to SMB training, or actually I think you can just Google it. If you just type in 7 steps to system success, it probably, or you can, you're going to link to it probably.
I'll put a link to it in the show notes.
There you go.
So if anyone wants a link, it'll just be at chatwithtraders.com/28. And the link will be just below the interview. So
yeah, that'll be good. You can go through that and see. But risk, we talk about total capital required to make the trade, average drawdown, average loss, cumulative drawdown, so that's a peak to trough measurement, looking at standard deviation of a loss. A lot of those types of measures, that's most important, because if you have two systems that both make 60% a year on average, and one has 5% drawdowns and the other one has 15% drawdowns. And I have actually a couple more examples where it even goes to the point of showing a system that made less but had a better ratio of drawdowns. When you apply leverage to that, or you randomize that information and you take the same statistics and you repeat it randomly through a program, it actually shows you that it's unreliable or it's less reliable. And when that happens, it means that's something you can't scale up. Nobody's trading because they want to make another $1,000 a month. Everybody that's ever gotten into trading, no matter how small they start, it's without fail. If you know how to do it, you're going to open up an Excel sheet and you're going to do some kind of compounding interest calculation to figure out how quickly you're going to be able to trade bigger so you can make more. And if you don't fully know and understand risk as a mathematical figure in your trading, all of those dreams of compound interest are going to turn into nightmares because you don't understand the big drawdown that's coming. And you have a couple of good weeks or a couple of good months, so then you ramp up your size, and you don't know when that risk that you could have defined by your strategy, that it was going to hit you down too far. So you shouldn't have ramped up so quickly. Should have ramped up a little slower, considering the risk that was probably coming. They do this at SMB on the options desk. They're doing very well. The market's been excellent for market neutral options trading. But the reality is, the flash crash is coming. 2008 is coming, and August 2011 is coming, and which are the harder times. And there's going to be a drawdown month. So they're always taking that into consideration on their trade size, not just ramping up the next month because last month was good. They know the pending risk. They know what's going to happen. And so that's how you pick your trade size and how big you're going to trade and what your expectation is. The second one is reward. You do have to have a positive belief and a positive mathematical and statistical outlook that you're going to have trading profits. So, and they need to be proven by looking back in time at what you've been doing, and they need to be proven in a simulated environment, and they need to be proven forward in the real world. And if you're not getting a reward, if there's not profits, you need to really, don't let psychology say, well, eventually it's going to start working, or I'm going to start tweaking things that I've never considered before and think that's going to make the difference. You have to have a positive expectation of profits. The third one is actually the term expectancy. So I kind of said expectation, but expectancy is an actual math formula that's used for your average win, your average loss times the number of each of those. And that comes down to an expectancy number. It's a very simple calculation that we could almost put this as, I can almost move this up to number one because it's such a valuable number, and there's so many other figures that systematic traders use as far as cumulative average returns, Sharpe ratio, standard deviation of returns, etc. Cumulative or expectancy is a simpler and very straightforward figure that also has the benefit where when you have a single trade on, while that trade is on, it's very, very difficult to think about the fact that this is 1 out of 1,000 trades. There's going to be 1,000 entries and exits that you're going to experience on a system or through some approach to the market. And when you look at each trade as if whether or not this one works out, or whether if 60% of the next 10 trades or 80% of the next 10 trades work, that has some kind of weight on the system. When the reality is it's over 1,000, you need to know that every time you pull the trigger, that you're not going to achieve a specific return that is your expectancy number, but you need to psychologically say, as long as I do this right, as long as I follow my rules, as long as I do what I'm supposed to do with this trade, I need to just know that I'm racking up my expectancy number. That every time I do it right, I just say, I earned $23 on this trade because that's my expectancy in this system. Whether or not you lost 10 or you made 60, it doesn't matter. You say my expectancy is $23 per trade, and that's the psychology you have behind using expectancy rather than how often you're right. The fourth one is volatility, which is not necessarily the volatility of the instrument you trade, but it's actually the volatility of returns. So it's basically, it's not simple math, but it is simply proven with math that if you have less volatility of returns, so fewer of your trades are outliers. Most of your profits aren't generated from one or two big wins, and you don't have these sudden larger losses than usual. When you can eliminate those, you have less outliers, you have a better probability of that system working for years and years to come. So looking at different ways of volatility of returns is something that we do. Which one am I on? 5. 5 is frequency. So that is partially psychology, also has to do with transaction costs, that a higher frequency system, especially as a retail trader, instantly has lower probabilities of success because your ratio of cost to expectancy goes up. So that is one of the things behind frequency. Also, your ability to execute, if you're taking the trades manually, goes down because on paper it looks wonderful. In the real world, you realize that sometimes you're sick, sometimes you go to the bathroom, sometimes the power goes out, and there's a lot of things where you can't mess with your statistics because of the fact that you aren't a machine. The 6th one is duration. So that's a kind of a psychology one that lets you know that some systems, trend-oriented systems specifically, are going to have a lot of losses put together. So they're going to have a lot of small losses with very short duration. So you're going to feel like you take a loss, you take a loss, you take a loss, you take a loss. And then you have a trade that starts to go in your favor. Psychologically, you say, I don't want this one to turn into a loss too, so I'm going to take it off. And that becomes the one that makes 10 times more than any of the losses had. Knowing that there are systems like that. I've seen systems with 30% accuracy or less that were fantastic systems because they had tiny little losses when they're wrong. So they just accumulated a few little losses, but they were great setups. They were the times when they could take that small amount of risk and they get wiggled out. They take the setup occurs again. They take a little risk. They get wiggled out. And then the setup occurs. They load up on the position and it goes in their favor and it goes big and it goes for a long time. So your losses may have been 2-3 hours and your wins can last 2 weeks and be enormous. So knowing that behind your system lets you know to allow those losses to just happen. Let them accumulate, let them happen over a short period of time. If the entire market is very stagnant, you may have a lot of stocks, a lot of positions, all experience the same thing at the same time. And right around the time you want to quit and pull the plug, 5 or 6 of those can run in your favor big on that system. So you just have to know what the duration expectancy is. And then the last one, which often is brought up as the most important thing, is the first question I often receive about a system or a strategy that is, I feel, could almost be removed from the list. But there is a purpose for it on the list, so that's why it's still there. And that one is accuracy. Asking how often or how many trades out of 10 or how many trades out of 100 are profitable is probably the most common first question, but it is the least important aspect of trading to know if something is going to be reliable and profitable in the future. The psychology of having to be right is what often brings that up. The psychology of wanting to win often is brought up. The training that we have in school that says if you get below 70, if you get less than 70% of the answers right, you are a failure. You have failed at this. And bringing that into the trading world is what keeps a lot of people from becoming profitable and having fun in this market. You have to be willing and understand that you may actually be wrong half the time, and that could lead to excellent results. You could have a 50% success rate and have outstanding results. Because if you're 50% accurate in a trend following approach to the market, so half of your trends run in your favor and half of them have small exits, you're going to be fantastically successful at trading. The reality is trend following is often 35 to 40% accurate. And that's why most people fall in love with the concept of trend following. But then when they try to execute it, they often get shaken out and move on to something else pretty quickly because they get that negative feedback from the market and see that they're accumulating losses. And instinct comes in and says, well, if I'm not getting the results I expected, it's probably wrong and I need to quit. But the reality is you just didn't have the right expectation of how that was going to work out. You probably were misled into being only shown great examples of when something worked, or being shown 2 things that didn't work and 5 things that did. And that sets you up for that expectation that if you do this, you're going to win more often than when you're wrong. And the reality is it's probably not that way. It's probably 7 losses and 3 wins, or 6 losses and 4 wins. That's probably how it is. And you may actually enter where you have 10 losses in a row, or 1 out of 10 works. And that's not enough data to consider something invalid. You have to look at more information than that. So those are the 7 steps in a very abbreviated way. The entire video series that you can opt in and get for free explores that over, I think it's either 7 business days or 7 calendar days that you get those. There's a video and kind of an article that goes with each one of those. So you go through that entire process, and even that is just a very brief snapshot of what Rick and I went into in the Systems Foundation course at SMB, where we really dive deep into all these metrics and ways of looking at different techniques and strategies and how you can measure them and know if they're going to work.
All right, awesome. No, that was really good, Andrew. Thanks for going into so much detail on that. And I'll put the link to that in the show notes at chatwithtraders.com/28. So if anyone's interested in learning more about systematic trading, then definitely check that out. I did, and I got a lot of value from it. So anyway, we should probably start to wind things down, but let me ask you just one more question.
Sure.
And I love to ask this question to a majority of the guests, and that is, what's the number one reason why the majority of traders lose money and never reach a high level of success, in your opinion?
Well, I'll have to just give an answer because I could probably think about this for days and come up with it, but or I might give a mixed answer. One is there's traders enter the market with a lot of confidence because they're either smart, so they may be more intelligent than a lot of their peers, family, or friends, and so they look at the trading market and say, okay, most people fail at this. However, I'm generally smarter. I have good head on my shoulders. When I try to understand something, I do well with it. And I'm also passionate about it. So they say, well, I have what it takes because most of my friends, they're just not even interested. So if they try, they'd probably fail. So I'm probably well suited for success because I have other success in my life. Or I've seen very successful businessmen and investors that in the markets that come to trading, and they get a negative feedback from the market, meaning they lose money. And they approach it the same way they would approach anything else in their life. If it's sports and you're losing, you just practice harder and you try harder and you learn more. And through sheer effort, you're going to be able to improve yourself and get better results. In business, you can work longer hours and you can cut your prices and you can make decisions that you control how you're going to fix it. And you get positive results from that in other areas of your life because you overcome what's going on and you make it work. And traders, those that are attracted to trading often have that mentality and characteristic. Then you come to the market and you have to learn very, very quickly that your willpower has no place in the markets. Your willpower to say, I am going to hang on to this trade until I'm right. I'm going to will this system to work. I'm going to will this trade to work. And you just say, I know I'm going to be right. And you take that approach to the market. The worst thing that can happen is that you get rewarded for that a few times. So you call the top in something that's high flying or up big for the day. You call the top and it drops right away. Say, oh, that's great. I should have taken a bigger size. Then it happens again and you do it again, a little bigger size. And, oh, that was great. And you don't even realize the whole market was consolidating. So every pop was faded. And then all of a sudden, the December rally comes and the market breaks out. You say, well, I've been conditioned. I know it works. I'm going to short this thing. And then it takes off. The whole market goes up 6%. Your stocks go up 11%. And the whole time you're just trying to will it. You're trying to study. You're trying to figure out why it should go down, why it's got to work out, why you're right. And through some willpower effort, it's going to work out for you. Where the mentality that works is to know when you're wrong and have a understanding that certain there's nobody that's going to be right 100% of the time. And as soon as you are wrong, as soon as you get to a point that is exceeded your expectation of what should happen, that you need to do something about it. And one reason I love options trading is I don't always have to close the position. In my psychology, that works great because I still get to kind of hang on to my idea. But in options trading, I can take other approaches for just kind of defending myself and bringing in a different trade to kind of enhance the position and not really close the original one. It's just kind of a psychological game I get to play that helps me, and it really works out better. But I think that's kind of it, is that they bring in success in other areas of their life. They try to apply it to the market, and the market doesn't play by the same rules. So I think I'm just going to pick that one. I think that's kind of one may not be a common one that's brought up.
Yeah, that's actually a really unique answer. I don't think anyone's given anything quite from that angle before, so I really like that answer. That's a good one. Now, Andrew, thanks so much for coming on. Now, I know there's quite a few listeners who I've spoken with who are keen to get into options or who might have already started on options. So would you be open to answering any questions that listeners might have in the comments about trading and more specifically around options?
Yeah, that'd be great. You can just let me know or figure out some way that I can be notified when they get posted, and I'd be happy to answer any questions.
For sure, yeah. So if anyone has any questions for Andrew, just go to chatwithtraders.com/28, scroll to the bottom of the page and just leave a comment there. And I'll let you know, Andrew, whenever there's any new questions there, and you can jump onto those.
Great.
Okay, and where can listeners go to find out more about you?
You can go a lot of places to find out about me, but most of my work right now is through SMB Capital and SMB Training, also known as SMBU. So the fastest way to type that in is probably smbu.com. You can also get me on Twitter. So I have a pretty unique first and last name combination. So if you were to Google, Twitter, Andrew Faldy, or just Andrew Faldy in general, you'll probably find me in a few different places. And I don't have any other distant relatives or anything with the same name at this point. So I'm pretty easy to find that way as well. So Twitter, Andrew Faldy, or I think it's Andrew F_SMB, but it's pretty hard to miss. But what's any other way? Andrew at andrewfaldy.com is email address. You can send that as well, so it'll come right to me. And then I can add you to my Google Plus, and you can get updates that way as well.
Okay, good one. Well, I'll make sure to put links to everything you just mentioned there in the show notes, including your Twitter handles. So, yeah, anyone who wants to find out more about you can just jump onto any of those links. And like I mentioned, I'll also put a link to the video series that you created about system trading. All right, Andrew. Well, thanks so much for coming on the show today and sharing plenty of valuable pointers with everyone listening. Have an awesome week, and let's stay in touch.
All right, you're welcome. Thanks a lot for having me.
Thanks, Andrew.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Chat with Traders, episode 70.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
This week, I'm stoked to say Technician is sponsoring the podcast, an award-winning technical analysis app and trading platform, which is designed to be as mobile as you. With Technician, you have all the features you could wish for in a premium charting package and more for free. Won't cost you a cent. Real-time data for US stocks and Forex markets, more than 85 indicators, drawing tools, plus you can even trade direct from the chart. Visit technicianapp.com now to try it out. Again, that's technicianapp.com to try it out. Okay, what's happening, team? I'm thrilled to have you tuned in for what is a really interesting episode ahead with Jeff Davis. Jeff is a day trader who specializes in the S&P futures, and he predominantly trades a mean reversion strategy which is built upon real data and statistical probabilities. Across his 20-year trading career, Jeff has also been heavily involved in the process of developing and deploying algorithmic strategies, but to a slightly lesser extent these days. In this interview, we talk about Jeff's prop days, the risks of being a one-man business, automated trading, specializing, statistics, and a whole lot more as well. From this conversation, I think you'll pick up on the underlying theme, which is really all about building confidence in your strategy and then being able to size up when you have edge. Lastly, Jeff has kindly offered to answer any trading questions that you might have, or if you'd like a little more depth around any of the topics that we hit on, all you got to do is go to chatwithtraders.com/70 and leave a question in the comments area at the bottom of the page. Very straightforward. I think you know the drill by now. Take advantage of that, guys. I really do encourage that. All right, so here we are. Please enjoy episode 70 with Jeff Davis. Hey, Jeff, what's going on? How are you?
Hi, Aaron. I'm fine today. Thank you for having me on. Nice to chat with you again.
Likewise. It's awesome to have you on. Thank you very much for doing this. I know it's Sunday evening where you are, so nice commitment from your side. But first of all, let's start right at the very beginning. I think we're going back probably close to 20 years now. How did you get started in trading? Tell us about what you were doing at the time and, what led you into financial markets.
Well, I took my path to trading wasn't what I would call conventional. I grew up in farm country about 2.5 hours north of New York City. But then after I graduated high school, I ended up moving down about an hour outside of the city. It was about when I was 30 years old. I was already married, had a mortgage, had a baby, another baby on the way. And so I had a lot of responsibilities, and I was working in the U.S. Postal Service. And I worked in a processing center. And the processing center, being in that environment, allowed me to have access to virtually every magazine and newspaper that came through the mail, to be able to see it and read it. So I was a voracious reader, and that's when I kind of discovered my interest in stock trading. And the internet kind of was coming around at the same time. So that kind of enabled where you didn't have to be in the city in order to be a stock trader. And everything just kind of, started to go from there. I never knew what I wanted to do or be in high school. So it didn't make sense for me to go to college. So I went into the post office. I had no finance or economics background of any type. And I just became attracted to the puzzle of picking stocks. And then when day trading came around, that really struck a chord with me. I liked the fact that I could possibly make a living from it while being my own boss. That really appealed to me. So I just kind of dove right in and proceeded to make every possible mistake one could make. But I wanted to get there, so I just kept at it.
Excellent. Okay, well, let's talk about some of those mistakes. So maybe walk us through your first 1 or 2 years when you decided that you were going to start trading.
Well, the first foray was just, small personal account, not day trading at all, wasn't really available, no leverage or anything in that, made a little bit and was able to save up. And then when, the prop firms started to come about with the LLCs and that, I was able to join one. And $25,000 account at that time minimum, and joined it. And used to get my quotes over the internet and have to call in my orders. So it was very interesting, and just, I'd read a lot, and like most people out there starting out, you just have all this enthusiasm and you read something and you think that's really going to be it and do it, and just turns out to not be that way. There's guys out there that have been doing it, and they're just going to, you're going to learn your lessons. And so I proceeded to learn my lessons. One of the big ones I learned right away was about risk, and it was because where I opened my account, the firm went under because a trader blew up the whole LLC. That was in 1999, Harbor Securities. So luckily for me, it wasn't that big of a monetary loss because I was fabulously good at that point at burning up my own account. So by the time somebody else actually blew up the firm, I didn't have too much left. I was well on my way to doing it on my own. So, but I did learn a lesson in risk from that. So
how does that work? How does a single trader blow up a whole prop firm?
That time, I guess the risk controls weren't that good, and everything was levered. There wasn't much money behind the firm, really. So I think he made a bet on Apple earnings, I believe it was, in a very big way. And when he was wrong, that was it. The whole pie went down.
Wow. Okay. Well, I don't imagine he was too popular.
No. Well, I don't think anybody was that, was related, in that firm, had that firm that started it. So then from there, I went, proceeded to just learn that lesson, saved up again. And from there, I went to Bright Trading. And I did a little more research and knew they had the financial wherewithal in that, and went to them and needed to get a Series 7. So I studied for 2 weeks, took the Series 7 test, passed that with a 91. Put 25,000 up with Bright and started heading to the city. Then I decided they didn't allow remote, which was very good for me at that point, and went down and got to sit on a desk and be surrounded by lots of different traders, lots of different strategies. And that was the start of like my prop trading career back then, mainly all because of leverage. You could get the leverage. So if you were going to make a daily or a monthly check, I didn't leave my job. I worked a night shift. So I actually worked overnight, left in the morning, pretty much went straight to the train station, slept on an 1.5-hour train ride, and got up and traded all day and slept on the train back and did that day after day. That's how bad I wanted to learn.
Okay, so when did you fit sleep in? Like, when did you get a decent sleep? I know you said you had an hour and a half in the morning, but when did you catch up?
Sometimes I didn't trade the whole day. I'd leave in the afternoons or something like that early to get in. But I could go. I was younger then. You could go a couple days without a lot of sleep. So you just did it. I had no other choice. That was the way. I had bills to pay. I couldn't just walk away yet, and that was it. No other options. Do it.
Okay, so before joining Bright, were you a profitable trader at the time, or did you learn to become profitable while you were at the firm?
More so at Bright, but more at Bright, I never really became super profitable. I was always more break even then, I would say. I didn't know I hadn't settled on a strategy yet. Just the market changed immensely. When I decided to go full time, it was in March of 2000, the top of the NASDAQ tech bubble in the markets. So I had a lot of strategies worked out, I imagine as most people did, and they all turned out to just be bull market strategies. And when the market started going down and that volatility really cranked up, nothing that I had thought I was going to be able to do was going to work. So it became really clear then I had to learn to adapt. And that was the big lesson that I learned there, is it was all about adapting at that point, just surviving. And they were changing rules at that time too in the markets. That's when we went from fractions to decimals. There was just all sorts of changes, in the market structure and that also. So I really learned that you can never just depend on anything to stay status quo for very long.
Okay, so how were you affected by the crash? Did you lose much money during that time, or were you okay?
No, because since I was new at Bright, they had some controls on me, which was a good thing. And then I managed to survive. I didn't really make money. I wasn't taking a check from there. I was still working. But I learned how not to lose money in that environment, where I learned how to short. I had no clue really how to short before, but in that market, you had to learn how to short. I really got a taste of volatility right away. Very interesting. Got exposed to a lot of different types of strategies in that also. When you went into Bright, the first thing you kind of were taught was to go in and you were going to tape read. And you were a tape reader and you were going to pick one stock and you were going to specialize in that stock, to the point where if you got good enough, you could tell when the specialist that was trading the stock on the stock exchange floor went to lunch, because you saw his little tricks. That was the whole thing. You knew all the rules of the specialist. You tried to trade. Your whole object was to try and trade on the side of the specialist, trade along with him, not against him.
Okay, and is that something that you picked up and actually adapted for yourself at that point in time?
Slow learner.
Okay.
Slow learner here. Didn't come right away, and started to get it. And most of my problems were mainly me, not really strategy wise or anything. I would tend to get over exuberant and trade too much, and lots of the beginning stuff in that. I would make money in the morning and then proceed to give back a good chunk of it in the afternoon, and just never did anything at that point to stop it right away.
Okay. So how long were you with the firm for until you went out on your own and began trading independently?
I was going down to Bright's offices daily until 9/11, 2001, when we couldn't get to the office anymore. It was right next to the trade centers.
Okay.
So then they had to allow us to trade remotely, and that was it. I traded remote with them for a while, and then ended up, there was lots more competition and that, and ended up moving on to, trading from home and just doing my own accounts and that. There was other ways of getting leverage.
Okay. And did you experience any challenges when you made that switch from going from trading within a prop firm where you're surrounded by traders to now being at home where it's just pretty much you?
Oh, yes. Yeah. Trading remotely was, lonely, hard, but great at the same time. You just, it takes getting used to. On the floor, though, in the office, you got exposure to different strategies, but never really did I experience where it's like this big team thing where everybody's sharing everything. I mean, when the market was open, guys were trading. They were worried about making their money, and that they weren't telling you. You could sit next to somebody, but he wasn't telling you what he was thinking every moment in that. He was focused. You know, guys wanted to make money. That's one thing I learned right away. The guys that had focus were the ones that made money. The guys that did the same thing every day, learned their strategy. The other guys came and went. The desk went from, 50 people down to 15 at one point. Saw so many people come and go. So you really learn that the markets change and you got to adapt with it. Saw guys that could make money for years that all of a sudden couldn't make a dime. Gone.
Interesting. Okay. So I'm not sure where this fits in on your timeline, but at some point you went from being a discretionary trader to actually quantifying your approach. When did that happen, and how did that happen, more importantly?
When did that happen? Years later. Mainly after I got Lyme disease. And I got Lyme disease and I got sick, and for a couple years was too medicated to be able to trade. And I realized then that being a one-man business was great, but there was downsides to it. And when I came back, one of my first goals was then to try to figure out a way where some things could be getting done if I wasn't able to physically trade all the time. And that was a big thing. That was a big realization that I think a lot of traders, a lot of your listeners that are starting out, they don't take into account. Things happen in life. Life happens, and you're a one-man business. If you can't make it to the keyboard, or you're highly medicated for something, you're not going to perform the same. You're not going to make money most likely. And you have to take that into account. So when everything is good and you feel you have edge in that, you have to really make sure you push it and you make money. You can't be just fiddling along for a long period of time because you don't know when life is going to happen. Hopefully for most people, nothing like that will happen.
Yeah, I think that's a really valid point that you brought up there. And this is something you mentioned to me when we last spoke, which I thought was awesome, is that, when you're trading, in most cases, you're a one-man band. And if something happens to you, then, you're out of business pretty much. So, no, I really like that point. So what was the first step you took towards actually being able to quantify your strategy? Like, how did that begin to happen? Like, how did you set those wheels in motion?
Well, the first thing was I developed a tool. It was supposed to be a tool, and it was tape reading stocks. And I ended up getting that programmed with somebody that I was working with that I was mentoring, and he was a programmer. So we exchanged my mentoring for his programming and ended up, coming up with a really good product, really cool, really different. And we just continued working on that and ended up at some point, I just saw it and said, wow, this can be built into a strategy. And that's when I went down that road of really, learning about and trying to build a system. Now, I tried to, I always had dabbled in it a little bit. Back in 2005, when I was trading, one of the days of the year that I used to look forward to was the Russell rebalance. And starting out on the Russell rebalance, I had identified certain types of stocks that tended to have big closing moves. There were big moves on the close with the MOCs on the Russell rebalance in stocks. So I had identified that. So for a couple of years, I was trading them discretionarily and did very well on those days. So then I wanted to take that to where I could really, not miss any opportunities. So I actually, my brother was a programmer. I had him program a program for me that would narrow everything down for me, filter it, because the filtering systems back in that day weren't that good. I gave him all the parameters I wanted. They were custom. And then it spit out the stocks, and in the last 4 minutes you were buying or selling, and you were, it was a 4-minute trade. That's it. You were out on the close. And so that was my first foray into, at that time nobody had the word algorithm. It wasn't in use. There was no algorithmic trading or anything. But that trade kind of all went away when computers came to everybody. Russell imbalances now are not that big of a deal anymore. They were, there was a lot of edge in them, and now the edge has pretty much been arbed out. So that was my first foray. Then developed the tape reading tool. That went back to my bright roots, just what's a strong stock, what's a weak stock. And, that algorithm pretty much is reading a whole bunch of different stocks. And then it takes all those metrics that, it's determining buying and selling strength across the whole range of stocks. And then that spits out some metrics. And then a second algorithm then would take those metrics and allow us to take those levels and turn them into some sort of a trading system. We could back test and we could, test strategies and we could optimize, and that's still working to this day. And still the work on that is still going on as we speak.
Cool. Okay, well, let's break that down a little further. So just going back to the tool that you started out developing, was that a tool just for personal use, or was that available publicly?
No, it wasn't available publicly. It was going to be available publicly, and that lasted for about 3 days. And then I decided, no, it's going to be a trading strategy, and pulled everything right back. And then it's, there was probably out on the web, there's some screenshots and that of it from way back in the beginning on some accounts I had in Twitter or something, but it's changed so much since then. So not really too worried about that. But that was, it was mainly designed as I was mentoring people to be able to say to them, why are you taking this trade? You're trying to short the strongest stock, or you're trying to buy the weakest stock, or, that's kind of what it was, to make things very visual for people. I always found the more visual stuff you can make in trading, the easier people can pick up on it most of the time.
Yeah, no doubt. Now, one of the things I find really interesting about you, Jeff, is that you're essentially an algorithmic trader, yet you don't know how to program yourself. Did this come with any challenges, by having to rely on someone else to do the programming for you?
I imagine it would for most people, but I was very lucky and blessed, either way you want to put it, in finding guys that could program that were also traders. So a lot of the language implementation in that most people I hear talk about when you're trying to have a non-trader program for you, they just don't understand. I never really went through that. So with me, it was just finding people that I trusted and that were hard workers, because we put in a lot of hours. And yes, I don't program, but I learned a lot about programming and back testing and that. I spent countless hours, going through stuff and that. So just not easy, but can be done. And once again, the internet makes it possible. And my initial idea when I was able to show it with people, I didn't have to do much selling. They wanted in. So that made it a little bit easier too. What I had come up with was different and interesting, and they just they decided to, they wanted to come on board. They came on board, and we worked. We put a lot of time in.
Okay, so if you had your time over again, would you have made a conscious decision to learn how to program right when you were starting to go down this path, or would you have done it much the same as you have?
I would have done it in high school when it was Fortran and that and COBOL, back when I was in high school, if I knew we was going down this road. But no, I don't really, I don't know. I think I got to where I am because of, my pattern recognition with my mind, seeing stuff in that. And I don't know if me being a programmer was going to help that. It probably would have taken away from my screen time. And screen time is so important. So to me, I had the screen time and kind of had these patterns and that in my mind, and it was just getting somebody to help me build them out. And we did that, and, got a really nice product out of it. And just going forward, it's still, it's good. I don't regret not programming. I don't, at this age now where I am, early 50s, I don't even want to think about it. That's the truth of the matter.
Okay. So I guess for some younger guys who might be listening who, are trading by hand at this stage, but may be interested in getting into algorithmic trading, would you suggest teaming up with a programmer who has trading knowledge versus learning how to program for themselves?
Without a doubt. I just think any way that you can go where you can get some part of your strategy automated or more mechanical is going to help you in these markets. These markets, you're trading against algorithms left and right. The bulk of the trading is that. So any help you get in that, if you're in your early 20s, definitely learned something. I would, I'm saying me 30 years later, 30 years advanced from that, it's a different story. But somebody in their 20s, no, learn. And if you can't wait, then find somebody that can program, work with them, get your ideas going. Just, avoid the rabbit holes.
Well, that was going to be my next question, is how did you avoid the rabbit holes? Because I know when you start going down this path, obviously firsthand, as many listeners will know already that this is something I've been pursuing. How do you avoid the rabbit holes? Because it's very easy to get stuck and go off on random tangents. How did you stay very focused while you were getting to a point where you could automate your strategy?
Didn't avoid all the rabbit holes, be honest. Got better at avoiding rabbit holes because you realized where they sapped you and how much programming time went to nowhere in that, and you were just going to end up scrapping it, or, you never scrapped it like, oh, we'll put it on the shelf, maybe we can use it later, but you kind of knew in the back of your mind you weren't going to get there most likely, but you just didn't want to say that you wasted a lot of time. So you get better at it with experience. My one partner, that was, Chris Hargarten's his name. He was very good at determining rabbit holes and, not going down them. He had done lots of programming work and running teams of programmers and at Microsoft for years. So he was instrumental in me coming to that effect a lot. And I always wanted to just be day trading. So, kind of knowing exactly what we were looking for kept us out of the rabbit holes. If you're searching for edge, you're probably going to run into some rabbit holes. And it's just, if stuff, you have to know when to throw in the towel a little bit on an idea if it isn't panning out. Otherwise you're most likely going to curve fit. You're going to go down a whole bad path when it comes to, trying to back test a strategy and that and make a strategy that's going to work. You have to really understand, what the foundation of your strategy is, where your edge is, and how it's going to, how that's going to play out in the real markets, not just in some back testing. I mean, nobody has ever seen a back test that looked bad, do you? Nobody ever comes to you and says, hey, look at my back test that lost money. It's like, because everybody can sit there and they'll take out the bad stuff and only leave in the good stuff. And here's your back test. But in reality, that's not going to work going forward at all. There's virtually no chance of working.
Yeah, and I think that's really key. What you said there is that you've got to have a pretty good idea on what you're actually looking for before you go into this. So, no, I like that.
That's where the screen time, Aaron, that's where screen time and that comes in, and really understanding, just do your homework on systems. I mean, they just have to listen to your other podcasts. There's plenty of guys, I've listened to most of them, that, talk about it, like trend following, the big rage for the last 25 years and that. Well, you're going to do a trend following strategy. You're probably only going to have a win rate of 30 to 40%. Are you going to stick with that strategy when the 60 and 70% is, you're in that drawdown period? Most people don't. You just have to understand what your strategy is and how you're going to make money out of it, how you're going to consistently, and then you have to understand how often it's going to trade. How are you going to get to size in that? So there's a lot that goes into it. You're not just going to pop something out of the box. I mean, there's a lot of sites out there now that, tell you they'll help you be an algo trader, and it's like kind of out of the can stuff. I don't think anything out of the can is really going to work that easy for anybody, truthfully. It's my opinion. I'm not expert, but I would say if it's generally available to the public as general knowledge, there's probably not much edge in it. If you're going to make money from it, it's because of you. Seriously, that's, what it comes down to is trading. My whole path to trading only got better when I took myself out of the equation, when I finally stopped hurting myself, always acted in my best interest. It's everybody starting out there thinking it's a strategy. I need this, I need another pattern, I need another trade. No, you don't. You need to make sure that your psychological effect on your trades is not what's causing the problems. That has to be right. And then when you design a strategy, the strategy that you're going to employ better fit your personality, your trading personality. I like day trading. I like coming to the screens during the day. I'm not an action junkie, but I enjoy coming to the screen during the day. I would not do good trading a system that only traded once a week or 3 times a month. Would not suit me. I trade way less now than I did before, but the market's changed. I just feel that's the most prudent thing to do. And I've focused and narrowed strategies down. Everything is getting towards a mature simplicity, I like to call it. Just, as a Ron Meyer, a basketball coach, Bruce Lee has quotes out there about, simplify. It's not what you add, it's what you take away. That's where I think all traders need to try to get to. And it's not by doing more, it's by doing less, and what you do less of, do better. And in the trading world, do it bigger. Find something where you can get to size on it, especially if you're a one-man business. If you don't have other streams of income coming in that, why mess around with something? You're in a risk business. You can't go into a risk business to just make what people do in a salary job. You need to go into a risk business and make more. And that comes with being able to get size on, have confidence, and know your edge, and then be able to size up. And, that's what's kind of led me to where I am today. Some parts are automated. I have tools that I've designed, that I use, that I trust. And then I may be the guy now that pushes the button, but it's all only pushing the button at spots that have really shown edge to me, through my work, through the hard hours, long hours of work I put in to, understand this is where I want to trade.
Brilliant answer, Jeff. I really like that. Now, just before we get into more of the specifics about how you are trading now, because I know it's slightly different from how you have been trading in some ways. Just before we get to that, what did the team project lead to? Like the programmers you were working with, how are you still involved with them? Where do they fit into the picture today?
It is getting ready to start trading. It's been trading for a hedge fund. And that's it. The strategy, the algorithm is being used, and they're developing strategies off of it at the hedge fund. I no longer have the day-to-day in it. It just 5 years of kind of not doing my style of trading. Just, I got burned out a little bit. I spent a lot of hours, be at the market during the day and then all night long, and that I got burned out. And so what was developed, they're using, and they're building onto it. I'm in touch with them, but I don't have day-to-day anymore. They're more, they've taken it to another quant level, but it's trading actively for a hedge fund. And it's been looked at by, quite a few other firms. They're raising money around it. And it's trading in the S&P futures, which I started out as a stock trader. So just that alone has, where I came to really specialize in it. Where I started, I ended up being back to, and just specializing in the one product. And, I started at Bright. You picked one stock, you traded every day. Well, now for me, it's the S&P futures, and that's what the algorithm is trading also, the S&P futures.
All right, Jeff, well, let's dig into more about how you are trading now. So you said you've gone back to specializing, and I know a very big part of that for you is actually building your strategy around statistical probabilities. Can you just maybe give us a little more insight to how you are trading today?
Okay, as I stated, I'm trading S&P futures. Everything is designed around mean reversion strategy. The reason I settle on mean reversion is I like to be active. There's more chances at mean reversion in the one product. Index products are really not trending products. They do trend, everything trends, but they don't trend the majority of the time. Your S&P, trend days in the S&P happen on average over the last 10 years, anywhere between 10 and 15% of trading days are what people could label as some sort of a trend day. Open near lows, close on highs, open near highs, close on lows, something like that. I mean, everybody's different definition may be a little different with range, but most days are range days. And in a range day, there's certain things that happen in a range day that tend to happen time and time again. And that's where I focus everything that I do. Everything is pretty much with range in mind.
Okay, so a big part of that for you is actually knowing the statistics within those ranges. Like if something happens, then there's a X% chance that this is going to happen. How have you actually built your strategy around that, and how do you get those statistics? Because, I mean, I personally feel as though there is such a great edge in knowing your numbers to that extent. Like once you have them, you can then begin to actually build your strategy around those statistics. So I guess what I'm asking here is, how do you actually get those statistics?
Believe it or not, a lot of them are available out there on the internet, but the average trader just doesn't look at them as they have any sort of use. When I'm looking for statistics, I'll read something, I'll see something, and then I go and maybe back test it out for myself, see if it's true. You know, other things, there's just numbers out there from real reputable people, and you can find them. They're there. You have to know what you're looking for. I use, when I say, high probability statistics, let's take, for instance, I'm looking at a certain amount of range is done in the morning. I've built a range prediction algorithm also. And a certain amount of range is done in this certain time period in the morning. And that will tell me that, 80% of the days, we're only going to do this much range that day. So now if we start to near that level, that's where I would then tend to come in and fade. If everything looks copacetic on the buying and selling levels, if it's not, if news hasn't come into the market, news can always change anything. So without news coming into the market, those probabilities hold up. I'll use spikes. When we just went through this past period in January and February, we were getting spikes of, 26 handles in less than an hour, sometimes 30 and 35 minutes. I have the data. I know what over the last 15 years, when you get that kind of a spike, what the odds are for some reversion on it and what, that reversion could be. And that's where I build the trades off of. So you're waiting for those to set up. And then I steal, I forget, somebody had a quote about that, stealing good ideas. Well, I steal from all sorts of different disciplines. I'm not a fib trader. I don't really believe in pivot points. I don't ascribe to any of that. But every one of those has probabilities of certain points in those domains being hit. Let's say the pivot for the pivot point traders. Well, the pivot is traded on 70% of all days. So, depending where we open, where we close, that can, come into there. Everybody kind of knows yesterday's high and yesterday's low. Well, yesterday's high and yesterday's low over time has been traded at 88% of the time. One of them is hit. That's the kind of thing. So I put those big high probability targets along with my range stuff. And that's what gives me where I'll get my entries. And I use a lot of stuff with VWAP now. So many traders are looking at VWAP and they're using VWAP to enter trades. Well, VWAP is the target on most of my trades. When we get away from VWAP in one direction or the other, that's where I get interested. Because I get interested in this algorithmic environment that we're in, your HFTs, which are now your specialists, are not trend traders. They're mean reversion. Everything they do is causes mean reversion to come in more often than not. So VWAP is more often than not, instead of trending away from VWAP, it's always reverting back to VWAP. So I use levels like that. Certain levels I come up to proprietarily with my back testing. And that's it. I track range. You don't read a lot about range out there. And I always thought one of the reasons why is because a lot of people that are using range, it's working for them and they don't want it to go away. So you don't read a lot of stuff about range. And so I got into range way back reading Jeff Cooper, Tony Crable, Linda Bradford Ratchke, and that. And it's stuck with me ever since. It's consistent. It's always expanding and contracting. Those are the regimes I look at. And there's different trades, different setups in those regimes. And, when you're developing a strategy or any kind of trading system, whether it be discretionary or anything, nothing is going to work in every regime. It's good. Every system most likely is going to have a period of time where it really makes money, a period of time where it treads water, and probably a drawdown period of time. That's it. I like to know where we are in all those different things, and I can then adjust, how I trade, how often I trade, and that all to the regime, or whether or not I trade at all. And that's it. And I didn't go down the rabbit hole looking for turns. I just listened to your podcast with Dr. Steenbarger, and he was talking about learn from your losses. Well, I know we're getting close to turns when one part of my strategy starts to take on losses. I know we're going to the next regime, most likely. Why? Because I was just going through a period of really, having big time performance, and now it's sputtering a little bit. Guess what? Regime is most likely changing. Do I try to find something? I went down that rabbit hole. To pick the turns is the holy grail. Don't try to pick the turns in the regimes. Just let your trades go out. And when you're you're at the time frames where probability is that the regime could be running out, maybe you lower your size or something, but you don't just try to, go against it. I don't try to predict in that way. That's it. And everything for me now, remember, everything is on a day trading time frame also, but these regimes still play in. When you're in high volatility, most people try to, talk about it as a volatility regime. I never settled on that because of all the hedging that goes on, because the VIX and everything just has days where it just isn't going with the market because of the hedging. Hedges being put on, hedges being taken off, and it has that decoupling. So I just use, everything I do is off of average true range. What is the market moving? How much is it moved? How far will it likely go? And there we go. So I do everything off of that. And I track everything off of, a certain ATR and percentage-wise. Keep apples to apples and everything. I can tell you right now, 40% of the ATR, 14-day ATR is done on 94% of the days. If I'm going to do most mean reversion trades without some other good reason to do it, I need to see 40% done, because 95 out of 100 days, you're going to do more than that. So why am I trying to fade something before that unless there's some other big level or something comes in? That's the way everything is put together with that. I know, there's just like the spikes. I'll give you one. A 22 handle spike in less than an hour has a 70% chance approximately of reverting approximately 5 handles. Does that happen in low volatility? No, they don't happen. In high volatility, you can get 5 of them in a day. So you have to know what part of your system in what regime is going to be active and where you're going to be trading it. That's it. And everything I do is, off a range, and I got my algo running, which shows me it's tape reading, all these stocks in the S&P 500, and that's giving me buying and selling levels where I have a look that nobody else has. I don't use any of the technical indicators out there. It's pretty much built my own indicator that I'm looking at for buying and selling levels. And if they match up, sometimes they just make me hold up a little bit. Then it's just design your system to where you can execute it. That's where lots of people fail. They try to design a system that is going to look good on paper or they think is going to play out, but they can't stick with it. Everybody's goal, they think I'm a day trader. I'm going to trade with these very tight stops, and I'm going to have 4 to 1 risk reward on my wins in that. You're trying to design an automated system. That's probably not going to work out too well for you. You're just going to get stopped so many times. You're going to have periods where you get stopped, and then what are you going to do? You're going to fiddle in it, and you're going to change it. And what are you going to change it to? To what's just happened recently, most likely. Recency bias is just so huge among, newer traders. The older traders were boring. We're bored. We just execute. We come in the same day and every day, and we do the same thing over and over. That's what we look to do. We don't care about excitement. We're not chasing, I like to call it, on social media, Twitter and that stock flavor of the day. We're looking at our strategy. That's it. And we're executing it regardlessly. You just execute relentlessly. Sets up. It's never just one trade. It's the whole series of trades that's going to play out. That's it. You execute. And that's how you get good at the execution. That's how you get good with your psychology to be able to stay in the trade. How many times have you had to stop and let's say you take a 3-point stop. The price of the product you're trading now moves to 2 points against you. It's 1 point from the stop, and you're sitting there and you're feeling like, oh, this isn't feeling good. It's not looking good. What the heck? Let me just take it here rather than letting it hit the 3-point stop. I'll save the point. Boom, you exit, and what's it immediately do? Goes right back in your favor and goes on to what would have made money. That's bad enough. But what most of us would do, I did it in the past, now you get a revenge trade because now I was right and I'm out of it. Now you chase in and you're in at a worse spot than you were in previously. And now you try to trade that with the 3-point stop and you're off sides and you're stopped out. And that's where, until you know your personality and you are convinced you're not going to do the stuff that's going to hurt your account. And it's just, that's what patience is. Patience is just saying, I can take this pain. I mean, I was just looking today and I read a quote that I had from Jeff Cooper, who I don't know if a lot of people know who he is. He's been around a long time. He's got books out there. And at Jeff Cooper Live, I believe, is his Twitter handle for anybody you want to look him up in that. And I was reading this today, and it says, trading is more about knowing when not to trade than it is about trading. Trading is timing. Waiting is painful. Pain brings wisdom. Wisdom brings balance. Trading can be excruciatingly exciting when done wrong and tauntingly tedious when done right. And that's the truth. When you're doing it right, it's boring, and it's not all this excitement and jumping from one thing to the next. It's finding something, getting in it, and coming in here day after day and executing it. And that takes a little time. You're going to have to get some screen time. You have to think outside the box maybe a little bit, and you have to throw away what the crowd is doing. There's so many trading wisdoms now that don't apply on the shorter time frames that may still be applicable for the long time frames, but in my opinion, on the shorter time frames, they just don't even apply anymore. And, that's just trading. Trading is always changing. And all these kind of wisdoms, like, the trend is your friend. I know good trend traders in that on the day trading time frame in an index product, it trends like 15% of the time. If you're going to aspire to the trend as your friend and try to always trade that on the trend, you're not going to get very far. You're going to be the hamster on the wheel, most likely. You have to know your product. You have to know the regimes. You have to know when the probability of trending is higher rather than lower. And that's the truth of the matter. None of those old trading wisdoms you can just take point blank and think that's going to, be your holy grail for trading, your path to profitability. It's not going to be. You have to know what fits for you. And that's the one thing, like with the guys I work with, always harping on them. It has to fit your personality. You have to understand your system so you can stick with it. You have to know where it's likely to draw down. You have to know what regime it's going to make money in. That's when you can maybe do size, just those are the things. It's so much with psychological, I can't stress that enough, and I go back to tape reading all the time, and, in my strategies, it starts from tape reading, and you don't really read the tape anymore with these level 2s and that, with the algorithms, the HFT, that's kind of gone. But it's just, to me, tape reading is knowing your strategy and just sticking to it and executing it all the time. That's it. In the old days, there was a book written 1920s or something on tape reading. And one of the things he said in it was, averaging does not come within the province of the tape reader. Averaging is groping for the top or bottom. So when I go into a trade, I'm in. That's it. That's part of my strategy. Maybe other people can find scaling in that. I'm on a day trade time frame. Time is against me. I have to go in with my size and do it. And you have to have confidence to do that. That's the truth of the matter. You just have to know, you have to see it, know it, and then execute it. And that's to me, that all comes from us first. Just, knowing yourself and knowing where you're supposed to push the button to get into that trade and not letting anything else take you into it. I mean, just this past week came within ticks of a spot I wanted to get in, but in the type of tape we're in the regime we're in, I've learned I have to wait. It has to get to my level for me to trade. Gets within 2 ticks, turns, and goes all the way the other way. I'm not in the trade. I can't get upset. I don't chase. Nope, it didn't get to where I needed to be. That's the thing. This month in March, I was just looking at my numbers before. In March, only traded of the, I think it was approximately 20 trading days in March, only traded 13 of them. And I'm a day trader. But sometimes we had really tight days here, no movement really, nothing sets up. Don't push the button. Come back the next day.
Hope you're digging the interview. We're just going to take a quick breather here. We still have a lot of ground to cover. Again, this week we have Technician on board sponsoring the podcast. A little bit about Technician. It's a free charting/trading platform that can be easily accessed using their web app or mobile app. So Technician essentially goes wherever you go. Once you're on the Technician platform, you'll notice the charts and interface has been extremely well designed to be modern, clear, and uncluttered, so you can remain focused with minimal distraction. In regards to the charts, you can plot over 80 indicators, you can draw all over them, and you have a bunch of chart type options too. As an added bonus, Technician provides you with real-time prices for US equities and Forex markets. For others, the data is either slightly delayed or end of day. Plus, you can practice with the built-in demo trading functionality, and if you decide to connect a compatible brokerage account to Technician, then you can even trade right from the chart. Just to add on this, I've actually heard from a few traders now who have started using the Technician app since hearing about it right here on the podcast, and they're loving it. So chances are you will also. For all the finer details, go to technicianapp.com and get set up. Just create a login and you're away. The all-new Technician is free. So one thing to remember here, guys, technicianapp.com. All right, let's get back to the interview. That was really interesting to hear about how, out of, 20 trading days, you've only traded 13 days and you're a day trader. I think that was really awesome that you could share that with listeners. It's a great point.
One of the analogies I'm always giving to my guys that I work with is this. Picture a pool, in-ground pool filled with sharks. Well, that's what you're jumping into to get your money. I want to jump into there when there's the most money at the bottom. In-ground pools, the water's generally pretty clear. You can see, I can see what's there. I want to jump in when it's worth going in there for. I don't want to jump in and take a chance on getting bit when there isn't that much going for. And that's the one thing through the years, that's where the mature simplicity comes in. It just, everything is the maturity of a trader is going to be to where less is more, less is more. And the sooner guys start to pick on that and pick that up and just stick with that, the better off they are on their trading paths, that less is more. And I don't want to be jumping in that pool all the time with all the sharks now. And over trading, in my experience, I've had access to lots of different prop firms. I know the guys at SMB, and that over trading is the downfall of most of your failing traders. And over trading comes from not being confident in what you're doing, your psychological trading, your mental capital is just depleted, and you're just operating on tilt. You're jumping from strategy to strategy. Somewhere you have to draw the line and say, listen, this is what suits me. I need to be active, but how can I be active in a prudent way? Or I have a slower personality. I can sit and wait and only trade twice a week. Look for a strategy that's going to set up with. That's the main thing. Understand so that you can always execute it. That's the problem. Too many times. How many times have traders sat there, they've identified a level, price gets to that level, and they do nothing? Because at that point now they say, oh, well, what about this or what about that? That's where the probabilities come in. That's where I don't struggle with. It hits my level, I know what my probabilities are, and I'm going in the trade. That's it. My risk is taken care of. I know what I'm risking. The trade is structured. I do the same thing on every single trade. There's virtually no difference in the trades, the steps that happen once I get into a trade. Do I have any control over the trade once a minute? I can't control anything. That's it. All I can control is how much I lose. That's it. How much I make or how much I lose. I don't have any sway on whether that's going to happen. And that's what I focus on.
Yeah. So, I mean, the reason why you're so, how do I say this? Why you can trade with such confidence and be so clear on your probabilities is because you specialize in trading one product, and that's the SPY. I mean, I think that's kind of rare amongst most traders, is that they actually just specialize in trading a single product. I mean, is that something that you would suggest other traders who are coming up today perhaps consider? Because it's very difficult. I mean, we had this discussion a couple of weeks back when we were talking, is that it's very hard to be crystal clear on your probabilities and know your statistics when you're trading a whole basket of stocks or basket of futures markets or whatever it may be. What would you say to other traders who are trading a whole range of different stocks? What should they consider? Like, should they think about maybe specializing in a single product?
Yes. In one word, yes. I will say, do I demand or do I think you have to narrow it to one product? Maybe not. I choose to do that. I like the futures now. I trade that. You know, the leverage is there. It's just a good product. You don't have slippage on your stops. That fits me very well. And I can get stats going back. You know, the stuff holds up. That's the market, the S&P. I don't have to worry about anything else. I'm trading the market. I don't have to worry about, you know, sectors and stuff like that. But I would think that it's fine to specialize in some niche, when I was at Bright Trading, there were guys that traded opening orders only. That's what they specialized in. You know, there were guys that traded, back then you had the AOL Time Warner merger, and there were guys that were just scalping against the spread on the ARB of the takeover. And that's what they did every day for however long. That thing took like over a year to close or something like that. Came in every day and just scalped against, that spread. And they specialized in that. There was other guys that specialized in trading only the high-priced stocks. You have to specialize. When I was going to Bright, I rode in a train car. And in the last car on the train, tell you about traders, how much they take. These were all pro traders. Want to know how much they cared about risk? They sat in the last car on the train. I used to joke with them, why are you guys all back here? Some of them had been riding the train a lot longer than me going to the city. You know what they said? Have you ever seen a derailment? If there's any cars left on the track, it's the last ones when the train runs off the track. They were taking care of the risk on their train ride to work. They didn't sit in the front car. They were in the back car in case the train derailed. I mean, they specialized. I saw these guys. I met execution block traders. The car was filled with like the specialist clerks from SLK, the clearing firm that Spear leads Kellogg. And that I used to see the runs from the specialist post at the end of the day. These guys said the thing you learned that was obvious right away was low volume stocks. The specialist never lost money. Only chance he had of losing money was in his high volume stock, where news could come in and the whole market could go one way and he had to be the guy taking the other side of it. I saw there were NYMEX traders on there. These were the locals in the commodity pits in New York. And that, their whole game was on specializing. You talk to them, they didn't say, I trade this, I trade that, I trade that. They traded, one guy was a spread trader. He traded spreads. Another guy traded the crack spread in just oil, and time and time again, when I looked, the guys that were making real money and real livings, somehow specialized in either an area or a type of product, but they did not try to be a jack of all trades. They were a master in one trade. And to me, I choose to do just one product because with the statistical probabilities I do, it's just, that's where they are. I can know my product intimately. And so I can get to that confidence place sooner to get to bigger size. And to me, that's what matters. It's all about, if you're trading and your strategy isn't allowing you to be able to raise your size and get to size, then what's the sense? Why? Because everything's changing. It's not going to last forever, whatever your edge is. You have to, when you have the edge, you got to be able to start to push the pedal. And, most guys, when their focus is spread wide, I don't see them get there. That's just the truth of the matter. That's what I've seen. The best traders I see, they focus, they know, they specialize. It may not be one product, but it's one niche, one type of trade, one pattern, however you're going to break it down, but they are good at it. They don't trade, guys that trade high dollar stocks don't trade single digit midget stocks. That's just the way it is for the most part. You trade what you're comfortable in, where you get that confidence, and you get that confidence by specializing. Would you go, to your doctor for, heart surgery? That's your GP, that's your general practitioner? No. Well, in trading, it's the same thing. You need to specialize in some way. I mean, I've heard other guests of yours say it. Morad, I know Morad. I've had conversations with him, Future Trader 71. Specialized. Dr. Steenberger, I've had conversations with him and email conversations and that for the last couple of years, and that his whole thing has come around focus on what you do best, where you can do it. Nobody that I know is talking about trying to trade this wide spectrum of things. It's figure out what fits your personality in the product and then dive in and put your focus there. That's just what I see. That's what I believe.
Okay. No, that's really good. That's really, really good. Now, one of the things I'd just like to pick up on there is you've emphasized this a couple times throughout our conversation here is you've got to get, when the time's right, you've got to be able to put size on it. Can you elaborate on what you mean by this a little more? Do you mean like taking much higher risk than you normally would? Like, it sounds like you're really ramping up how much you're risking on each trade when you're talking about you've got to get size on it. Can you just walk us through that a little bit?
Okay. Strategy I'm currently trading. We'll just start right with that. It gets developed. I start trading it. I'm trading it at one size, kind of feeling it out, because no matter what you do, when you're developing a strategy, you're in a certain mindset and you think you're going to cover everything that's going to come up, but you don't. So you go in and you start to trade it, and now the regime changes and you say, oh, I thought I had all the rules covered for that regime, but then maybe you haven't been in that regime for 6 months. Now you're into this new regime and you say, oh, I forgot about that. So I always allow for that. So it's going to take me a little time I like to see the strategy trade in, the regimes that I have labeled. It's expansion and contraction. There's two different flows of the market in those regimes to me, and the rules vary slightly in those different regimes. Once I've traded both regimes in it and everything is panning out, then the whole goal of the thing is to start to raise the size. Now, I use a fixed stop amount pretty much all the time. Now, it's not fixed by an exact, let's say, in the S&P futures. In a certain regime, it may be 6 points, it could be 8 points a week later where I'm risking. The reason is I'm using what I've settled on to tell me what to risk is, and I track the 1 minute average bar change in the S&P futures. And then I know my stop I want to be approximately 3 times that or more in order to have a decent stop. I need to be outside of that range. I need to be outside of the noise. So I track that 1 minute range all the time, the average of it as we go through the day. And my stop can actually change during the day. For the most part, that stop is always goes against what everything I thought when I first started trading. I thought as a day trader, I would be trying to design a system where I would have the 3-point stop to make 6 points. No, that's not where I ended up. All my work has led me to taking me a place where I will have the 6-point stop with a first scale at 3 points and a second scale maybe at 7 to 9 points someplace or further. But the wider stop. Why the wider stop? Because it allows me to get on the size. When I am comfortable, I tell the guys I work with all the time, so many people set a stop and they say that's what they're willing to risk to lose. But in actuality, when they're sitting at the screen, they're not. They're not. So my stop is set wide to protect me from myself. Since I'm sitting here and I'm watching the action, I have it at 6 to 8 points. Let's say I enter on a short. Price runs through me. 3 points. If I had a 4-point stop, Aaron, I'm getting into that zone where now I'm starting to think I'm wrong. They just ran right through me, right? I got in, I didn't get profitable for even a minute. You know, I thought I had a good level. They came right through me, 3 points. There's my stop sitting at 4. The urge is very strong then to come in and say, just take it off here and save yourself the point, because it is real money in that. By me having it at 6 and sitting there and saying, I know that the 6 doesn't get hit that often. I know the percent, I know my percent of the time that I take the full stop. That's what I call my full stop. It's almost like a catastrophic, but it's in there. When I know that percentage, I can sit there. They run 3 points through me now. I'm not tempted to fiddle on anything. That's it. Now, the process may change. Now my target, my initial first scale may come back. It may come back to break even. They went 3 points by me. Everything is I'm looking for a 6-point reversion. Well, you know, my expected value now in this trade just diminished. And I'm, you know, so you have to understand that it just diminished. I'm looking for a 6-point mean reversion. They ran 3 points through my entry. So now my stats are all saying I can get 3 points into money. We start to drift back towards break even. I may decide to reduce half my risk right then and keep on the other half looking for that 3-point reversion. And now also it makes it more comfortable. If I'm wrong, they're going to go back. And even if they get the 6-point stop, it's really only a 3 now, because I cut my risk in half. And that's the whole thing. I don't want to fiddle. When you're building any sort of strategy, you have to figure out ways that you can trade it and execute it without the urge to fiddle in it. That's the truth of the matter. So like me, I very rarely will say they ran through me and now they're coming back towards my entry point. Most of the time, I'll just execute half. I'll have the guys I work with saying to me, why aren't you taking off the whole thing? Listen, I got the trade in. There's still opportunity here. I don't want to fiddle that much. I'm going to leave on the half. My risk is cut in half. What am I worried about? If I truly had accepted taking the loss on full size at the 6 points, why am I worried about taking the loss on the 3 points? It's all just psychologically being content and understanding I can take that risk. So I designed a strategy, whereas now I can size up. I can just start doing more contracts each time. Get comfortable with that number at that 6-point stop. That's my worst case scenario. Once if I'm truly comfortable with that and I'm comfortable with the strategy, it start to raise the size. Why? This edge could go away in a year and a half. It's about pushing that size up to make more in those same trades. But you have to build a comfort level with your strategy under live conditions before you can start to do that. But once you start to get that comfort level, you have to go. And that's the thing. And the main part of it is being comfortable with your stop. And for me in day trading, any system you employ where you employ stops, the returns are going to come down as soon as you put stops in. You have to put stops most likely, you know, unless you're sitting there and you can always execute. But I like to have a stop in. My stop, I consider it, it's 6 to 8 points in these markets most of the time in the futures. My first scale on the profit side will come out at 3 or 4. That's where I take it off. That now allows me to sit with that second piece in that normal bouncing back and forth. I don't get antsy at all. That's it. My stop is now moved. I got a first piece in my pocket. That's money in my pocket. Now I determine my risk on that second half to how much money they can take away, or do I get to keep all that money in my pocket? It just makes it very simple, very easy to stick with. The whole strategy is just designed where your mental capital stays in play and your capital in your trading account grows. And that's, what it is. Like the numbers for March, they're not astounding, but my average, let me just pull it up. Every trade I trade in 2 scales. I mean, if you read my blogs on medium.com, you can see I talk about scales. I trade in 2 scales. I'll just put that right out there. And my losses, overall, all the losses are averaging just a little over 1 point in the futures. Meanwhile, each trade is averaging almost 4.5. My first scale is only getting me about 2.5 points on average, because it depends on what the volatility is. If price is having a hard time moving, I'm getting that first scale off to relieve the pressure on my mental side. That's all it is, to not fidget. I have some money in my pocket and I can let the second part go. I don't have to worry about it. I can let that play out, because slow moving markets, everything takes longer. I got a fast personality. I had to design a way where when I don't get that instant gratification, I could sit with the trade. That's what most day traders are like. We like that instant gratification. You get into a trade, you want to see it starting to work. How many times have you gotten into a trade, it doesn't work right away, and then you're looking to take it off? Just because you're bored, it isn't doing what you wanted it to do, and that's it. So I had to combat all that in the strategy. The second scale is averaging almost 7 points with a 2-to-1 win rate. That's what mean reversion can get you. You trade on the trend side of the ledger, it's going to be a little different. Win rate's not going to be as high. You have to figure that out on your own. Me, I like a higher win rate. A higher win rate where the mean reversion comes in. I can find that higher win rate. I am day trading. I have a stop. And it just allows me to be able to keep my personality in check, trade my personality, be active, and put on size. I hope that makes sense to you.
Absolutely. No, I mean, guys listening, if that didn't make sense, I would suggest actually rewinding a little bit and listening back through that twice, because that was really interesting, Jeff. I appreciate you really going into good detail on that and sharing that with us. Very insightful. Well, we should probably wind these things down now. We've been going for just over an hour, so I've really appreciated having you on, Jeff. It's been good. Where can listeners go to find out more about you?
Well, I'm on Twitter at Shack48 Trading. I mean, you could pretty much just Google Shack48 Trading. I've been writing blogs for years. I don't always keep up with it and that. Lately, I wrote some on Medium in the past couple months. I had other ones I used to write for SMB Capital. I wrote for Minionville for a little while. But I get in a phase where I want to write something, and then I kind of fall out of it a little bit. And so you can find me there. My email is readily available out there, shack48@gmail. If anybody wants to contact me, it's fairly easy. I mean, on Twitter, you can just reach out to me if you want to send me a direct message, and I don't follow because I don't follow a lot of people. I haven't been as active on social media because of the focus. I've always followed a lot of smart people that are talking more macro stuff in that, but I've really cut that down a lot. I don't want to even have anything come in. I just day trade, stick to that, and only what matters to that. And I've really cut down a lot on my social media interaction. A lot. I used to post a lot more. I don't do it as much, but I'm available to anybody. If somebody'd like to come in during the day, I run a call, hit me up. I'll let you join in for a day or two. You can take a listen. You can see, live what I do. I think you'll find some really interesting stuff. It's the S&P futures that I'm trading now. And you'll just, it's pretty interesting, I'll say. But I'm easy, I'm accessible, I'm out there to help people. I don't mind helping, but I love helping guys, Aaron. Let me just say this. I love helping the guy that's been kicking around for a couple years and they haven't figured out how to really make the money. They're not losing money, but they can't find that way to flip the switch. Those are the guys that I really I delve into. I love helping those guys. You know why? They've showed the persistence. I don't really like at this stage in my trading career, if I write something for the newer guys, if I, I'll do something like this for the newer guys, that's fine. But my one-on-one time and my stuff like that, I really like a guy that has shown he's not giving up right away at the first little, storm that comes along. Because I've come across so many guys in my career where, they all tell you, oh, this is my passion, this and that. The first little storm comes along and they're gone. They're out, I like the guys that have been kicking around, and I love working with businessmen because they understand that this is a business. Guys transitioning out of business and that, because I put a lot of stuff in those terms. That's the difference. This is not a hobby. This is not a place to come to markets to get your action junkie side out. This is a business. You got to run it like a business, especially if you're a one-person business, and you have to have a goal of really making something of it because there's nobody else to back you up if something happens with you. So you have to take it serious and you have to have that focus and do it. So those are the type of guys, any of them out there like that, hit me up. I'd love to talk to you. And as you can tell, I'm not shy when it comes to talking.
Nailed it, Jeff. Absolutely brilliant answer to take us out. Thank you very much. One thing I was just going to add in there is maybe, guys, if you have any questions for Jeff, just leave a comment in the show notes at the bottom of this page. I take it you'd be cool answering any questions that come through, Jeff?
Yes, no problem, Aaron.
Awesome. Okay, guys, so just go to chatwithtraders.com, scroll to the bottom of the page. First, go to chatwithtraders.com and find this episode. I'm not sure what episode number it'll be just yet, but scroll to the bottom of the show notes page and leave your question in the comments area at the bottom, and both Jeff and I will be monitoring that. So, if you've got any questions, that's the place to leave them.
Can I just say one more thing, Aaron?
Go for it.
I think what you're doing is fantastic for the trading community. I listened to most of your podcasts that you've done. I tried to get through and listen to all of them. I've actually discovered some new guys that I follow on Twitter a little bit and that, but I think there's lots of good information out there for, you're really providing a good service to the trading community, and I just got to commend you on that. And I look forward to all the podcasts that you put out.
Well, thank you very much. I appreciate that. It means a lot coming from yourself, Jeff. So good stuff. All right, guys, let's close this out here. And once again, Jeff, thanks a lot for coming on.
Thank you for having me, Aaron.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
set up in China, data governance regulations, that make it really challenging to use customers' data for things it wasn't already designed for, that you didn't already get consent for.
Which we learned from Cambridge Analytica scandal just as one case, and there are many others. That is not the case in the US. It's not the case in Europe. There's a lot going on. I mean, the EU's AI Act is pretty widely praised by some people, not everybody, but it's quite broad and far-reaching. But that's not the case in China, in terms of what you're saying.
So China's setup is now more similar to the GDPR that exists in Europe. So around kind of protecting consumer data and giving people the right to opt in to different uses. Of course, in China, there's always the exception, unless the security services think that you might be a dissident, and then they're going to get whatever they want on you. But in terms of kind of companies, they're certainly relatively restricted in what they can do.
Switching gears a little bit, Dan, sluggish economic growth recently weighs into the government's calculus and how they're thinking about AI's potential to spark social unrest.
I think that the Communist Party is very much involved in trying to think about, how to control possible social unrest. I was in Shanghai in November 2022 when there were protests in the streets denouncing zero COVID, denouncing the Communist Party by name, that these were things that were erupting. And so I very much sign on to Helen's description of AI, that China is leading in the AI of censorship. It is leading in the AI of facial recognition. That right now it looks very much like the US is a place where ordinary consumers can tinker with and play around on a lot of these AI tools, whereas in China is mostly reserving these very powerful tools for its own use, potentially to control society. That right now, China is in a moment of economic weakness. This might deteriorate further, this might get a little bit better, but there is always this presence hovering over there that the state security might ramp up its technology, really to make sure that there are no socially destabilizing incidents.
Well, Helen, Dan, thank you so much for being here. It's been great to learn from the both of you.
Thanks so much.
Thank you very much.
This is Horizons Middle East and Africa. Our top stories this morning.
Cooling U.S. inflation spurs a global equity rally. However, Treasury yields climb back up as doubts persist about the quality of the data. The Bank of Japan ends the central bank's bonanza this week with a hike that leaves rates at a 30-year high. The 10-year yield hits a 2006 high while the yen weakens. And TikTok signs deals to create a U.S. joint venture, majority owned by American investors, including Oracle, Silver Lake, and MGX. It's quite a busy Friday for you, but it is good morning to you. It's just gone past 9 a.m. across the Emirates, 7 a.m. here in Johannesburg. I'm Jennifer Zabasaja in for Jumana Bersechi, and we are closing out the week with a central bank bonanza. It's been quite a busy past 72 hours. Of course, we just mentioned the Bank of Japan wrapping up what has been a busy 72 hours for central banks, but then also for economic data releases, as we were just mentioning there. And that softer than expected delayed CPI print that we got from the U.S. really still digesting for investors, and some of the questions still looming about what exactly, how much weight to put on some of the data that we did get. Let's take a look at U.S. equity futures trading marginally higher right now. Notably, though, we should point out that S&P E-minis are in the green after ending a 4-day losing streak. We had talked about some of the concern around tech valuations in the AI trade earlier in the week, but we did actually see the S&P closing in the green on Thursday. Micron also helping to bolster some of that sentiment with its best day since April, closing up more than 10%. We also have the U.S. 10-year yield right there, about a basis point there. Notable because after we did get that CPI print on Thursday, we did see yields pulling back ever so slightly. So we're watching closely where that goes. Right now, the U.S. 10-year yield at 4.1412 there. Dollar yen also, of course, in focus. The yen extending losses against the dollar after we did get that BOJ decision earlier today. We still are awaiting Governor Ueda's press conference later on today, but right now it's notable to just see where we are at right now at 156. Right there, of course, extending some of the declines that we've been seeing for the yen. And really quickly, let's just bring you Brent crude, headed for a second weekly loss despite some of the tensions earlier this week between the U.S. and Venezuela. Brent crude down now just over 0.1% there to trade below $60 a barrel there. And we've actually seen Brent slipping more than 2% this week. Let's just zoom in, though, quickly on that delayed CPI report that we got out of the U.S. One analyst describing it as one of a kind. And despite some very suspicious holes that we did get, notably in shelter costs, there was enough that we did get in this report for the doves to shift yields lower, as we mentioned. But still, the question is, now that we have seen a bit of retracement in the Asian session, clearly there are some doubts about the quality of the data, especially given that this was coming at a time during the shutdown in the U.S. Now, let's just stick on this story. Underlying U.S. inflation rose in November at the slowest annual pace since early 2021. Meanwhile, the core consumer price index grew 2.6% last month from a year ago. But the report, which has been described as, quote, Swiss cheese by some analysts, comes with some credibility issues. That's due to the lengthy U.S. government shutdown, which limited officials' ability to collect data. Joining us is Anita Krishnagupta, CIO at WealthBricks Capital Partners. Anita, thanks so much for joining us. We just mentioned some of the descriptions that we are getting for this data print there. But, you know, some people are noting that potentially this print does signal some genuine easing of price pressures. I wonder what, if anything, it signals for you.
Good morning, Jennifer. Absolutely right. You can describe it as Swiss cheese, but the trend is downwards for inflation, whether it's driven by shelter rent and, of course, oil prices coming down. So the trend from a 3% coming down to a headline 2.7 and a core 2.6. Now, whether the 2.6 or 2.7, it's still a downward trend. And I think that's what's very important for the Fed to continue cutting rates. While the dot plot shows one cut, more analysts, and we're also in the camp of 2 cuts. And if we get a dovish Fed governor in May to replace Chair Powell, I think that's definitely going to happen.
So, Anita, when we look forward, what's your sense of the economic, the state of the state of the economy in the U.S. Moving into 2026? Are you confident maybe that it is in fact on a path to stability?
Actually, yes, we do think it's on a path to stability. So in 2025, tariffs was the word of the year, no longer. I think in 2026, we are actually going to be focused on productivity, on growth. Consumer remains very important. We have had the Fed raise their expected GDP growth numbers for 2026. Now, if we're getting GDP growth in the US at above 2%, that is a pretty good clip. What we are also seeing is any kind of an infrastructure buildup in the US. We are seeing defense spending. We are seeing, other consumer indicators are still strong. We're also talking about, money coming into accounts in the US. Now, that's still a possibility. But every way that we look at it, the US is stable. Of course, there are always, black swans that, could emerge. But it's looking pretty positive with all the data that we have seen recently, inflation ticking down, growth coming up, and of course, the big boost from AI spend and productivity, which is off and on, but seems to be more on the upside.
Right. Anita, I do want to talk about AI in a minute, but I do want to move to the BOJ, our other top story, because you went overweight in Japan in October. Given what we did see from the BOJ earlier today, do you stand by that move? Do you reposition? Are you waiting to hear from Governor Ueda?
No, absolutely. We went overweight. We are going to stay overweight. There's a lot of positives for Japan at this point, and the weaker yen actually is playing very favorably for exporters. So we've had the short-term, hike at 0.75% overnight. In spite of that, the yen actually hasn't strengthened. You've got the 10-year JGB finally at about 2%. You've got inflation, which is a little, still high at around 3%. So real rates are, still, something to worry about in Japan. But all these are pointing towards, Prime Minister Takaichi's, the fiscal stimulus, the boost to industry, and that's going to continue. And Japan remains an industrial nation, and we think that the equity markets there are going to continue to perform well. It's a leader in robotics. It's a leader in some of the automobiles, the hybrids. And the weak yen, again, I reiterate, is positive for Japan industry.
Let's stay on that, because we talk about a weak yen, we talk potentially about a weaker USD. What does that mean for your positioning for risk assets moving into 2026?
So we have a fairly clear view at this point. We would never be out of the US in technology. US remains a growth story for us. At the same point, we do have a weaker US dollar. And when we're looking at growth, it's coming from India, it's coming from the UAE. So some of these emerging market economies have very high growth numbers, whether it's India at an expected about 6.7% for the next fiscal year. The last number was 8.2 for the last quarter. You've got the UAE at over 4.5 to 5% economic growth. So there's a lot outside the US, and the weaker dollar, though the UAE, of course, the currency is pegged to the dollar, but India is not. So the INR has been weak. So it's a mix for us in terms of equities. We would say be diversified. These are our three top, allocations: the US, India, and the UAE. And within fixed income, we like emerging market local currency debt. So that's where the weaker dollar comes into play, because EM currencies this year, EM local currency debt is about 15%. That's been a call for us. We also like steepeners in the US. So these are our favorite plays going into 2026.
Great to get your insights this morning. Anita Krishnagupta, WealthBricks Capital Partners CIO, joining us there in Dubai. Anita, thank you so much for joining us. Now, let's move on to tech. We're watching Chinese stocks related to TikTok after the company signed deals to create a U.S. joint venture majority owned by American investors. An internal memo from CEO Shou Chu tells employees that agreements have been made with Oracle, Silver Lake, and MGX. Let's bring in Bloomberg's Edwin Chan from Hong Kong. Edwin, thanks so much for being with us. So this is a Bloomberg scoop. Give us some more insight into some of the details that we know about this memo.
As you just mentioned, it kind of laid out the key details, much of which actually we already knew about. That Oracle, Silver Lake, and MGX were the main drivers of a new joint venture in which U.S. investors will essentially take 50% stake. ByteDance will retain 20%, or actually 19.9% below the threshold as required by law, and then existing ByteDance backers, some of which include U.S. entities, will take the other remaining stake. And I think we knew the broad contours of this deal. What Shou Chu's memo actually did not go into was how the Chinese side views this framework. And I think since September, when the U.S. president mentioned that he had secured a deal and that China looked favorably upon it, it's interesting that Beijing has still not publicly voiced its opinions on the matter.
Do we know yet, Edwin, what this means for ByteDance? Because this had been an issue and a discussion for quite some time. Where does this potentially leave the company in their oversight of TikTok?
So ByteDance will not be operating the data or the algorithm. According to Bloomberg's previous reporting, what's going to happen is they're going to license the algorithm. This is assuming Beijing is on the same page as the U.S. Negotiators. What's going to happen is ByteDance will license the algorithm to this joint venture, which would then adopt it and retrain it and operate it going forward, including any data that's generated from it, which would be stored in country in the U.S. In terms of ByteDance, they retain a stake. I think we've reported that they will retain also a sizable share of the profit contribution. They will get a large proportion of the profits going forward from this joint venture. It's also important to note that TikTok Global, i.e. ByteDance's international division, continues doing, we think, some of the more attractive businesses such as e-commerce and live streaming and live shopping. TikTok Shop, for instance, remains very much under ByteDance's purview. So it's not like they're completely relinquishing the U.S. market.
Interesting. It's a fascinating story and very massive in the tech world, of course. Edwin Chan in Hong Kong for us, bringing us that scoop. Edwin, thanks so much for your reporting. Now, for a look at some of the other stories we are following today, starting off in Dubai. Dubai police have urged workers and residents to stay home this morning after heavy rain and thunderstorms lashed the UAE. Roads and highways across the city are flooded, and a safety advisory has been issued for motorists and pedestrians. The unstable weather has caused some flight cancellations and delays ahead of one of the busiest travel days for Dubai International Airport. President Trump has given federal workers 2 additional days off this year, closing the federal government on Christmas Eve and December 26th. The holiday order is effective for this year, excusing employees from duty for 3 consecutive days unless agency heads determine they need to work. The New York Stock Exchange, though, issued a statement on its website noting stock market hours will remain unchanged on December 24th and December 26th. And U.S. police say a man suspected of last weekend's shooting at Brown University has been found dead at a storage facility in New Hampshire after taking his own life. Earlier, authorities identified the 48-year-old former Brown student as a person of interest in both the university killings and the later murder of an MIT professor in the Boston area. Saturday's attack at the Ivy League school in the state of Rhode Island killed 2 people and wounded 9. Now, coming up, we turn back to central banks. The Bank of England governor warns the pace of interest rate reductions will slow as the central bank approaches the end point of its cutting cycle. We hear from Andrew Bailey next. This is Bloomberg.
up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. The Bank of Japan has raised its benchmark interest rate to its highest level since 1995. Governor Kazuo Ueda and his board hiked to 0.7%, 75, sorry, the 0.3% that will hiked after its two-day meeting, sending yields higher. Joining me now is Bloomberg's Paul Jackson for a deeper dive into this. So, Paul, give us a sense of how markets are reacting to this.
Well, this decision, like you mentioned, it's not quite back to the 1980s, but it's certainly back to the 1990s. This is the highest interest rate since the 90s, 30 years since it's been this high. And we've seen the yen weaken a tad after the decision. And we've also seen benchmark yields rise above 2%. And they haven't really been at that level regularly since the late 1990s. Now, I think at this point we've had the decision out, not much commentary around it. This is a heavily telegraphed decision. All our surveyed economists expected this rate hike. So the yen hasn't moved that much from where it was before. So you could say that for the Bank of Japan, round one has gone okay. But we've got round two to come. That's the press conference of the governor this afternoon. And really what the kind of view he gives about the trajectory of rates going forward is going to be key to how the market responds subsequently.
Right. And Paul, what is the expectation for what Governor Ueda might telegraph, if anything?
Well, I think the message he must convey is that interest rates will continue to rise as long as the outlook is realized for the Bank of Japan. Now, we have two board members saying that the outlook is a lot more robust than the bank overall is thinking. In fact, we've got one board member saying they've already reached a level of inflation in line with the price target. So that would suggest that the trajectory for interest rates is upward. And I think markets will be wanting to get a feel for, is this going to be something every 6 months? Or is it going to be slower or perhaps even faster than that? And I think that Ueda must get through this press conference keeping the idea that interest rates could be as fast as once every 6 months or faster.
Well, we'll wait for that press conference, as we know you will too. Bloomberg's Paul Jackson joining us. Paul, thanks so much for walking us through that. And let's just stick on the central bank bonanza. The Bank of England has lowered rates to a 3-year low in a narrow vote. While the rate cut was widely expected, the dose of caution was not, and that sent gilts tumbling. Governor Andrew Bailey told us room for further moves next year is limited, and the central bank will face closer calls on its decisions.
Well, I've been very encouraged by the progress that we've made on inflation. I've been saying for some time that it's going to, we had this, what we called hump up this year. I thought it was going to come down, and it has. And the good news is it's actually coming down a bit faster than I think we thought it would. I'm particularly pleased because there's been an easing of food price inflation, which is really very important. I mean, all inflation is important, but we know that food is salient. It's very salient, and of course it hits those on lower incomes a lot as well. I think now that we're on a path where we'll probably be around this level for a few months, but we think that come the spring, April, May time, we should see another quite sharp drop and take us, I hope, to around target. So we're going to come back to target sooner than we thought. So that's encouraging. All of this is very encouraging. And for me, certainly, it was a strong basis to cut today. It's the sixth cut we've made. Now, looking forwards, I do think we'll continue to have something of a gradual downward path. We'll have to judge the evidence, as you know, at every meeting. We'll come back for the meeting at the end of January, early February, and do that. The calls do get closer, but because as we come down, we will approach a level which is going to sort of, in a sense, maintain inflation. It's not going to be too hot or too cold, if you like to borrow that phraseology. It's very hard to know exactly where that level is, but we will approach it. We're approaching that level. We must be approaching that level in a sense mathematically. So the calls will become closer, and I would expect the pace of cuts therefore to ease off at some point. But I'm not going to judge exactly when that is because it's too uncertain at the moment.
And that was Bank of England Governor Andrew Bailey speaking there. Now, the European Central Bank has left interest rates unchanged for a fourth straight meeting as inflation hovers around target and the euro area weathers global shocks. ECB President Christine Lagarde says policymakers will act one meeting at a time based on incoming data.
We reconfirmed that we are in a good place, which does not mean that we are static. There was a unanimous decision that was taken today concerning the rates that we decided to hold, but there was also a unanimous view that all optionalities should remain on the table.
And coming up, oil heads for its biggest annual drop since the pandemic as tankers sit idle with nowhere to offload their crude. We'll bring you that story next. This is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Angola has secured $753 million in financing to speed up development of the Lobito rail corridor, ending months of delays tied to talks over government guarantees. The U.S. International Development Finance Corporation and the Development Bank of Southern Africa are providing the funds to upgrade about 1,300 kilometers of railway linking the mineral terminal at the port of Lobito to Luau on the border with the Democratic Republic of Congo. Liberia has approved a major rail agreement that clears the way for U.S.-backed Ivanhoe Atlantic to develop an iron ore mine in neighboring Guinea. Lawmakers ratified the deal, giving the company access to a key railway that links the Guinean deposit to Liberia's port of Buchanan. Ivanhoe Atlantic plans to start building the mine in 2026 and begin shipments the following year. And Ghana's unemployment rate rose to 13% in the third quarter, up from 12.6%, creating a new challenge for President John Mahama. Youth unemployment climbed sharply to 34.4%. The increase comes despite signs of economic improvement, including slower inflation, a stronger cedi, and solid growth. And those were just a few snippets of the stories we'll be covering in our monthly show, Next Africa. That airs tonight. Catch the full episode on your terminal, our website, and on TV. Plenty more coming up. This is Bloomberg.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question. I mean,
I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
This is Horizons Middle East and Africa, our top stories this morning. Cooling U.S. inflation spurs a global equity rally. However, Treasury yields climb back up as doubts persist about the quality of the data. The Bank of Japan ends the central bank's bonanza this week with a hike that leaves rates at a 30-year high. The 10-year yield hits a 2006 high while the yen weakens. And EU leaders agreed to loan Ukraine $106 billion for the next 2 years to keep the war-torn country afloat, pivoting from a plan to use frozen Russian assets. It's just gone past 9:30 a.m. across the Emirates, 7:30 a.m. here in Johannesburg. I'm Jennifer Zapasaja in for Jumana Bersechi. Happy Friday to you. It has been quite a week of central bank activity and, of course, economic data activity, sort of culminating with that CPI print that we did get in the U.S. yesterday, which some analysts are describing as Swiss cheese, and some actually saying take it with the entire bottle of salt. So we'll get into that in just a minute. Let's just take a look at where U.S. equity futures are right now, looking like unchanged, as you can see there on the board. Though what's been notable is that we did see the S&P index and most of the U.S. indices actually on Thursday, ending their 4-day losing streak. Of course, we mentioned some of the concern around tech valuations and the AI trade earlier this week, potentially getting a bit of support from Micron having an upbeat forecast and actually having its best day since April on Thursday, closing up more than 10%. So we have seen a bit of positivity for U.S. equity futures to start the day on this Friday. We'll watch where it goes right now, a bit unchanged right now. The U.S. 10-year yield also in focus, up about 1 basis point there. We had mentioned some of the initial moves after we did get that delayed CPI print on Thursday. We saw yields actually pulling back, but now we have seen some of that retracement happening. The U.S. 10-year yield at about 413.92 there. The dollar yen also in focus. The yen weakening and slipping against the dollar after the BOJ raised its benchmark interest rate as concerns really swirl about the future of the BOJ's path of rate hikes. And as we spoke to our reporter earlier, we are waiting for Governor Ueda's press conference in just a few hours to get some more insight into potentially what the messaging is that he gives us. And really quickly, Brent crude headed for its second weekly loss despite some of the tensions that we did see between Venezuela and the U.S. earlier this week. Brent has slipped more than 2% this week, down below $60 a barrel there to trade just down about 0.2%. And really quickly, let's just zoom in on that delayed CPI report out of the U.S. As I mentioned, one analyst describing it as one of a kind. And despite some of the suspicious holes that we did see in it, notably in shelter costs, we did see enough of a move for doves to shift yields lower, as we did notice. And still, the question is, especially as we do see some of that retracement in the Asian session, how much doubt is there about the quality of the data that we did get in November, that we did get on Thursday for that November print? Now, let's turn to the African continent, and specifically here in South Africa. To South Africa's inflation, it eased more than expected in November, lifting hopes the central bank could cut interest rates as soon as next month. Consumer prices rose 3.5% from a year earlier, down slightly from October, and closer to the Reserve Bank's new 3% target. Joining us is Jeffrey Schultz, head of CEMEA Economics at BNP Paribas Markets 360. Jeffrey, thanks so much for being with us there from London. Let's just start here on the print that we did get. Were you surprised by this print, especially if we consider some of the inflation target readjustments that we have seen in this country? What is your assessment of some of the details in this November print?
Good morning, Jennifer. Good to be on the show. So yes, I mean, I think the headline number did surprise a little bit to the downside, coming in at 3.5%. I think most of that downside surprise, though, came from the more volatile components, non-core components like food. But outside of food, I think the print itself actually was not surprising at all to us. So core inflation picked up a nudge, but still this is sitting at 3.2%, very close to the central bank's new 3% point target. But underlying pressures in this economy have remained very weak and very benign, and we expect that to continue through to 2026. So, our forecast for next year is quite well below the consensus. We have an average of about 3.2% again for inflation, which is in 2026, which is very similar to the performance that we've seen this year. So what didn't surprise us about the release was the fact that underlying or core inflation pressures remain extremely benign, and that's a combination of factors that are driving that. So I think on balance, this was a very encouraging and should be a very encouraging report for the South African Reserve Bank.
Did it confirm any of your expectations for where the SARB moves next then, Jeffrey?
So I think the SARB is not going to take sort of inflation prints for granted. So, yes, we've had a lot of downside surprises in inflation over the past year. I think the SARB will be comfortable with that, but as we know, the SARB sets policies based on forward-looking expectations of where inflation is heading. Of course, there are risks in the system still, but at the end of the day, I think SARB's own forecast kind of suggests that inflation should remain pretty well anchored towards sort of 3.5% next year. Now, does one CPI print, or a couple of CPI prints before their next MPC sitting at the end of January open the door for them to cut? Look, I think January is a possibility for a cut, but our view is that the central bank will probably want to take a more cautious approach from here on out. And so our view is that a quarterly pace of rate cuts going into next year probably makes more sense. So our view is that they probably will hold off on cutting in January and will probably resume cutting in March and then follow a quarterly pace of 25 basis point cuts until they get to 6%. So January is not off the table, but our view is that the central bank will probably want to take it a little bit more cautiously from here.
Jeffrey, we're taking a look at the dollar rand right now, and we have seen some notable appreciation for the rand over the past few months. I wonder, depending on who you speak to, a weakening of the dollar is going to be persistent through 2026 at the beginning of the year. Do you think that will be supportive of further disinflation in South Africa? What is your expectation for some of the volatility for the rand?
Yes, I mean, we are constructive rand for sort of idiosyncratic factors. So we think that the growth picture picks up a little bit more meaningfully next year. We have a growth forecast of about 1.6%. I would argue maybe even with some upside risk to that. We think that there is a lot of value in South African government bonds, and that will continue to bode well for inflows, foreign inflows into SAGBs, but also local interest in SAGBs, which we think will be a firm driver of the currency. But in terms of the external backdrop as well, you mentioned an expectation for continued dollar weakness. That's something that we very much buy into here at BNP as well, and so we see that dollar weakness probably bodes very well for most EM inflation trajectories, in particular South Africa, and we see this as particularly relevant in economies with relatively high FX pass-through like South Africa has. I think as well, the external environment, there were stories early on Bloomberg around how oil prices have hit, are hitting lows again. And I think our base case here again is that oil will remain crimped by meaningful supply overhang. So again, I think a stronger currency coupled with things like a weaker oil price is a very disinflationary outlook. If you add on top of that the fact that China is continuing to export more deflation into the rest of the world, all of these factors I think remain very supportive of a disinflationary narrative. But certainly the currency element I think should provide a lot of scope for, I suppose, disinflationary pressure to remain quite well entrenched in the South African economy next year.
How do some of the gains that we are seeing in precious metals, Jeffrey, play into that narrative as well?
Yes, so terms of trade, I think, is definitely one of the factors that I think are helping the currency. We've obviously seen, nearly a 70% rally in gold prices year to date. South Africa is a large gold producer. Obviously, this matters. On top of that, the oil price. South Africa is a net oil importer, so as a result, net your terms of trade environment is very supportive for the currency. We see that in the current account of the balance of payments dynamics. Our expectation is that the current account over the next year is probably going to average somewhere around 1%. Current account deficit is going to average somewhere around 1% of GDP, and a trade surplus of about between 2 and 2.5% of GDP. So these are very supportive factors as well for the currency. So absolutely, I would say that the current commodity price environment, particularly in precious metals, is very much a favorable tailwind for continued ZAR outperformance.
Yeah, good to take a look at some of those external factors as we zoom in here to South Africa. Jeffrey Schultz, head of CEMEA Economics at BNP Paribas Markets 360, joining us in London. Jeffrey, thanks so much for your insights. And let's just stick on one point Jeffrey was mentioning there. Oil is on track for its biggest annual decline since the pandemic as a glut of supply stalks the market. Tankers filled with oil are idling on the world's seas, waiting for the market to pick up. For more, we're now joined by Bloomberg's Anthony DePaola. Anthony, what is driving this surge in supply? We've been speaking for months about potentially what this portends for 2026, but give us some background.
Good morning, Jennifer. Yeah, that's right. Basically, it's additional production coming to the market. So we've got producers like Guyana in the Americas that has brought on new oil fields, and so that's pumping new oil into the market. The United States, there's a lot of talk about how the lower prices are not conducive for production there. So we are seeing a tapering off of growth, but still, the U.S. is a massive producer, so still pumping a lot of barrels out into the market. So we're seeing those additional barrels come to the market from those non-OPEC plus producers. And then on the OPEC plus side, because they have seen those competitors taking market share from them, because they have seen the writing on the wall in terms of prices, they've decided to kind of forego their previous defending the price policy and get back into a regaining market share policy. And so they've eased constraints. They've increased the quotas progressively over this year. And they've added a lot of new barrels to the market. Just Saudi Arabia, for example, is up on about 1 million barrels a day of production just this year because of the barrels that they've brought back. They are going to take a pause in the first quarter of next year because they do see that glut building and they do see that weighing on the prices. But they have brought oil back as well, too. So there's a lot of oil in the market. Demand in some areas has not been as good as it should have been. It's moderated a little bit in China, but still growing. So we still do see top line crude oil demand growth growing, hitting new records every year. So it still is up there. We've just seen it slow a little bit compared with the amount of oil that we do have in the market, Jennifer.
And Anthony, we've been talking about the pressure that Brent is already under. We've taken a look at the prices over the past few days. How low could we see prices realistically go, though, considering some of those factors you just pointed out?
Yeah, I mean, a lot of people are talking about the prices now being under pressure, but also saying that with that amount of oil coming to the market, and oil, of course, is a futures market, so people are looking forward at that oil coming to the market. They're saying with that amount of oil in the market and the perception of that coming glut, prices should be a lot lower, but for the geopolitical concerns that are holding things up. We don't know whether there's going to be additional sanctions on Russia. We don't know whether there's going to be additional fighting in the Middle East. So there are a lot of question marks that investors have that are looking at oil prices and saying, not putting them as low as they should be. However, as we get into next year, when that glut does materialize, all other things being equal, if we don't have real flare-ups in geopolitical concerns, then people are talking about those prices dropping from where we are now. So we're already in the 50s, but kind of around that 50 level. So that would be another $10 off. And so that's quite a bit. We're already down about a fifth this year. As you said, we're into a second weekly decline. So oil is going to end the year on a low note, and the risk is that it goes lower next year. Markets have been very resilient to geopolitical pressure over the past 2 years, in that we haven't had prices spiking up consistently on geopolitical concerns because investors are looking through that and looking at seeing if there's real supply disruptions, which we haven't had to date, and they're looking at that supply coming on. So they're seeing a very well supplied market. Again, with that demand that continues rising, but just ticking up, not growing as quickly as the demand coming into the market. And so that's the imbalance that we have, and that's leading to oil in storage, which is always a bearish factor for markets. So that's really what we're looking at going into next year, Jennifer.
Yeah, and certainly going to be something I'm sure we're talking about for quite some time. Bloomberg's Anthony DePaola. Anthony, thank you so much for your reporting. And you can read this story and all of our previous big takes on the terminal. Just type NI Big Take Go, and also on Bloomberg.com. Definitely check that out. It's a great read. Now, coming up, European Union leaders have agreed to loan Ukraine 90 billion euros after failing to break the deadlock over using Russian assets frozen on EU soil. We have the details on that next. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. EU leaders meeting in Brussels have agreed to a $106 billion loan to Ukraine. The funding will be delivered using joint debt rather than frozen Russian central bank assets.
The member states have agreed to finance the Ukraine through EU borrowing on the capital markets for an amount of 90 billion euros for the next 2 years. We will do this by way of enhanced cooperation that is backed by the EU budget headroom.
Joining me now is Greg Sullivan, Bloomberg's Russia economy and government editor. Greg, thanks so much for being with us. So it seems like this potentially is a bit of progress if we're seeing these members coming together. Give us some more details on what we learned.
Right. Well, this agreement is actually the culmination of months of discussions and back and forth. EU leaders have been pushing to make this loan to Ukraine, which they see as very urgent, with Ukraine starting to run out of money and U.S. aid to the country all but dried up. For a long time, many leaders had been pushing to use frozen Russian assets, but Belgium had been resisting that. Most of the assets are actually located in Belgium, and Brussels had concerns about potential retribution or legal exposure down the road should they use the frozen Russian assets. So this deal actually marks a pivot for the EU, not breaking the deadlock over using those assets and instead borrowing against their own budget. But it also represents the urgency the bloc feels with funding for Ukraine at this pivotal moment.
So then, Greg, if we think about long-term, is this the only solution that these leaders have come up with, or is there potentially a plan B that they still need to work out?
Well, some of the leaders did say that they're still open for discussions on what to do with the Russian frozen assets. One thing leaders did make clear is that Ukraine would not have to pay back the loan unless Russia actually paid compensation to Ukraine. So they will keep the assets frozen until reparations are paid by Russia. Now, of course, in recent days, Russia has been upping the pressure on Europe itself. It has taken to local courts to file a lawsuit against Euroclear and has threatened action against local banks with assets in Russia. So again, upping the pressure there to try to avoid the bloc's use of the Russian frozen assets.
All right. Greg Sullivan, Bloomberg's Russia economy and government editor. Greg, thanks so much for bringing us the latest on that story. Now, coming up, as U.S. inflation spurs a global equity rally, we look at the outlook and risks for the bull run in 2026. Details on that next. This is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise.
With some fun along the way.
This is Bloomberg Surveillance.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Cooling U.S. inflation has spurred a global equity rally with Asian shares climbing this morning. That's after European stocks closed at an all-time high and Wall Street ended the day higher with tech popping 2%. Looking ahead to 2026, positive momentum and a host of bullish forecasts should drive the U.S. stock rally, but there are still a whole host of risks ahead. And for more, we are joined by Farah El-Bahrawi, who leads our EMEA equity markets and strategy team to dig into this. So Farah, of course, there are a number of themes that analysts are dissecting and trying to figure out what exactly 2026 is going to be dominated by. Let's just start with the risks potentially for U.S. equities that have had quite a bull run in 2025. What do you see as maybe a prime amongst them?
Absolutely, Jen. So that's the issue here. You have a very strong year. Analysts are expecting a fourth year of really strong gains heading into next year. So we're going into that with valuations quite rich, concentration quite high in the US equity market. A lot of things really have to go right, just as expected, for next year. So if we look at the macro, we're expecting that exact Goldilocks scenario. Economy is resilient, but at the same time, weak enough for the Fed to comfortably reduce interest rates. And then, of course, the AI theme, that's something that's going to continue to be in focus. Companies are spending so much money to invest in CapEx. When are investors going to see a return on investment there? We've already seen some worries in some recent numbers with that, but it's going to be it's going to be a key theme heading into next year, as well as the concerns about the value chain and AI and even jobs. If you think of how jobs are going to be impacted as adoption becomes more widespread. So again, and how that feeds into the economy. A lot of risks for investors to keep in mind heading into next year, certainly, and not barring even geopolitical shocks, even in potential inflation shock. Everything just has to go right for the S&P 500 to deliver on what's expected to be a record year. Yeah.
Yeah, and of course, AI valuations as well. Farah, maybe really quickly, what about Europe?
Europe, again, you have record optimism. Strategists are bullish. Buy side is bullish. Expectations for the economy are good, but there's a lot of room for disappointment. Are we going to see that fiscal stimulus feed into the economy? And profit expectations are extremely high for Europe as well. If we see some disappointment on that front, especially with the market having re-rated quite a bit this year, that's where the risk lies in Europe.
All right, plenty to watch out for. Just a few days until 2026. Farah El-Bahraoui, who leads our EMEA equity markets and strategy team, walking us through potentially some of the challenges ahead for equities. And let's just finish on equities right now. We were mentioning some of the upside that we did get yesterday. Initially, we saw some of the downside after some questions about tech valuations and the AI trade, inserting a bit of negativity earlier on in the week. But S&P futures trading a bit sideways right now. NASDAQ futures looking a bit higher. If we cross the Atlantic, though, Eurostock 50 futures down about 0.3% there. So plenty to watch still for Europe, especially as we take effect on what Farah was just mentioning there. That is it for Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Stick with us for Daybreak Europe. This is Bloomberg.
Some people would say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And you know, we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns. And a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersachi in Beirut, and this is Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. Happy Friday. These are the stories that set your agenda. The EU greenlights a €90 billion loan to Ukraine after marathon talks in Brussels, but it's backed by joint debt, not frozen Russian assets. The Bank of Japan hikes rates to a 30-year high. Japan's government bond yields rise to their highest since 1999. The yen, though, slides. Plus, stocks gain in Asia as the delayed US CPI report shows core inflation at a 4-year low. But with October's numbers missing, analysts cast some doubts on the data. So it was a strong session on Wall Street yesterday, with gains for around 1.5% for the Nasdaq 100, gains of close to 1% for the S&P 500, lifted by a benign inflation picture with all the caveats around that, and we'll unpack that story for you shortly. But also you had the stellar report coming through from Micron, and that lifted the tech space as well. It was also a decent session for European stocks, but today futures pointing a little lower by 0.3% on the European stocks 600, or 50 futures, I should say. Here in the UK, FTSE 100 futures pointing lower by about 32 points, down 0.3%. We had the rate cut, of course, coming through as expected from the Bank of England yesterday. S&P E-minis pointing lower, modestly so, by about 0.1%. Nasdaq 100 futures then stateside looking to add 26 points. Let's flip the board and have a look cross assets. So the inflation data, again, with all the caveats and the messiness around the numbers, did lead to more pricing of further rate cuts from the Fed into next year. More than 2 now priced in by traders. So we look at the benchmark 10-year currently at 4.13. Yields just up 1 basis point after the gains of yesterday. 1.33 on the pound, largely unchanged after the rate cut that came through, and caution in terms of the path ahead being signalled by BOE Governor Andrew Bailey. $59 a barrel on Brent, set for a second week of losses on oil, back below $60 a barrel and down 0.3 in the session today. And gold still holding above that 4,300 level, but a little softer in the session by 0.1%. Let's flip the board and have a look at the Asian session, where the focus has, of course, been on that fully expected Bank of Japan interest rate hike to 0.75%, but nonetheless the highest rates now in Japan for 3 decades. And you're seeing that move in terms of the yen, interestingly weaker on the back of that move by the BOJ, even as they signal further hikes to come if the data continues to align with their expectations. The yen then currently trading at 156, a little softer versus the US dollar, down by 0.3%. The Nikkei getting a bit of a lift, up 1.2% in the session so far. Over in Hong Kong, the HSI gaining 0.6%, and the read across is there for the benchmark in Asia, following the strength that we saw in Europe and Wall Street as well, up 0.6% so far across the Asian benchmark MSCI Asia Pacific. Let's get to what's happening then in terms of the support coming through for Ukraine from the EU. European Union leaders reaching that agreement then on a loan to Ukraine. After marathon talks at a summit in Brussels, the EU will raise joint debt to loan Ukraine €90 billion for the next 2 years.
As a matter of urgency, we will provide a loan backed by the European Union budget. This will address the urgent financial needs of Ukraine. The Union reserves its right to make use of the immobilized asset to repay this loan. At the same time, we gave a mandate to the Commission to continue working on the reparation loan based on Russian immobilized assets. Okay, for more, let's bring in Bloomberg's chief Europe correspondent, Oliver Crook, who, of course, has been following all the details
for us. Ollie, tell us exactly what was agreed and what the nature of this loan is, given that these frozen Russian assets are not now being used.
Yeah, Tom, that wasn't clear to you exactly on what the mechanism is there. I mean, so this is a very complicated solution by the European Union. Depending on who you ask, it's an intensely elegant solution to a very complex problem, or to another, it might be a very sort of elaborate can-kicking to basically keep those Russian mobile assets immobilized, get the money to Ukraine from the European budget, and say that later on, if that loan will only be repaid if Russia repays Ukraine, and those Russian assets will be used in the stead. So that is effectively the mechanism that's in place here. Rather than seizing the Russian assets, making that decision today, it's keeping them under European control so that in the future, that when it comes time to actually repay that loan, the Russian assets can be used for that. So that is sort of deferring that decision to a large degree. It satisfies many of the concerns that the Belgians had throughout this process. And we should say that that 90 billion euro loan that is being backed by the European Union from the budget of the European Union, there are also some carve-outs there. It does not need to be backed by all of the member states. Hungary, Slovakia, the Czech Republic are all ones that objected to it. There was a unanimous vote on this, but those three countries, for example, will not be put on the hook to back that loan. So what this does in the short term, Tom, is it does get the financing needs to Ukraine as they need them. We know that they're basically running out of money in the first quarter of next year. This will bring that stopgap, but in some ways, it really kicks the can down the road in terms of figuring out what to do with those Russian assets. Because remember, Tom, there's no sort of reality in which many of these sort of political parties in Germany and France of the far right would sort of take on a debt burden to try to fund Ukraine. So this is the other thing that they're trying to balance there. Friedrich Merz and Emmanuel Macron, everyone seems fairly satisfied with this decision. That being said, it really leaves the sort of more difficult discussions to a later date.
Okay, so still questions further down the line with the two-year deal, at least tying Ukraine over beyond that period of the first quarter next year, as you say, when financing would become particularly tight. The other big issue that you've been walking us through and giving us the detail and context on in the lead up to this meeting, Ollie, is the EU-Mercosur trade deal, a mammoth trade deal that's been, what, more than 2 decades in the making, but it's been delayed again. What's happened there?
Yeah, so 25 years in the making, and they're going to have to wait another 3 weeks or so. And I think Ursula von der Leyen sort of nodded to this in her press conference yesterday that, you know, it's been 25 years, what's another 3 weeks? And effectively, the French and the Italians were not satisfied by the sort of safeguards that would be put in place for the farmers in case sort of pricing gets out of whack, imports get sort of flooded into the market. They want to have an emergency break within the clause to make sure that they can pause the trade deal and sort of amend it going forward. And also, of course, there's the issue of, you know, things like pesticides. They need to have the same rules that are applied on the goods that are coming into the EU as they impose on the farmers within the EU. And Tom, this is obviously a very emotive issue because the farmers were here in Brussels yesterday. The tractors were lining the roads of Brussels in protest to a number of things, including the Mercosur deal. But we heard from Emmanuel Macron at length. He was questioned at length about this in the doorstep, saying that basically, you know, he needs to show two sides. One, that he's standing up for the French farmers, but on the other side, I think he does really want to see this deal get through, get over the line. Same thing with Giorgia Meloni. You'll remember that the president of Brazil said basically, you need to sign this deal by Saturday or it's not going to get signed in my mandate. He's walked that back a little bit after a conversation with Giorgia Meloni. So the new date to watch for, Tom, from what we understand, is January the 12th. That's when this trade deal could get put into place. And we should say it's very important for the Europeans. It's very important for Latin America. Why? Because everybody's trying to diversify away from the United States, but to do so intelligently so they don't have some of the same trading problems that they have had with other countries in the past.
Okay, so another market, certainly for Oliver Crook's diary, January the 12th, as we look potentially to the signing of that deal. Bloomberg's chief Europe correspondent, Oliver Crook, thank you for that update. Let's get to Japan right now, because the yen has weakened after the BOJ raised rates to their highest level since 1995. Let's bring in Bloomberg's Japan economist Taro Kimura. Taro, get us up to speed then in terms of the market reaction to a move by the BOJ that all economists expected.
Right. As expected, the Bank of Japan hiked rates to 0.75% from 0.5%, though it looks low, but it's highest for Japan since 1995. Yen has weakened, probably because there was some speculation that the BOJ probably release their newest estimate on the neutral rates, which it didn't in today's release. So that provided some comfort to yen bears, and that's why the yen is reacting. Rates is picking up. The 10-year yields, I think it broke the 2% level for the first time in also 2006 or something. That's because, of course, BOJ hiked rates, but also probably the markets also see the BOJ's move slightly dovish because, you know, I see the break-even inflation rates, the 10-year inflation expectations are picking up, and that's driving the long-term rates. So probably the markets are seeing, given the pro-stimulus political interference from the government, markets are questioning whether the Bank of Japan can temper inflation in the long term.
And meanwhile then, Taro, what are you and the team going to be watching for when it comes to the governor's press conference? Governor Kazuo Ueda, of course, set to speak in a little under half an hour.
Exactly. So I don't think the yen bears are feeling relieved from the release from the Bank of Japan, because there's still a risk that the Ueda will signal something on higher neutral rates. And even in the statements, I see some signals that even though the Bank of Japan is hiking rates, it's calling the interest rates still significantly low. And that means, you know, the Bank of Japan is suggesting that their policy rates is still below neutral, and there's more space to hike going forward. And also in the statement, they clearly laid out some forces that drove them to hike rates, which is the easing U.S. tariff uncertainties, U.S. economy easing uncertainties also in U.S. economy, brisk wage growth and inflation. So those shows the Bank of Japan's posture that they're going to continue to hike rates. So including any off-the-cuff remarks from the Ueda, I think the market should be alert to each of what he says.
Okay, really interesting, a breakdown of the decision and what to look for then from the press conference. Taro Kimura, Bloomberg's chief, Japan economist. I just promoted him temporarily. Taro, thank you. Let's get to the broader picture across the Asian session then. Stocks in Asia gaining after the delayed US CPI report showed core inflation at a four-year low. But with October's data absent, because of the shutdown, of course, economists have warned of anomalies in the report. Despite that, the Chicago Fed President Austin Goolsbee said there was a lot to like.
We could get back on that golden path. Rates could come down. If we get stabilized full employment and we're on path to 2%, I would be comfortable with rates being a fair bit below where they are today. I just am uncomfortable front-loading the rate cuts before we're sure that we're actually back headed to 2%. This is a lot to like from this month's report, but we are going to want to see progress in services and progress in a couple of places on a sustained basis.
Well, let's bring in Bloomberg's Valerie Teitel right now, and it seems like that it's significant because Goolsbee, of course, was a dissenter and wasn't ready to push rates lower, and now he's saying there's a lot to see, there's a lot to like in an inflation report that's been described as Swiss cheese by some economists.
No, I think it was interesting to hear from Goolsbee that he did take away some conclusion from the report yesterday. I think there was a healthy dose of skepticism about this report, if even any Fed official could say anything with clarity after yesterday's data. But look, the market definitely took the direction of the data seriously. The fact that it came in soft, we saw the equity market really rebound from Wednesday's weak session. The NASDAQ basically scraped back nearly all its losses from Wednesday, and we did see two-year yields drop. They did drop by just 2 basis points, but Tom, it's been fairly range-bound in the Treasury market last few months, and we're at the bottom end of that range now, so very close to a breakout. So the market did take at least the direction of the report seriously.
Talk us about the debate around the data then, because it was the government shutdown and the effect of it. October data wasn't able to be collected. What do we know about just how messy this report was?
Well, look, the debate is still raging on Twitter, Tom, if you did want to get involved about statistical data calculation. There is still a lot to be said. There was
that is usually my favorite Friday activity.
Favorite Friday activity, yes. There was a few surprising factors in this report, one of which analysts have been heavily debating in the last 18 hours is a huge fall in housing inflation. We actually saw Omar Sharif from Inflation Insights say that the fact that they essentially assumed that rental inflation for October was 0 is a thing that is totally inexcusable. And he actually followed that up with that someone should be fired today from the BLS. So essentially they assumed that one of the biggest components of core CPI was 0 for the month of October. Now that's shelter inflation, housing inflation. We've heard a lot about this debate. Fed Governor Stephen Miron, that's one of its main basis for why he thinks that inflation is going to return to target next year, because we're going to see a slowdown in housing services inflation. But there was also other questions. We saw a big drop in apparel. Many people thinking that was because that the survey period for CPI was 1 week closer to Thanksgiving, 1 week closer to Black Friday, and perhaps captured some heavy discounting going on. So still a lot to be debated, but at least from Fed officials mentioning that this is a good sign. We do hear from New York Fed John Williams later today. He will be speaking at 1:30 p.m. Okay. Given he's a centrist, if he has any conclusions to make from this report, I think that'd be a good thing for the equity market.
Okay, so we'll listen to that commentary and all the caveats, of course, around that data set. Valerie Totel, thank you very much indeed. Coming up, UK startup Fuse Energy announcing its latest fundraise as it aims to make energy cheaper and more abundant. I'm going to be speaking with their CEO and co-founder next. The company valued a little over $5 billion. That's coming up. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Welcome back. Now, Fuse Energy has raised $70 million in funding, boosting its valuation to $5 billion. The London-based energy startup aims to provide lower-cost energy to consumers and develop its own renewable energy assets. Quantum Light, Revolut founder Nick Storonsky's venture capital firm, is a new investor in the business, also backed by Balderton, amongst others. I'm joined now by Alan Chang, CEO and co-founder of Fuse Energy. Alan, formerly one of the first employees at Revolut as well. Alan, thanks so much for coming in and talking to us about the raise. What do you plan to do with the capital that you've raised? $70 million, how are you going to be deploying that?
Yeah, so for the first 2 years, we've been very focused in the UK. With the new funding, we'll be focused on expanding to US, Ireland, Spain, and deep into continental Europe as well.
Is that a 2026 story? Is the US a 2026 story for you?
Yes, that's correct.
Okay, how significant is that market potentially for Fuse?
I mean, the goal for Fuse is to become the #1 energy company in the world, so it's hard to do that without going to the US.
That is quite the ambition. What sets you apart from any other energy companies then?
Yeah, so our key focus is full integration and lower the true costs per kilowatt hour. So we do anything from building a utility scale power generation all from scratch, all the way to energy retail and everything in between. So we're able to, for example, we just finished one of the solar parks a couple months ago, and we're able to lower the cost per kilowatt hour 30% below market, and that allows us to serve more customers at a lower cost per kilowatt hour.
Because you have the full stack.
Correct.
What stops your competitors copying what you guys do?
Reality is nothing. Anyone can build this. But they have, incumbents have been around for a very, very long time, and they haven't done. If they wanted to do it, they would have done it.
Okay, and talk to us about customer acquisition, because it's been pretty rapid. Give us the latest numbers in terms of customer acquisition and the kind of growth you're projecting for next year.
Yeah, so we've projected to grow roughly 10x this year.
Wow.
And the plan for next year is to grow another 4x. But internally, we're shooting for 10x.
Okay, you're shooting for 10x again in 2026?
Yes.
And you achieve that, you expect to achieve that this year?
Yes, that's correct.
Okay, 10 times the growth. What are the biggest constraints right now?
Biggest constraints is talented engineers. Ultimately, we are not capital constrained. Last month, we actually, we were actually cash flow positive for the first time ever. So it's really about hiring really talented engineers, and so we can go to more markets and build more products.
How do you work through grid capacity? Because that is famously constrained as well.
Yeah, so we have in-house team of developers that partner with the grid and work with landowners to develop sites. But yeah, you're not wrong. Like it is very constrained, so that's why we have a very, very big pipeline, over 1 gigawatt, going all the way to 2035, with projects coming online every single year.
And famously, there have been startups in the energy space that have collapsed. I'm thinking of Bulb Energy in recent years. Significant price swings around the energy story, part of that linked, of course, to geopolitics and Ukraine. What stress tests have you done across the business for those kind of price swings?
Yeah, so we stress test internally market prices every single month. So we do take the worst case scenario and we basically plan for that, both from a liquidity perspective and capital perspective.
Okay. When it comes to the question of AI and the build out of the data center story, and you're looking to build in the US, that's a key market for you, clearly. Yep. How much are you factoring in? What are you modeling in terms of the potential impact of data centers on energy use in the years ahead?
Yeah, honestly, like your guess is as good as mine. But what we do know is it could be anywhere from a few percentage points to over 100% increase in demand in the next 10-20 years. So one thing for sure is there is not enough energy to go around, and it's our job to make sure we build more.
What do you think by the end of 2026, looking into 2027, what is the potential US growth story for you?
I mean, like for us, we want to be a key leader in energy in the US as well. So we plan to go to Texas, state of Texas first as a first market.
Yeah.
But ultimately, in 5-10 years' time, we expect US to be half our business.
And it's renewable energy. The focus is on renewable energy, but you also use gas as well. Is that right?
Yeah, our focus is low cost energy, and it just so happens renewable is very, very low cost.
What about being full stack requires a significant capex, presumably, because you have the full stack. It involves significant investments in the actual generators of energy. Is that going to be a constraint for you longer term?
No, actually, there's actually a lot of abundance in capital on project financing, on renewable infrastructure. So actually, that's not a constraint for us.
How is it to operate a business like this in the UK at this point?
I would say it has its challenges, obviously, right?
What are the biggest challenges?
Well, I'll say the biggest challenges is, I think as identified, the planning grid, right?
Yeah.
If the government can do a lot to basically remove the red tape, and things would go much faster.
So, Keith, if you were to ask for the government for one change that could help your business and your sector, what would it be?
Deregulate planning and deregulate planning.
Deregulate planning.
Yeah.
Okay, Alan, thank you very much indeed. $17 million raise, big ambitions for the company globally, and the US market clearly central as well with a $5 billion valuation. Alan Chang, CEO and co-founder of Fuse Energy. Coming up, we're going to switch focus to the retailers with Nike in focus. Shares there sinking on weak sales in China. The CEO says the recovery will not be a straight line. More on that to come. This is Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Now, the suspect in last weekend's shooting at Brown University has been found dead after taking his own life. Authorities had also linked the suspect to the murder of an MIT professor 2 days after the university shooting. 2 people were killed in the attack last Saturday and 9 were wounded. Australia will start a gun buyback of surplus, newly banned and illegal firearms after terrorists killed 15 people in a Hanukkah attack at Bondi Beach. The effort will be the biggest such program since the government's buyback in the aftermath of the 1996 Port Arthur massacre, a landmark moment of public safety policy to regulate guns used in mass shootings. And TikTok says it has signed deals to create a U.S. joint venture majority owned by American investors. An internal memo seen by Bloomberg from CEO Shou Chu tells employees that agreements have been made with Oracle, Silver Lake and MGX. Oracle shares jumped in after-hours trading on the news. The new venture will operate as an independent entity that will control data protection, content moderation and algorithm security in the U.S. Chinese regulators have yet to say whether they will approve the deal. And federal workers in the U.S. have been given an early Christmas present in the form of a 3-day holiday. That's after the U.S. president signed an executive order making Christmas Eve and December the 26th federal holidays for the first time. But the New York Stock Exchange and NASDAQ say their hours on those days will remain unchanged, with the stock market closing early at 1 p.m. on the 24th, while December the 26th will be a full trading day. Coming up, the BOJ governor is due to speak after the central bank hiked rates to their highest in 30 years. Stay with us for that. This is Bloomberg.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. The EU greenlights a €90 billion loan to Ukraine after marathon talks in Brussels, but it's backed by joint debt, not frozen Russian assets. The Bank of Japan hikes rates to a 30-year high. Japan's government bond yields rise to their highest since 1999, while the yen slides. Plus, stocks gain in Asia as the delayed US CPI report shows core inflation at a 4-year low. But with October's numbers missing, analysts cast doubt on the data. Let's get to the markets then. A solid session on Wall Street. Yes, there was all the context and question marks around the inflation data, of course, of the US, but nonetheless, you saw a strong session with the Nasdaq up around 1.5% and the S&P gaining around 0.8%. Today, European futures, after a decent session, again, for European stocks yesterday, gains of 0.9%. Today, a bit of profit taking, 50 futures pointing lower by 0.2%. Here in the UK, FTSE 100 futures down by 32 points after that rate cut by the BOE. S&P E-minis currently flat. Nasdaq 100 futures looking to add about 0.1%. Let's flip the board and have a look cross-asset then. A focus on the US 10-year yields, marginally higher today after a modest gain yesterday on the back of the inflation data. 4.13 right now in the US benchmark 10-year. Traders pricing in at least 2 cuts from the Fed in 2026. The pound at 133, largely unchanged after yesterday's rate cut, and Andrew Bailey suggesting caution ahead in terms of further moves lower. $59 a barrel on Brent, set for a second week of losses on oil, down 0.2, and gold holding above 4,300, but a little softer in the session by 0.1%. Let's bring you live pictures right now of Tokyo, where Governor Ueda of the BOJ, as you can see, is seated and is commenting following that decision to raise interest rates to 0.75%, the highest level then since 1995. And the BOJ in its statement as well saying that if the data lines up with their forecasts, there are further hikes to come. Japan's economy is recovering moderately, says the BOJ's Governor Ueda. Japan's economy is recovering moderately. Ueda saying that wage hikes are likely to be solid next year. That, of course, is consequential in terms of how the BOJ thinks about further rate hikes. You see these wage negotiations and the moves higher in inflation. 3% is what the CPI data came out with earlier on Friday, 3% in the month of November. That is 44 months now above that 2% target for the BOJ. Wage hikes are likely to be solid next year, says the BOJ governor. We can get more context and bring in Valerie Teitel as we continue to watch these lines from the head of the Bank of Japan. What stands out to you in terms of what to think about? There's a little bit of uncertainty. There's this mismatch in terms of yields higher, Val, and yet the yen weaker. Some in the markets questioning just how far this BOJ can go. Some expecting, in terms of the people we've been speaking to, analysts and economists, maybe at a 6-month pace you get further interest rate hikes. But in the context, of course, of a new government and a new prime minister that is focused on fiscal stimulus.
Well, look, as we're watching UATA speaking, the real things we're looking for is a signal on timing. What do they think about the next rate hike? Is it going to be at a 6-month pace, or will he in some way imply some more urgency to normalize policy? The way he could do that is by talking about the neutral rate. If he does see the neutral rate as something higher, maybe that's implying they have more to go in this hiking cycle, maybe implying that they want to hike a bit more than expected next year. We're also looking out for any hints on their ETF holdings. Will they start to wind those down in January? It was something that Bloomberg did report a few weeks ago. But you're right to tie in the political angle here. Takaichi's government is on the verge of passing the biggest budget in Japan's history. So fiscal spending, fiscal stimulus is really going to be a big part of Japanese economic growth next year. And she's doing that alongside, dollar yen being at 156. The yen is at the weakest levels of the year. And in some ways, she doesn't want to import inflation at the same time she's juicing the economy. So a way to do that is to strengthen the yen, hike rates a bit more than the market expects. But given the yen and sticky prices, I do think the political angle here is that Takaichi is willing to allow some tightening. It's just down to UATA, perhaps in this morning's press conference, to tell the market just how much that could be.
A way to saying that they will be raising rates if the economic outlook is met. So that's matching what we heard from the statement. Accommodative conditions will support the economy firmly. And again, we have had the interpretation that he's not going to want to go too much against the grain, to your point, of the new government and Prime Minister Takaichi. So accommodative conditions to support the economy firmly. That comes back to your point as to what the neutral rate is in terms of what their agreement is. Is it 1%, 125, 150 even? The likelihood is rising for the outlook to be realized. Governor Ueda saying the likelihood is rising for the outlook to be realized. Wage price cycle is likely to be maintained. And of course, if that is maintained, it does arguably give them room to go further on those rate hikes. Again, Bloomberg and its assessment of BOJ watchers most expect further rates, but at a 6-month cadence.
One thing to note here is that despite the Bank of Japan's really cautious preparation for a hike, he is noting that the uncertainties over the U.S. economy, tariffs, have receded. That was a big part of why the Bank of Japan was cautious earlier this year. I'm interested to see if he says anything about asset prices, including real estate. Those have really risen in the last, or climbed sharply, should I say, in the last few months, and there are obviously lessons tied to the late 1980s, the massive housing bubble that burst in Japan. Maybe they're becoming more concerned about the rise in asset prices, but nothing yet from Takaichi on those two topics. He is noting, though, that uncertainties over the U.S. economy and tariffs have receded, and that was a big reason on why they were so cautious earlier this year.
Briefly, in terms of the broader global market impact of this, as we think about the rate differential closing now between the BOJ and the Fed, how do we think about things like the carry trade and money flows in and out of Japanese assets?
Well, look, that's a big point to bring up. Because Japanese fixed income has been trading at such a low yield level for such a long time, and there's low volatility, at least aside from this year, it has been used as a funder. Essentially, you sell Japanese yen, essentially paying those low rates in order to fund another trade. Now, that kind of trade has really kind of been ripped up amid the volatility in Japanese fixed income this year. But it is a key question on what the market will use as a funding currency next year. I mean, it could be even the euro, because there is a low volatility expected, at least across European fixed income, with the ECB moderately staying on hold for the most of next year. But I don't necessarily see the carry trade being disrupted by anything Ueda is saying at the moment in this press conference.
Okay, Val, thank you very much indeed. Markets reporter Valerie Teitel, and we keep across, of course, the lines from the BOJ governor, from one governor of the central bank to another governor of a central bank, and this time the BOE, warning Andrew Bailey of limited room to lower interest rates further. Different direction of travel, of course, for the Bank of England versus the BOJ. Andrew Bailey was speaking after the UK central bank voted 5-4 to cut rates to a near 3-year low. Bailey said the MPC will face a closer call on its decisions next year.
Well, I've been very encouraged by the progress that we've made on inflation. I've been saying for some time that it's going to, we had this, what we called hump up this year. I thought it was going to come down. And it has. And the good news is it's actually coming down a bit faster than I think we thought it would. I'm particularly pleased because there's been an easing of food price inflation, which is really very important. I mean, all inflation is important, but we know that food is salient. It's very salient, and of course it hits those on lower incomes a lot as well. I think now that we're on a path where we'll probably be around this level for a few months, but we think that come the spring, April, May time, we should see another quite sharp drop and take us, I hope, to around target. So we're going to come back to target sooner than we thought. So that's encouraging. All of this is very encouraging. And for me, certainly, it was a strong basis to cut today. It's the sixth cut we've made. Now, looking forwards, I do think we'll continue to have something of a gradual downward path. We'll have to judge the evidence, as you know, at every meeting. We'll come back for the meeting at the end of January, early February, and do that. The calls do get closer, but because as we come down, we will approach a level which is going to sort of, in a sense, maintain inflation. It's not going to be too hot or too cold, if you like to borrow that phraseology. It's very hard to know exactly where that level is, but we will approach it. We're approaching that level. We must be approaching that level in a sense mathematically. So the calls will become closer, and I would expect the pace of cuts therefore to ease off at some point. But I'm not going to judge exactly when that is because it's too uncertain at the moment.
The Bank of England Governor Andrew Bailey, who, according to the Press Association, is speaking to BBC Radio right now. The governor saying that the UK should be prepared for AI job displacement. That line coming through. Press Association reporting on a conversation between Andrew Bailey and the BBC. We'll keep across any additional lines, of course, from the Governor of the Bank of England if and when they come. Meanwhile, Bloomberg understands that the ECB and officials there believe the rate-cutting cycle is probably over, given the latest outlooks for growth and inflation. The bank held rates steady, with President Christine Lagarde saying the euro area economy is resilient.
We reconfirmed that we are in a good place, which does not mean that we are static. There was a unanimous decision that was taken today concerning the rates that we decided to hold. But there was also a unanimous view that all optionalities should remain on the table.
Coming up, oil heads for its biggest annual drop since the pandemic as tankers sit idle with nowhere to offload their crude. We bring you that story next. This is Bloomberg.
Peru is maybe first country inspired to me to how can I use the different ingredients. First time I went to Peru, trying to culture food, I never had this ingredients never used in Japan. Kind of like a wow, and cilantros, chili, garlic, and olive oils. It's a lot of good seafoods, complete a different way. Example, they have the fresh fish, but Japan, the fresh fish uses sashimi. But Peru use fresh fish, make the called ceviche, cooked with lemon juice. Never use soy sauce. First time I eat this, kind of wow. So then after this one, my open eye more, my cooking style that change, combine to Japanese style and another country food, then make novel style.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Welcome back. Let's get you up to speed on the latest lines coming through from the Bank of Japan Governor Ueda. Of course, you're seeing a further move lower in Japanese yen versus US dollar as Ueda says that we need to view the neutral rate as having a broad range. Also, on terms of rates being the highest level in 30 years, no special meaning to have rates at the highest level in 30 years, according to the governor. We will make comprehensive assessments on the degree of easing. But it's the lines on the neutral rate that I think the markets are latching onto. There is a continuing debate, of course, as to what the neutral rate is for Japan. So rates increased today from 0.5% to 0.75%. Expectations from most Bank of Japan watchers that Bloomberg's been talking to that you'll get further rate increases at a 6-month cadence. But, of course, Governor Ueda has been stressing that is dependent on, of course, their forecasts and the data coming in line. He does expect that to happen, of course. Difficult to determine the neutral rate ahead of time, according to the governor. The Japanese yen, just briefly checking in on the price action, 156 now. So again, weakening modestly, down 0.5%, weakening a little further on the back of these comments from the Bank of Japan governor. Now, to the commodity space, and oil is on track for its biggest annual decline since the pandemic as a glut of supply stalks the market. Tankers filled with oil idling on the world's seas, waiting for the market to pick up. For more, let's bring in Bloomberg's Anthony De Paola. Anthony, what is driving this surge in supply then?
Hey, Tom, good morning. Yeah, exactly as you said, there's a lot of oil in the market, and that's because there's been so much additional production from other countries, particularly outside of the OPEC Plus group of main producers. There's Guyana in the Americas that has added new fields and brought new oil onto the market that wasn't there before. They're a new producer. The United States, a huge producer, pumping out huge amounts of crude. Of course, we are talking a lot about whether some of those producers in the shale patch can continue to produce at these kind of lower prices. But we're just seeing kind of the incremental barrels being shaved off the top there. But there is still a massive amount of production and production growth. In some cases, not as much as was forecast. But we are seeing that oil coming into the market and outpacing the growth in demand. Top-line oil demand growth is still growing every year. We are seeing records. So that is still ticking up, but a little bit slower than some people would expect. And again, a little bit slower than that additional supply coming to the market. So we are seeing some buildup in crude supplies on vessels in storage, and that's bearish for markets. So a lot of people are looking at that glut really materialize and getting into the market and bringing prices even lower next year than they are now. So we're already below 60. Which is kind of a threshold for Brent. We haven't been below 60 for this long a time for a while. And now some of the market participants that we've spoken with are looking at prices even down closer to the $50 barrel mark next year as we go in and as we deal with that glut and those extra barrels coming to market, Tom.
Okay, how far we get towards that $50 a barrel level. As you say, 59.68 right now on Brent, down 0.2% and set for a second straight week of losses. And arguably then, with that context, further pressure on oil into 2026. Bloomberg's Anthony De Paola with the details on the Bloomberg Big Take, of course, which you can find on Bloomberg.com and on the terminal. Anthony, thank you. Let's get to one of the biggest retailers, of course, in the sportswear division, Nike, coming through with details yesterday. The world's largest sportswear company saw its shares falling more than 10% in aftermarket trading after the company warned of a decline in sales and a weakening market in China. Bloomberg's business reporter Jennifer Creary joins me now with the details. So Jennifer, Nike's been under pressure all year, and now there's kind of further underscoring the challenge there, particularly when it comes to the Chinese market. What is going wrong for Nike?
I mean, the problem here is the pace of change, and you're really seeing investors disappointed in how fast the turnaround is happening. So there are really two persistent sore points here that we saw from yesterday's results. So the first being Converse, the iconic brand. Sales are down 30%. For a long time, the company has relied on sales of its iconic Chuck Taylor sneakers, but unfortunately, consumers are just not as interested in the sneaker as they were before. The other sore point is Greater China sales. So that's down 17%. And that's because Nike has really struggled to sell off a lot of its excess old inventory and really innovate fast enough to capture the attention of an increasingly picky Chinese consumer. So it's not all bad. Some other regions are growing. So North America is growing and it's showing some progress in its running category, but it's simply not fast enough to really buoy investor confidence.
So where does the company, given the challenges, particularly when it comes to Converse and the Chinese market, where does Nike go from here?
Well, really, it really needs to boost in-store traffic and sell off that excess inventory, and more importantly, create products that capture the consumer zeitgeist. So on the analyst call, CEO Elliott Hill did say that the recovery won't be a straight line. We're acting decisively to accelerate the lagging areas, with China at the top of that list. So they know what the problem areas are, and Nike said it will focus on Tier 1 cities in China, like Beijing and Shanghai. So it's moving forward with that change, but it's simply not fast enough. Products take about 18 months to 2 years to really feed through, so it's going to take a while. One thing that I think is important to mention is that, Nike hasn't given full-year guidance for a while now. It's only been given guidance for the following quarter. And one thing that will buoy investor confidence is when they start issuing longer-term guidance. That will give them confidence that, the recovery is underway.
Okay, that's interesting. So that's an important metric to watch if indeed they come through with that forward-year guidance for the full year rather than just the quarter. Jennifer, thank you very much indeed. The update coming through from Nike and some of their investors losing patience in terms of the potential turnaround there, with pressure, of course, on the Converse brand and the Chinese market. Jennifer Creary, our business reporter. Now, some other stories making the news this Friday. New survey suggests Britons are more likely to spend and buy big-ticket items than they were before the government's budget. GfK's indicator of major purchase intentions rose to -11 in December. That's up 4 points from November and the highest score in almost 4 years. GfK's overall consumer confidence index rose to -17, matching the highest reading this year. A career diplomat has been named as the new UK ambassador to the US. Christian Turner is a former High Commissioner to Pakistan and had been due to begin a new post as the UK's ambassador to the UN. He replaces Peter Mandelson, who was sacked, of course, after emails obtained by Bloomberg revealed more details about his relationship with the paedophile sex trafficker Jeffrey Epstein. Some local elections due to take place in England next year may be delayed in a move that could limit the losses faced by Prime Minister Keir Starmer's governing Labour Party. 63 councils have been told they can choose to put elections on hold for a year as part of efforts to streamline local government reforms. The elections due in May are seen as a pivotal moment for Starmer's future. Switching gears now, Blackstone's annual holiday video is back, and this year the firm's 40th birthday sparks an over-the-top midlife crisis.
Turning 40, it's a really big deal.
Did you get a nose ring?
I've always had this.
Some of us are in denial that we've become a mature organization.
Hey, guys, let's start buying sports teams.
Okay. We could buy Ferraris.
No, let's buy a Ferrari.
Yes! Yeah, we're definitely having a midlife crisis. Wait, are we rolling?
Even Steve's going through it.
Well, I was thinking of becoming a DJ.
Steve Schwarzman, a DJ? He'd crush.
Okay, there you have it, the Blackstone annual video. You can watch more of that, of course, on Bloomberg.com. And getting us into, of course, the seasonal spirits and the festive spirits. There's a lot more coming up. Stay with us. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome back to Bloomberg Daybreak Europe. So, the BOJ hiking rates to the highest level since 1995. Governor Ueda continues to speak, of course. Recapping some of the lines for you as we see further weakness for the Japanese yen, now at 156 versus the US dollar. Governor Ueda saying it's difficult to determine the neutral rate ahead of time. Of course, they've raised rates from 0.5 to 0.75%. The BOJ's governor, of course, saying there is some distance from the lower end of the neutral rate, also saying that rate hikes haven't had a strong tightening effect. And again, the BOJ in its statement saying they do expect further hikes if their forecasts, of course, come to fruition. And we saw inflation data out of Japan prior to this decision from the BOJ earlier today, coming in at 3% for the month of November. That is the 44th month where you've had inflation above the BOJ's 2% target. We'll keep across this story for you, of course, globally significant as well, as we see that divergence between US rates and Japanese rates being squeezed as, of course, Fed rates come down and Japanese rates go up. Let's flip the board and have a look at what's happening in the inflation story out of the US then, talking of that rate differential. And expectations, interestingly, from Bloomberg Economics, that you could get 100 basis points of cuts in 2026. The inflation data, yes, yesterday was mixed and murky, given, of course, the government shutdown and the inability to collect data over October. The month of November, 2.6% was the core increase in terms of CPI. There were different reactions to this, of course, but you did see a bit of a move into terms of US Treasuries, yields down. You did see some increase in the bets around how far the Fed can get, given that, at least on the surface, this was a benign print. But again, with all the caveats around how muddy that inflation picture was. And again, BE, Bloomberg Economics, expecting that the chances of a rate cut, another cut in January, have increased as a result of that inflation data. Let's flip the board and have a look at the data print out of the UK, because the one to watch is retail sales. That's coming up in the next couple of minutes. The opening trade team will break that for you. In the context, of course, of lower growth in the UK, lower inflation and higher unemployment, retail sales important in the context of kind of building out the picture for you. As the governor of the Bank of England yesterday saying that we will likely move further lower, but really raising questions as to how far they can go, and the decisions becoming more challenging going forward. The rates moved lower by 25 basis points, of course, as expected yesterday at the Bank of England. Now, earlier, when we reported on UK consumer confidence, the graphic attributed it to GSK instead of GFK. We do apologise. Should, of course, been GFK. Coming up, I'm going to be speaking with a lovable CEO and co-founder, Anton Osika, after the company reportedly raised more than $300 million in new funding. That exclusive interview coming up. The open trade is next. This is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Good morning from London. I'm Anna Edwards alongside Lizzie Burden. We're an hour away from the opening trade. Here's what you need to know. The Bank of Japan hikes rates to a 30-year high. Japan's government bond yields rise to their highest since 1999. The yen is volatile. The EU greenlights a €90 billion loan to Ukraine after marathon talks in Brussels, but it's backed by joint debt, not frozen Russian assets. Plus, it's a mixed picture for global equities as analysts cast doubt on the latest US CPI report due to missing data.
Happy Friday, Anna. Here's the picture in markets. You had that stock rally on Wall Street triggered by that surprise US CPI print. Futures now pretty flat on the S&P. Euro Stoxx 50 futures pointing lower, though. And as you say, the focus right now really on Japan after the BOJ hiked rates as expected. We're back to 90s levels on rates, and we are for 10-year JGB yields as well, above 2% right now. The countdown to the opening trade starts right now.
Welcome to the program, everybody. This is the opening trade. It is Friday morning, Friday the 19th of December, and we have nearly, Lizzie, made it through an incredibly busy week when it comes to central bank decisions and plenty of data. Let's get straight into another of those central bank decisions, and it's still ongoing in the sense that the press conference is still happening over in Japan. So the BOJ unanimously deciding to hike rates. 0.75% is now the lofty height of base rates in Japan, a 30-year high. Now, it was interesting because in the commentary that came with the rate hike initially, there was some language that had people saying, well, maybe this sounds a little bit hawkish. Let's wait for Ueda. Let's see if he leans hawkishly. And so there was a lot of focus on things he was saying about the neutral rate as to whether he would give hawkish clues and sort of confirm that from the minutes. Well, at one point, he seemed to say things around the neutral rate that sent the yen weaker, that suggested there wouldn't be any hurry or need to increase interest rates very quickly. And then, on the other hand, he said something else about the neutral rate that pointed in the other direction. So he said all kinds of things about the neutral rate, which haven't necessarily given us much of a steer as to how hawkish he's feeling, how quickly another rate hike will come. The result of that is that the yen is down by 0.3%.
Yeah, neutral on neutral. This really was his chance to draw a line under the yen weakness. But as you say, we're at 156 per dollar still, despite the press conference. But it's ongoing. You can see Ueda there on the screen speaking right now. We've also, of course, had central bank decisions yesterday from the BOE and the ECB. And it was a surprise from the Bank of England. We knew that they were going to cut, but after that inflation print that we broke on Wednesday, you might have expected, indeed, Banu Bueja, who joined us from UBS yesterday, expected the vote split to be much more dovish, and it wasn't. There was no change from previous expectations, and that is why the market reacted hawkishly to that decision.
Yes, and as much as the conversation we had yesterday about 9 zero might have been a bit more extreme, it does seem clear that the market was positioned for something, as you say, a little bit more dovish. So that was the Bank of England, that was the ECB. Now we're still in the BOJ. We'll keep monitoring Governor Ueda and what he has to say there. But let's pivot our conversation to the EU leaders meeting, because they had two things to do here: secure funding to Ukraine and agree on a trade deal. They certainly haven't done the second. They have agreed some funding for Ukraine, but certainly not through the method that had been sort of top of the billing going into this, which was using frozen Russian assets.
Yeah, a real about-facing approach. It seems that they've been convinced by the issues raised by Belgium about illegal blowback, and it really reflects the urgency in Brussels to help Kyiv here. You even had the German Chancellor, Friedrich Merz, admitting that the plan A about frozen Russian assets was just clearly too complicated. And a really great line from Poland's Donald Tusk saying it was a choice between money today or blood tomorrow. They just had to figure out what to do without that funding from Washington.
Yes, and really interesting, those comments from Merz then, because he'd gone into this conference yesterday saying the use of frozen Russian assets was the only option. And then afterwards, as you say, being much more pragmatic, saying this is the pragmatic solution, this is a good solution, it is the only option. So a real change in tone coming through from Germany, which is interesting because this is going to involve joint debt.
Yes.
And joint debt has not been something that in Frankfurt they have always felt terribly comfortable with. So we'll see where that one goes. Interesting to see Emmanuel Macron after this meeting also saying that they are open to the idea. We should be open to the idea of more engagement with Russia, transparently with Ukraine, but more engagement with Russia. And I wonder if this is picking up a little bit from what the United States is doing to sort of make the running here on finding a peace deal.
Exactly, because if Europe is going to have to step up to the plate on the money front, it's also going to want to have more of a seat at the table when it comes to the peace talks, where at the moment Donald Trump is dominating. Now, let's also talk about the US CPI print, because that takes us over to Washington. We had that inflation gain lower than all estimates, but we've been talking all week about how patchy, flawed, and of course delayed this data is, and there's so much skepticism about this sudden drop in the core reading.
Yeah, absolutely. And the headline 2.7%, that was well below the 3.1% that was estimated. It did lead to a slight repricing for January, only slight. I mean, there's a 22% chance of a rate cut in January now from the Fed. We'll see how that weathers the holiday break, if you like. But of course, it led to a lot of a lot of people pointing out that we shouldn't take all of this too seriously because this data was so flawed. But it didn't stop stocks rallying. I mean, that and the Micron numbers didn't stop stocks. I know there have been all kinds of names for reports that we've been focused on that have, the Swiss cheese one was one of my favourites. The other one I like was from Wells Fargo that said, take it with the entire salt shaker. So not just a pinch of salt, but an entire shaker of salt required to give the right emphasis to how, to suggest how much emphasis we should put or not on this particular CPI report.
Yeah, great line there. But in terms of that market reaction, as you say, you had Bitcoin rallying, gold and silver now hovering near record highs on the rate cut bets. Platinum near a 17-year peak. It's up for a 7th straight session. But of course, the Venezuela tensions also buoying that haven appeal for the metals.
OK, let's talk a little bit about some corporate news we've had just breaking this morning. BBVA, the Spanish bank, announcing authorization for a buyback. The board approves a buyback of as much as 3.96 billion. So we mention it because of the size of that number. I suppose we'll keep an eye on the BBVA share price at the start of trade. Execution will start on the 22nd of December, so that's next week. They're commenting in this regulatory filing on this buyback this morning. We will keep an eye. The buyback it will be executed in several tranches. We will keep an eye on how that goes down in the markets, of course. Let's talk about, it has been a busy week. We've still got more to come.
Yeah, plenty on the day book this morning, Anna. This morning we've got, as usual, ECB speakers reflecting on yesterday's decision. We've already heard from Madis Muller saying this morning that it's too soon to say where borrowing costs may go next. But of course, we've had officials telling us that they think cuts are most likely done. So interesting to pass the reflections of the Governing Council this morning. Then at 8:30 a.m. London time, we have the ECB's wage tracker. Before at 1:30 p.m. London time, the Fed's Williams will be speaking.
Let's tell you about the conversations we'll be having this morning on the programme. A host of guests lined up to join us. Jeremy Stretch, CIBC Chief International Strategist. Who knows where the yen will be by there, but we will certainly talk to him about that. We'll also talk about, of course, the central bank decisions, the data we've had out this week and what is still to play for and heading into next year. Sabrina Kenish joins us, Pictet Asset Management, senior economist. Lots of conversation about Europe and the economy, where it goes into next year. Peter Oppenheimer, Goldman Sachs Chief Global Equity Strategist. They're still constructive positive on stocks, the broadening out theme, one we will address there. And Floris Lucht will be with us, ING Wholesale Banking Digital Assets Lead, but he's joining us because he will assume the position of Kivalis CFO in the new year. That's the banking consortium that is looking to set up a euro stablecoin, so we will be all about that at 8:30 UK time, Lizzie.
Well, here's what else you need to know this morning. TikTok says that it's signed deals to create a US joint venture, majority-owned by American investors. An internal memo seen by Bloomberg from the CEO, Shu Shu, says that tells employees that agreements have been made with Oracle, Silver Lake and MGX. Oracle shares jumped in after hours trading on the news. That new venture will operate as an independent entity that will control data protection, content moderation and algorithm security in the US. Chinese regulators have yet to say whether they'll approve the deal. Elsewhere, Britons are looking more likely to buy big-ticket items than they were before the release of Rachel Reeves's budget. That's the latest read from a survey from GFK. The firm's indicator of major purchase intentions rose to the highest level since January 2022 in December. All the sentiment measures, including consumers' outlook for the economy and their own finances, improved from November, when fears of tax rises in Labour's budget weighed on confidence. And Nike shares sank after the company warned that sales will decline this quarter amid persistent weakness in China and at its Converse brand. The world's largest sportswear company expects revenue to be down in the low single digits in the 3 months starting December 1st. So I said we were back to the 90s in Japan. It doesn't seem that we're back to the 90s when it comes to Nike and its Chinese sales, but Converse, you know, the 90s, noughties trend that is not coming back.
Right, well, it seems that way. So Converse is an area of concern, it would seem, for Nike. China, broadly, a region of concern for them. So in China, sales down by 17%. The CEO saying that the recovery is not going to be in a straight line and that China is definitely an area of focus. Competition really hot, it would seem, in the Chinese market, and just lots of analysts raising questions as to whether Nike really had the products that now, in this day and age, not the 90s, not the noughties, 2010s, but in this day and age, what will impress the Chinese consumer? And that is fast evolving and fast changing.
Well, just also talking about retail, we also had the latest UK retail sales numbers dropping at the top of the hour, falling for a second straight month in November, and so adding to all the evidence that we've had so far that uncertainty in the run-up to the Chancellor Reeves's budget did weigh on the economy. Well, of course, we already saw that in the GDP numbers, but it looks like the Black Friday discounts just didn't do enough to boost sales as we've seen in recent years.
Yeah, absolutely. And these numbers coming in negative when they were supposed to be positive. So that GFK story that we had overnight that painted a quite positive picture for the consumer, well, that maybe didn't last too long. We'll see how this goes down with investors a little bit later on. It is 11 minutes past 7 here in London. Coming up on the programme, oil heads for its biggest annual drop since the pandemic as tankers sit idle with nowhere to offload their crude. We will bring you that story. Plus, Bitcoin also could end 2025 on a low note. We will delve into the pressures facing the cryptocurrency. Up next, the Bank of Japan caps a busy week for central banks, hiking its benchmark rate to its highest level in 30 years. If you have any questions, please do get involved in all of these conversations around the BOJ, around that European leaders meeting in Brussels. Anything you want to contribute, please do. IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersachi in Beirut, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
"45 minutes away from the opening trade, and we've got futures pointing in opposite directions on both sides of the Atlantic. Lower here in Europe, but only flat to the downside as we look to close up the week. But let's reflect on the data we got out of the US yesterday, which of course sparked that rally on Wall Street. That delayed US CPI report showing core inflation at a 4-year low. But with October's data absent, economists have warned of anomalies in the report. Despite that, the Chicago Fed President Austin Goolsbee said there was a lot to like.
We could get back on that golden path. Rates could come down. If we get stabilized full employment and we're on path to 2%, I would be comfortable with rates being a fair bit below where they are today. I just am uncomfortable front-loading the rate cuts before we're sure that we're actually back headed to 2%.
So ammunition for the dubs, perhaps. Austin Goolsbee there on Fox Business. Let's bring in Bloomberg's Valerie Teitel for more. Val.
Look, I think it was a comfort for the markets that we did have a Fed official who could make a conclusion from the data set yesterday in that U.S. CPI report, which had many missing components and a lot of big questions on data distortion. We did, though, see U.S. core inflation fall to a 4-year low. So a lot of these components, which analysts are still debating, did come in softer than expected. So it wasn't necessarily data distortion in both directions. It was data distortion on the lower side. A big part of that, though, could come to how the BLS dealt with shelter inflation for the missing month of October. Flip the board. I just want to talk about the current debate raging on Twitter right now. It's been 18 hours since this report released, and there is still a Twitter fight ongoing on what the BLS did for the month of October. They essentially assume that rental inflation, OER, as it's also known, was 0 for the month of October. Anna, this is a big deal. Rental inflation makes up around a third of core CPI. So something like this could really distort the data for months to come. However, it all distorted it in the softer direction. I think the market's big takeaway is that inflation at least isn't reaccelerating. And so we were comfortable pricing in that equity market rally. So absent any surprises from that CPI report yesterday, we now had our attention on the Bank of Japan. No surprises here from Ueda. No hawkish comments about his commentary on the neutral rate. And Anna, I think that means that Christmas can start early for a lot of the traders out there.
Yeah, maybe. It seems as if the yen wants to weaken, doesn't it, Valerie? Thank you very much. Bloomberg's Valerie Teitel with us to talk about, yes, that ongoing Twitter fight still taking place around the inflation print. Blank pages in that CPI report and the UADA lines coming through on the BOJ. Let's stick with those with the BOJ for a moment and just go to some of the latest lines coming through here. He's touched on relations with the government, saying they have communicated with government closely, and of course the relationship between monetary and fiscal really interesting to watch right now in Japan. And then saying we don't see price trend falling if wage momentum holds up. So, you know, could that be something of a hawkish line that we were looking for? Well, maybe not, because the yen just seems to want to weaken this morning, and it's almost at session lows right now, having another go at weakening through the 156.40 level. Let's bring Jeremy Stretch into the conversation, Chief International Strategist at CIBC, and the perfect person to speak to about so many geographies that have had really interesting news flow this week, Jeremy, that we're all still trying to get our heads around. Let's start with the BOJ. How much weaker for the yen? So we're currently at 156.37. We're down 0.5%. Is this the direction of travel that you were expecting?
Well, we didn't think there would be a big reaction in terms of a yen gain on the basis of the rate hike, because it was essentially priced. We were anticipating, certainly earlier in the year, that we would be looking for a rate hike, first of all, in January rather than in December, but of course that's been brought forward. That was already discounted in the market, but we expected UADA to be constructively ambiguous in terms of his language, and that seems to be the undertone here, and it doesn't look to us as though the pace of policy tightening from here is going to be amplified, and indeed we're expecting probably policy to remain unchanged. Yeah. So it isn't the case that we should be expecting a big yen rally on the basis of that Economics 101 suggestion that a rate hike would be beneficial for the yen.
It is a long time since the last hike. I think it's almost a year, isn't it? So they're not going at a very fast pace.
Glacial, I think, is possibly the way to look at it.
Glacial is a good word. So is this more structural adjustment in the Japanese economy rather than actually a cyclical adjustment?
I think that's probably the case. So obviously we've been, I mean, you know, in the context of those of us who have been in the market for a longer time than others.
Okay, you can include me, Joe.
We have seen this sort of preeminent backdrop of inflationary pressures being subdued, Japan and the Japanese economic cycle being very different to the rest of the world, and that is still very much the case. And we are seeing this gradual pace of policy tightening, and it doesn't look as though we're going to see any significant change. And of course there are key undertones in terms of the Japanese market which are relevant and will remain relevant as we go through not only next year but into the end of the decade, in terms of those demographic changes and how that impacts the bond market and bond purchase strategies. So there are a lot of structural factors which are very much at play as far as Japan is concerned.
Well, yeah, they're very exposed to Fed moves now, and the fiscal story in Japan as well. Where does the yen end up at the end of next year, roughly, in your...
Well, I think it's a scenario where we don't expect much in the way of BOJ action next year, but I think it may be the case that we do see a slightly firmer yen, but that's possibly a story of risk and risk uncertainty. So the context for us for 2026 is that for the first half of next year, going back slightly broader in terms of the Fed dynamic, we're expecting the Fed to be a little bit more activist than the way that the market is anticipating. So that may well encourage a slightly cheaper dollar, but also that if that provides some boost to the equity market, that's good news in the first half of the year, but maybe some equity market uncertainty which provides a risk-off safety net for the yen in the second half of the year. So maybe it will be the case that dollar yen will end next year lower than we are now, so nearer sort of a 150 threshold. But I think it is going to be a case of, yes, the yen and Japan is going to be somewhat exposed to what happens in the broader picture, and including in the Fed.
Okay, so a slightly more activist Fed. Did that outlook for you change after the data yesterday, or did you kind of write it off like most economists seem to have done?
Well, I think yesterday's data, clearly there are many anomalies in terms of the data. You cannot take it with a great deal of credence, even to the extent of the timing of the data collection was that potentially rather nearer to Black Friday than before. So there are enough anomalies in that. I think that one of the things that I've been talking about to clients over the course of the last few months is talking about not the headline unemployment level or the non-farms adjustment on a month-on-month basis, but looking at things like U6, the underemployment rate. And I think that's symptomatic of a labour market which is softening, and I think that leaves us with that degree of comfort that the Fed will be a little more activist in the way than is currently priced in the market in the first half of next year. And so that leaves us with that narrative that we assume that will be a detrimental or a dragging factor in terms of dollar valuations in the first half of next year.
Yeah, let me ask you a bit more about that, because some people are looking at the AI story in the States and saying, you know, this is America making the running, this is positive for US growth, and they may even accept the things you've said about what the Fed will do, but they'll say, look at the growth story that the US could deliver with AI, and maybe that ends up being growth positive and dollar positive in some way. Or is that not the way it works? Because if the US grows and everybody's happy, naturally, money tends to seek other opportunities.
Indeed. So I think if we have a situation where if the rising tide of AI lifts all boats and we do have a globalized recovery, then you may well find that you do see those higher beta or higher growth currencies performing better. So then that provides a narrative where you don't necessarily see the dollar being the preeminent story. If you do see some degree of uncertainty, then you might see an element of a sort of a flight to safety bid coming back into the dollar, even amidst the uncertainties and the geopolitical dynamics and the Trump noise that comes around that. So I think there are certainly a number of sort of uncertainties to really consider. Yes, the AI narrative is particularly interesting because obviously the parallels with .com, et cetera, et cetera. I think the whole equity market story becomes more of a problem once we've worked through the Fed easing narrative. And I think that's why in the second half of next year we're a little more nervous about the equity dynamic and then potentially coming back into a safe haven premium, which might start to come back to the dollar's benefit.
Let's talk about easing here in the UK. We had the BOE decision, of course. Kind of surprising, perhaps, that they weren't more dovish than had been expected before the weaker-than-forecast CPI print. What's your outlook for BOE cuts next year? Because if they don't cut again for a long time, do you see continued sterling strength in 2026?
Well, I think first and foremost, if we go back a couple of months, I was saying to our traders, the market was seriously underpriced in December, and ultimately it proved to be correct. Now, we had that 5-4 vote. In a sense, markets obviously got ahead of themselves because they looked at the data this week and thought, well, more members will have switched camps. But I think many of those who are reticent to vote for cuts at this point are very concerned about the inflation persistence narrative in terms of wage growth and in terms of service sector prices, and they require more evidence. But I think there will be enough evidence going through the early part of next year to warrant the bank to consider further easing. So I think the market is underpricing probably the next two policy meetings quite significantly because I think the data will be warranting that. And obviously this is, I've only just heard the headlines from the retail sales report, but that doesn't seem to be anything other than, arguing for policy easing as well. So actually I think there will be some degree of uncertainty from a sterling perspective. So I think euro sterling goes higher as a context, because I think that's probably the better way to look at sterling in the context of the next 2 or 3 months, because there's a lot of noise around the dollar, and I think that's probably a cleaner way to look at the sterling narrative, because I think there's more cuts coming than are priced into the market, and I think that will keep sterling on the defensive.
And against the euro, I mean, and do you assume the ECB is just on hold for, well, forever?
Indeed.
Policy terms?
So yes, I've been quite comfortable with the narrative of the ECB being on hold. So the next move inevitably will start to be priced to be a hike. Now the question is, how quickly will that prove to come to play? I think that's probably still more a story for 27 than 26. But if the ECB is going nowhere fast, and if we look at the survey data we've seen this week, IFO was disappointing, but ZEW implied there is some degree of resilience in terms of the investor sector. And I think if we see that playing out, then I think we can see the euro gaining, not only against the dollar, but also against sterling. And I think we do see both of those euro pairs moving higher.
Just very briefly, Lagarde was asked at the press conference about all the speculation about who'll replace her, lots of personnel changes at the top of the ECB coming.
Indeed.
Is that going to create volatility in the currency markets?
I think it potentially does. So because there will be an obvious fixation in terms of who will be the leadership and how will that leadership frame the debate. Because, of course, we've seen plenty of that in the context of the Fed. So I think the whole narrative about the leadership of the ECB will become much more relevant. And, of course, not only do we have the monetary policy dynamic, but there is also the political dynamic in terms of the nationality of the leadership of the ECB. That also amplifies some of that volatility or potential volatility.
Another theme we import from the US, Jeremy.
Indeed.
It's good to see you, Jeremy Stretch, Chief International Strategist over at CIBC. Well, coming up on the programme, we're going to cover the market moves and the leading stories on the global economy with Sabrina Kanish from Pictet Asset Management. That conversation coming up next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
The belief for climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are gonna kill everybody. So we gotta figure this out. And we're not gonna do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back. This is the opening trade. 30 minutes from the start of Friday's trading session for cash equities, of course. And this is the futures picture right now for European markets. Of course, European stocks globally did okay yesterday with that inflation print out of the United States. Certainly over in the US, we saw strong gains on the back of it, rightly or wrongly. Plenty of people pointing out the extent to which we should not rely on that CPI print. But anyway, we went higher in stocks. Today looks a little bit different, and European futures are pointing a little bit lower. Eurostoxx 50 down by 0.1%. You can see that the FTSE 100 futures may be down 0.3%. Oil prices a touch weaker at 59.72 on Brent. And let's have a look at the bond markets then, because we're focused here as well with all of these central bank decisions taking place this week. We heard from the Bank of England, we heard from the ECB yesterday. Not a huge amount of movement as we get Friday's session started when it comes to European government bond markets. But I should mention that we are also watching what's going on in Japan. We have seen some fairly historic moves coming through on the Japanese 10-year yield. It went through its 2006 level, then it went through its 1999 level. As rates go to a 30-year high in Japan, that is rippling through certainly the JGB market, Lizzie.
Well, let's dive into some of those central bank decisions, shall we? After the Bank of England voted 5-4 to cut rates to a near 3-year low, Governor Andrew Bailey weighed in on the UK economic growth debate. Bailey told us what the BOE can do to help revive the British economy.
So we have got low growth in the economy. Now, I think the underlying reasons for that are more to do with, I think, the productive capacity of the economy. But the best thing that we at the Bank of England can do, obviously, is maintain stable prices, low inflation, because that will support growth in the economy. We are also seeing some signs of weakening in the labour market, which obviously does affect our view on what inflation is going to be, and we do take that into account.
Meanwhile, Bloomberg understands that ECB officials believe the rate-cutting cycle is probably over, given the latest outlooks for growth and inflation. The bank held rates steady, with President Christine Lagarde saying that the euro area economy is resilient.
You know, we reconfirmed that we are in a good place, which does not mean that we are static. There was a unanimous decision that was taken today concerning the rates that we decided to hold, but there was also a unanimous view that all optionalities should remain on the table.
Joining us now for more is Sabrina Kanish, Senior Economist at Pictet Asset Management. Sabrina, I'm interested how you reflect on that ECB decision. First of all, good morning. We've heard from ECB officials this morning, the likes of Muller saying that it's too early to say where rates may go next. Villeroy of France saying that the ECB is going to have to be agile at the coming meetings. Is the next move a hike?
Good morning. Yes, indeed, listening to Lagarde yesterday, so the ECB seemed quite comfortable, or at least she mentioned that the economy remains resilient in the Eurozone and has even surprised on the upside. She mentioned the rise of exports despite some easing after the front-loading of export at the start of the year ahead of import tariffs. But overall, going to the meeting yesterday, just looking at the data, they pretty much came on the hawkish side. So we had Q3 GDP, which surprised on the upside, mostly reflecting resilient domestic demand, and also on the inflation front. So we have sticky services inflation, 3.5%, mostly reflecting wage growth. So it's fair to say this is actually what we have in line. We think that the ECB has ended its cutting cycle in June amid this resilient economic activity with potential for the economy to rise even further above growth potential. So we do expect the next move to be a rate hike.
And when does that come? We've just had Olli Rehn saying that the next ECB move isn't necessarily up. Could that hike that you see come in 2026, Sabrina?
Yeah, so that's here it's difficult to say. So as early it could be at the end of 2026 or 2027. Again, here it depends on the implementation of the German fiscal plan. So this is the main engine of growth for next year. The budget 2026 has been approved by the parliament and the numbers are pretty big. So we are talking about 127 billion euro in investment spending. So despite some concern about implementation challenge regarding the quality of investment, regarding the type of new investment, net, we think that the impact on growth would be quite significant. So drifting up growth in Germany as well as in the Eurozone. So depending on the implementation of the German fiscal plan as well as the recovery of private consumption. This is what we are seeing. So private consumption has continued to slowly recover as saving ratio is going down, but overall remaining well below trend because of the high level of uncertainty.
Sabrina, can I ask, good morning to you, can I ask you more about your assessments of the German fiscal push and what that is going to do to the European economy or even to the German economy? You know, how far-reaching will the effects of that be? It is focused on defence, but also on infrastructure. Some people are impressed by its scale, but suggest that perhaps the implementation might be a little slow. What's your assumption, your base case assumption about what this looks like for Germany?
Yeah, we are pretty optimistic about the German fiscal plan and the impact on the German economy and for the Eurozone as a whole as a consequence. But as you mentioned, the main risk is the implementation risk. However, just looking at the recent number, for instance, they were concerned about the implementation of the fiscal plan, and looking at the federal cash fiscal deficit, it has increased to 1.5% in October. So again, this is early sign, but it has increased when the budget 2025 was approved in autumn of this year. So with the budget 2026 being now adopted, so we should have the impact early in 2026, especially coming from government consumption. Then, as regard to public investment, it takes more time to be reflected in growth. So this should be reflecting in 2026 and 2027. So the impact that we have on growth, because we have the current budget. So as part of the current budget, there is a share dedicated to government consumption with a lower fiscal multiplier, but then we have the big infrastructure plan of 500 billion euro, and here fiscal multiplier are higher, so with a higher impact of growth. So net, we have an impact on the economy of 0.7 percentage point in 2026.
Sabrina, do you see any resurgence for the manufacturing sector in Europe? Is that a phenomenon that you see already or that we should look for next year? It seemed in the latest PMI data out of France that maybe there was going to be a hint of that, but then Germany not telling the same story. I wonder what the balance between services and manufacturing looks like for next year for you.
Yeah, that's a very good point, because in fact, when you look at the engine of growth, the economy is mostly driven by the services sector, and thanks to periphery economies that are services-oriented ones. So we expect this to continue when you look at the December PMI. So it has slowed down, but the services sector continues to perform pretty well. But we are expecting a rotation from the sources of growth from services to manufacturing sector. There is a potential for that. So indeed, when you look at industrial production in the Eurozone, so it's still 10% below trend because of Germany, where industrial production is 20% below trend. Sentiment on the manufacturing front remains pretty depressed, although we have an impression that sentiment has bottomed out, but they are positive drivers. So the first one being higher demand for capex. They are investment needs, and the number in Germany are eye-watering, so 127 billion euro of investment spending, but also demand coming from consumers, so savings remain pretty elevated. And the third point is the easing of monetary condition. The manufacturing sector tends to be quite sensitive. So this is what we expect for 2026, a recovery of the manufacturing sector, and therefore boosting commodity prices.
And Sabrina, I'm interested in your view of the impact of AI on the European economy. Lagarde says it's positive. How long do you expect all this capex that we're seeing to translate into productivity gains? And do you think that that's going to come with job losses?
Yes, so that's a very fair point. And indeed, Lagarde did mention yesterday that investment surprised on the upside in Q3, so it was up 0.9%, and despite external and domestic uncertainty. So there is early evidence that capex or AI is impacting investments positively and growth. We have to wait to see even more evidence of productivity gains, given the fact that those investment tends to react growth with lag. We tend to see at the beginning a G curve because of investment in intangible investment before being translated into higher productivity and higher growth. But this is something that will definitely impact growth going forward.
Sabrina, thank you very much. Thanks for joining us. Have a good weekend. Sabrina Kanish, Senior Economist at Pictet Asset Management. Now, sticking with the European economy, European Union leaders have reached an agreement on a loan to Ukraine after marathon talks at a summit in Brussels. The EU will raise joint debt to loan Ukraine 90 billion euros for the next 2 years.
As a matter of urgency, we will provide a loan backed by the European Union budget. This will address the urgent financial needs of Ukraine. The Union reserves its right to make use of the immobilized asset to repay this loan. At the same time, we gave a mandate to the Commission to continue working on the reparation loan based on Russian immobilized assets.
For more, we're joined by Bloomberg's Chief Europe correspondent, Oliver Crook, who is with us in Brussels, has been following this conversation in and out of this meeting. Ollie, good morning. We're hearing the ECB's verdict, or a bit of it at least. The Finnish Governor, Olli Rehn, saying that the EU joint bond plan for Ukraine is a tolerable solution. I mean, tolerable may sum up the reaction or the response from various European leaders, I suppose, to this finally getting to a deal.
Yeah, that's right. And I mean, listen, we heard from the Chancellor of Germany walking into the meeting, basically dismissing the solution they ultimately came to, saying that it was really not a practical one and one that really didn't make much sense. But at the end of the day, he fell in line with a number of others. So what we have today is an agreement to loan Ukraine 90 billion euros to fund its war effort, to fund its budget 2/3 of the way for the next 2 years. Absolutely critical for the Ukrainians who run out of money in the first quarter. And the way that the Europeans have found to do this is to basically have joint debt from the European budget, backed by the European budget. They loan it out to Ukraine. Ukraine only has to pay that loan back. This is a zero-interest loan. Only has to pay that loan back if the Russians pay them reparations. And if the Russians don't pay reparations, which of course seems pretty unlikely, but it's certainly a possibility, then the Russian assets that are still going to be held in Europe will be paid back. Pay back the loan. So now this solves the problem in many respects. It basically gets the Belgian concern on sides. It kicks down the road the decision of what to do with the Russian assets. It makes it so that European member states can say they don't actually hold the risk on their balance sheet, which is not true, but is a little bit more complicated than that. So it ticks a lot of boxes. It solves a lot of problems. So I think that depending on your perspective on this is an intensely elegant solution to a very complex problem, or this is a very elaborate can-kicking effort to kick the can a little bit further down the road. But at the end of the day, what it does ensure is that Ukraine will get 90 billion euros in order to continue to survive for the next 2 years.
All right, a tiny needle to thread. Bloomberg's Chief Europe Correspondent Oliver Crook, thank you so much for explaining how they got there for us. And coming up on the programme, Renault has now regained investment grade status at S&P Global Ratings. We'll take a look at that and the other stocks we're watching next. This is Bloomberg.
A cidade estava sitiada.
Isso, ao começo, eu também não sabia o que fazer. Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now. It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Nisho talya ki kon ahmalep ahmata chuara pango ahmalep manchang lenya ay kon mamanya.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation. Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Happy Friday, everybody. Already this morning, the Bank of Japan has raised its benchmark interest rate to the highest level in 30 years. Speaking a short time ago, the BOJ Governor, Kazuo Ueda, said that more increases are in the pipeline, but only if conditions allow. Let's bring in Bloomberg senior editor Brian Fowler out of Tokyo for more. Brian, what's Ueda actually been saying about the economic outlook? We had a guest on, Jeremy Stretch, earlier saying that he was constructively ambiguous. What do you make of it all?
I think that's a very good description. He definitely is keeping his options open. He signaled that, of course, the tilt is still towards more hiking if conditions allow, and that's what everyone expects. But he also sought to sort of hedge on where he's going. He did not reveal any sort of hints in terms of what the pace might be. We've spoken to a couple of ex-BOJ officials, very high-ranking people who know this stuff very well. We spoke to a man called Hayakawa-san last week, and then today, Momo-san. And they were both of the opinion that we could see hikes every 6 months for at least through 2026 and maybe into the first half of 2027. That would take the rate up to 1.5%. That seems to be a pretty widespread idea of where the terminal rate may lie for this current cycle. But Ueda did not give us that in any sort of concrete way during his press conference today.
Yes, and Brian, I noticed one of the latest lines in the press conference was the more data to judge the neutral rate, the better. So, you know, just a wait and see message, perhaps. So what has the market reaction been to this? You know, bond markets have moved and also focused on the yen, which just seems to want to weaken on this.
Yeah, so the move was widely expected. 50 out of 50 economists we spoke to predicted it, and that's very unusual. So really the focus was on the future. So when the decision came through, we saw kind of a counterintuitive reaction in the market. You might expect the yen to rise on a rate hike, but of course, in this case, that move was factored in, and I think the market was a little disappointed that they didn't see anything more in terms of hawkish signals from the BOJ. To your point on the neutral rate, the BOJ has said in the past that it sees that rate lying somewhere between 1% and 2.5%. Ueda-san did say today that there's still some room between where we are now and the lower end of that range. And that's his way of saying that the BOJ could hike again and still keep settings relatively accommodative overall. And that's his way of also saying that he's still on the same page with Prime Minister Takaichi in terms of wanting to support the economy right now with policy.
Brian, thank you very much. Bloomberg's Brian Fowler with the latest on the BOJ. Let's broaden the conversation, but actually start with the BOJ conversation with Mark Cudmore, our Markets Live executive editor, who joins us for 3 minutes on the markets. So, Mark, the yen seems to be weakening, yields going higher. Some of that is what you would expect from a rate hike, but not all of it. What stands out to you from the BOJ?
I'm really surprised that the yen has continued to weaken here. And I say that in context that, as you know well, Anna, I'm a structural yen bear. I always think the yen's going to depreciate forevermore. But I actually thought that this press conference, in context that Governor Ueda is always a very cautious individual, I don't know what people were expecting. He was never going to be more hawkish than this. Sure, he wasn't particularly hawkish, but I thought he was about as hawkish as he was ever going to be. So I kind of thought that after the original dollar-yen spike, the market wanted to sell yen. So the initial dollar-yen spike did not surprise me at all. But I thought we'd probably drift lower into the afternoon. Instead, we seem to be breaking higher out of the range. Now, there's a bit of a weird dynamic here that we're going into lower liquidity. As this starts going kind of higher, you actually get a binary situation where it's unlikely to stay around these levels. We would start triggering some stop losses if we could drift much higher from here. So at the moment, the price action's confusing me. I expected dollar-yen to drift lower into the afternoon, but there's a risk of some funny moves later on, given what's happened.
Mark, did the market overreact to that US CPI print yesterday? A lot of skepticism from economists, some calling it the Swiss cheese report. It was so holy. How much do you trust this drop in inflation?
Yeah, I mean, what's interesting is how quickly markets did this kind of dismiss it. So markets, the yields did not react much. I mean, you've seen this exceptionally soft print, and you'd expect people to price in more rate cuts. But in fact, the market barely moved in the yield side. Now, equities rebounded. They kind of, they liked that, but they did, of course, pair that later on in the session. So, but you know, stocks traders are always a bit more optimistic bunch, always more inclined to buy. This wasn't a bad news data print. Even if it wasn't, should be dismissed and not taken as a positive. You couldn't suddenly say, this is a bad news, a reason to sell. And if you've got no reason to sell in stocks, then you buy. That's the default action. But certainly, bonds traders ignored it entirely.
Okay, I'm going to ask you a really dangerous question now, Mark. Are we done with 2025? Can we all take some time off and come back for 2026?
No, I think, unfortunately, and I say this embarrassingly because I'm heading off on December 24th, so I'm leaving the problem to my team. But look, I think this is a market where the price action suggests that the technicals are a little bit fragile. The market is very bullishly positioned, and I think structurally, as we've discussed a lot, I expect stock markets to make fresh record highs in 2026 easily. I think it'll be a good first half of the year because of the structural tailwinds. But I think there are some problems there in terms of risk aversion side that have not played out. And again, I still draw attention to the fact that the digital asset treasury companies continue to trade weaker and weaker. That spreads into the crypto sector. That spreads into retail sentiment at a time they're getting squeezed by Christmas. And that kind of weighs on the favored AI names, the meme names, and that's why I think it's going to be problematic for another couple of weeks.
All right. Well, in other words, don't switch off Bloomberg TV. Plenty more to come in 2025. Bloomberg's Markets Live Executive Editor, Mark Cudmore, we thank you so much. And remember, you can get up-to-date analysis and insight from Mark and the rest of the team by going to MLIV Go on your terminal. Let's get to your stocks and watch now with Chloe Melly. Chloe.
Good morning, Lizzie. So Renault could be on the move today after winning back its investment grade. So S&P said that Renault had managed to materially refresh its lineup and also expand outside of Europe, and that could potentially really boost volumes over the next couple of years. So this is something that could provide that lift in the shares for Renault after quite a bit of weakness over the last year. Like much of that car making sector, we can see that weakness up here. And this is really also a vote of confidence in the CEO that started just over the summer. So Renault to keep in mind today. Moving on to sportswear companies, which could also be on the move. It could be weaker this morning after Nike over in the US warned that sales would be much weaker for this quarter, and that's because of weakness in China and in its Converse brand as well. So some of this is company specific, but a lot of it actually also bodes quite badly potentially for those other European sportswear companies that also have huge markets in China. And we saw the Nike shares really tank on the back of that news. So we'll see how this read across actually plays out at the open for Adidas and Puma, which have been having a bit of a tough year as well. And finally, BBVA could be moving higher this morning after unveiling its biggest ever buyback. We are talking about 4 billion euros. This is an attempt by the bank to draw a line under the failed bid for Banco Sabadell that failed earlier this year in October. And this is really an attempt at kind of moving on, get investors back on side. And so we'll see if the huge buyback manages to do it.
Yeah, that was a long story, wasn't it, Chloe? Thank you very much. Our equities reporter, Chloe Melly, with the stocks that we are watching this morning. European equity market futures then do point a little bit lower. US futures are pointing higher right now. So E-mini is only 0.1%, but NASDAQ futures up by 0.3%. European yields just a touch higher, particularly at the longer end, 30-year. And the Japanese story focused on the 10-year horizon. We'll see whether that has any psychological impact on the European trading day ahead. But we'll come back with the market open. This is Bloomberg.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Welcome back to the opening trade, everybody. The last trading day of the week. Not quite the end of the year, but certainly of the week. Let us get into this market session. This is the picture from yesterday over in the United States, but I think it's important just to revisit this in terms of where the European markets closed, which is where the yellow line is, and where we were in the US sort of psychology of the trading day at that point. The markets got quite excited about that CPI print out of the US. As flawed as it was, as full of holes as it was, the market did send stocks higher. Some of that lasted in the US session, but not all of it, which goes some way to explain why futures are a little bit weaker here in Europe. So we are expecting to go a little bit weaker at the start of trade. Euro Stoxx 50 futures down 0.1%, as are DAX futures. FTSE futures maybe down a little more. A little bit of weakness in the oil price overnight, but not a huge amount. Still around that $60 level on Brent. Lizzie, what do we have in terms of individual stocks and sectors that we're watching?
Well, I've got my eye on the trainer makers. Adidas and Puma here on this side of the Atlantic maybe going to be lower because of that weakness that we saw out of Nike, particularly in China. So there could be a read across into some of the European names. Also looking at BBVA after they unveiled that €4 billion buyback after the failed Sabadell deal. And I'm also watching the European delivery stocks because you had FedEx stateside beating estimates, in fact topping all Wall Street estimates and raising the low end of its profit outlook for the year. So watch the likes of Deutsche Post, IDS, PostNL. Could keep on going. Poste Italiane, all of the European delivery stocks we should keep in focus this morning, Anna.
Yeah, that's an interesting one. I remember a time when logistics was often seen as quite a bellwether for the global economy, maybe still so we'll certainly keep an eye on those. See if there is that read across from FedEx. And it could all be about read across this morning because, as you say, Lizzie, we're watching anything to do with the sportswear industry on the back of those Nike numbers. They were disappointing on China, which could have a bit more of an impact into the European session as well. Let's have a look then how these European equity markets open up for the final trading day of the week. The FTSE 100 is pretty flat, almost entirely flat, a bit of a Friday feel. It's been an incredibly busy week. We've had data aplenty out of the United States, the UK. We've had central bank decisions from the UK, from the European Central Bank, from the BOJ. And we're still getting data in the United States that requires a huge amount of concentration because of the holes in it. So that's still in the market's mind, perhaps trying to analyse everything we've heard this week. The CAC 40 opening down 0.25%. The Stoxx 600 as a whole then is flat to negative, I guess we'd say this morning. Lizzie, do you see anything of interest on the sectors board just yet?
Well, as we look across the continent, we have banks leading the gains this morning, up 0.25%. Energy not far behind. Utilities, insurance, construction and manufacturing also in the green. But it's still about 3/4 of sectors in negative territory this morning. And consumer products and services at the bottom of the basket, down more than 1%. That's the biggest mover in terms of the sectors. Just in terms of a few of the things that we'd flagged before the open, Renault raised to investment grade by S&P. That's seeing gains of 0.8%. I'd said to keep an eye on the delivery stocks. DHL up more than 1% after you saw FedEx beating estimates. But not all of the names in that basket really making gains. The Austrian postal company, in fact, down 0.7%. We're waiting for Puma and Adidas. at the moment. And then BBVA was another one that I had flagged because of the buyback news, and actually they are up 0.7% at the moment, Anna.
Yes, I guess you might expect on the buyback. So yes, waiting for some of those sportswear makers to kick into gear. But in lieu of that, or as we wait for those, interesting to see that consumer products and services is the worst performing sector, with some weakness, not a huge amount, but a bit of weakness in some of those luxury names, as the team points out. So Christian Dior down by 1.9%, Burberry down 1.4%. Perhaps a little sense that maybe there is read across into anything that a business the size of Nike has to say about the Chinese market. Does that have an impact on our expectations for these luxury names? We'll keep that in mind. Adidas just opening, and it is down by 2% right now.
All right, well, let's get some analysis, shall we? Peter Oppenheimer, Chief Global Equity Strategist over at Goldman Sachs, joins us round the desk. Welcome, Peter, on this Friday.
Good morning.
And we had Mark Cudmore just a few moments ago telling us 2025 isn't over. Can we have a Santa rally yet?
Well, we've been having one, certainly, and there's still some time to go, as you were saying. So I think we're going to end the year pretty strong, and it has been an incredibly strong year, not all in a straight line, but I think the tailwinds remain with us as we move into next year.
OK, so in terms of those tailwinds, we were talking about the US CPI print. I wonder whether it made much of an impact on your outlook for Fed cuts and therefore US equities in 2026.
I don't think it's changed very much. The central backdrop, I think, is relatively benign for risk assets, for equities broadly. Look, you've got continuing economic growth, with the US in particular, in our view, likely to grow stronger than the consensus. But alongside that, we're seeing some decent progress on inflation coming down, and we're expecting inflation in most countries to hit their target rates by the end of next year. And that's going to provide the platform for some more rate cuts, particularly in the US and the UK, with some dollar weakness. And when you look at that combination, all things equal, that should be a reasonably supportive environment again for risk assets for next year.
And so you're constructive on stocks. Good morning to you, Peter. You're constructive on stocks in 2026, but you do see that there'll be lower index returns than we experienced in 2025. What's behind that conclusion?
Well, firstly, let's say, 2025 has been a remarkably good year. It's been a year in which most markets have made very strong progress, and indeed, as we've been arguing, most markets have outperformed the US, and that's been the first time that's happened decisively for 15 years or so. But given the scale of the rises that we've seen, much of it coming from valuation expansion outside of the US, we would expect profits to be the main driver next year. That's still going to deliver, we think, pretty decent returns, but not as strong as we've been seeing through the course of 2025.
Yes, and to your point, I mean, Euro Stoxx 50 up by 17% year to date, NASDAQ up by 19%, S&P 15%. Some of these European stock markets, I mean, the IBEX 35 up by 47% year to
Well,
date.
remember that those numbers are double that in dollar terms.
Yes.
So if you look at everything in common currency, many markets in Asia and Europe are up twice as much as the S&P.
Yeah. I was just about to say, if Guy Johnson were here, he'd say something very smart about if you turned it all into euros, how it would look different. But yes, but I wonder, so given that that's the case, that we've seen some of these markets really outperform the US this year, what does that tell us about the tech trade stateside and our expectations for 2026? What should we take away from, what should we expect to see in that particular sector?
Well, I think still positive, but what we've got to understand is that in the last 15 years, tech has been the only major sector consistently to generate high returns, driven by very, very strong profit growth. And that was reflective of an environment where the leading tech stocks were relatively capital light. And now, of course, we know that they're building up their capital spending at a tremendous rate. We still think that's going to generate good returns. And in fact, within the US, we're still looking at better earnings growth in the tech sector than the broader market. But the differences are narrowing. And of course, the valuation gaps are very large. So I think what we should expect, as we've seen this year, frankly, is a broadening out, more diversification opportunities. We've spoken about how that was reflected this year in a broadening of geographical returns. But we also saw it sector-wise. Tech did very well, but so, of course, did many value sectors, banks, utilities in many cases, some industrials and so on. And I think that's really reflective of how this ramp up in CapEx spending in the tech sector is beginning to move out into other sectors.
And some of that is part of that tech theme, isn't it? Because into financial services, into utilities, into energy, very much related. Are there other themes, though, if you want to insulate yourself? I mean, pharma did okay in the States this year as well, or globally, in fact. Is that, where are you looking for things that are maybe not quite so related to the AI build-out?
Well, I think we're seeing a broadening out of different styles. So for much of the last 15 years since the financial crisis, nearly every year and in every market, growth outperformed value. And that reflected consistent falls in interest rates, which really helped growth stocks re-rate. Of course, it reflected the dominance of technology profits, but also a lot of the value or more mature industries were facing very significant challenges. You know, banks had to delever and raise capital, many of them cut dividends and so on. We were seeing lower commodity prices, excess capacity in many industrial spaces. And I think that while the tech space is generating some high returns in those mature industries, so it is a bit related to technology, that's not entirely the case. I mean, financials are also benefiting from steeper yield curves and from ongoing economic growth. The fact that they have very strong balance sheets now. We're seeing a ramp up in fiscal spending in many places. Germany is an obvious example. Some of that's going into defense stocks. And we have very high savings rates in many countries, and some domestic stocks, particularly in Europe, which have lagged behind for many years, are beginning to see some stronger returns. So I think it is really broadening out.
So the AI benefits are spreading to other sectors, and there are other themes going on. But what about the downsides to AI? You know, if we get job losses, and I wonder whether you expect them, how does that affect other sectors? Consumers particularly.
Yeah, I think that certainly we are beginning to see some positive effects of AI in terms of productivity, especially in the US, and we expect that to continue through the next few years. There may be some increases in unemployment. Some of that might reflect the impact of AI, some may not. But I think that at the same time, we should acknowledge that private sector balance sheets overall are very healthy. That's true for banks, it's true for corporates, and it's true for households, particularly in Europe and Asia. And so I think there is still an underlying support with rising real wages for some improvement in consumption.
And earlier in the week, and it seems a long time ago with all the central bank action, we had the jitters around Blue Owl and Oracle, and I just wonder whether that volatility is going to really be a theme in 2026. The more we question the AI bubble, every time there's a little bump in the road like this.
Yeah, well, I don't think it's a bubble because although, you know, clearly AI and technology has been dominating the narrative, it hasn't actually this year been dominating returns. And of course, the balance sheets overall are very strong and valuations are not as high as we've seen in other bubbles. Nonetheless, I wouldn't expect returns to be in a straight line. We saw this year very strong returns, but bear in mind, you know, 6-8 months ago, we saw quite a big correction in tech stocks, triggered in part by the introduction of DeepSeek in China, and that sort of rattled people's confidence in the competitive moats around some of the dominant companies. We could easily see something like that happening again. Of course, these stocks are very big, particularly in the US index, and that could have an effect of triggering a correction. But I think that would be different from a significant broad drawdown, which really would require a more significant negative macro picture.
Peter, thinking about other global themes, I wonder how China looks to you next year, as it relates maybe to European stocks or to the global stock story. We're looking at some of the European athletics companies down today, the likes of Puma, Adidas, on the back of the Nike numbers. That's a sector that still has a lot of exposure to that kind of market, and the consumer there has been just sluggish for a long time. And there's a lot of political pressure for China to do something different and expand its economy. How does that play out for the companies that you're watching?
Well, I think there is a very strong theme in China of weak domestic demand, as you mentioned, but actually the overall economy is strong, and our views are above consensus for next year. A good deal of that is reflective of very, very strong exports, notwithstanding the impact of tariffs in the US. And China is extremely competitive and moving up the value curve in many of its exports. That has got a negative effect competitively, I think, for Europe, and that's reflected in a longer-term headwind that we see for the European economies. And indeed, that is going to be a struggle, I think, for some companies that are very, very tied to China domestic consumer demand. But, of course, many of these have derated a lot over the course of this year. And I think, again, selectivity is going to be a crucial part of the diversification story as we look into 2026.
Okay, Peter, thank you very much. Thank you for joining us. Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs. Let's check in on the core six then, some large heavyweight businesses that tell some good stories here in Europe. Schneider Electric up by 0.3%, often part of that AI narrative. Of course, everywhere else, though, we see red on the board. Not a huge amount, but red nonetheless. Let's check in with Chloe Melly. She's got our stocks on the move this morning. Chloe.
Good morning, Anna. Renault is up about 1.2% this morning after winning back its investment grade from S&P. So S&P has said that the company had managed to refresh its product portfolio and had also just done quite well recently. And so this is something that is now driving the stock. This morning it's managed to really expand internationally outside of Europe as well, and therefore that will boost volumes going forward. And therefore we are seeing that reflected in some positive movement in the share this morning. Moving on to some downward moves, and this time this is for Puma and Adidas. This is back on the back of the read across from Nike, with Nike flagging that there will be weaker sales for this quarter, the quarter that started on December the 1st, because of weakness in China in particular. So that doesn't bode too well for Adidas and Puma, given the fact that they also have a huge presence in China, a huge market in that region. And we are seeing particular weakness actually for Puma, which is down about 2.3% this morning. Moving on to DHL, which is up on the back of the read across from FedEx, which has reported earnings ahead of estimates over in the US. FedEx is considered to be really a bellwether for the economy. This is a company that has exposure to manufacturing, to retail, and therefore when it does well, it does kind of spell good news for the rest of a bunch of different sectors, and it does spell good news as well for that delivery sector. And we are up about 0.7% for DHL this morning. And finally, WH Smith is down quite a lot. Well, it was down quite a lot. This has now pared some of those gains after announcing that the UK financial regulator was going to open an investigation into the accounting error that had led it to overstate its results. So this is an accounting error that had led the shares plunging. It forced the CEO to resign, forced it to delay its results. And so now the fact that we have got a probe by the FCA is really the latest blow for the company. And so we are seeing a little bit of weakness this morning for WH Smith.
All right, Chloe Melly from our equities team, we thank you so much. And coming up on the programme, disappointing numbers and sales warning from Nike. We discussed the European read across. We will dive into the details next. This is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg. Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to the opening trade. We're 17 minutes into today's session. As you can see, it's slight gains across the European continent this morning. Flat to the upside on the stock 600. The FTSE 250 is the one that's letting us down this morning. It's down at 0.2%, but green elsewhere. We've discussed the read across to Adidas and Puma from Nike. Let's dive in, though, to the Nike story. Nike shares sinking after the company warned that sales are going to decline this quarter. The world's largest sportswear company blaming persistent weakness over in China, but also at its own Converse brand. So let's bring in Bloomberg opinion columnist Andrea Felsted for more. Andrea, you're looking at Nike shares down this year. Is it a Nike story? Is it a China story? It seems like from the other athletics names, this could be more than isolated to the company.
It's a bit of both. Nike is in the middle of a big turnaround. China is obviously weak in the retail luxury side. Hopefully it's coming back. But there's also been a big change in China. They're very into outdoors, outdoor lifestyle kind of wear that is really owned by Anta Sports. And Nike is seen very much as a kind of a fashion lifestyle brand with the Jordan sneakers and the Air Force One sneakers. And I kind of think those two things are working against it. So it's got to really do what Elliot Hill has set out his strategy to sort of win with sport, rediscover its kind of sport, functional, outdoor credentials rather than being seen as a fashion brand.
Yeah, it's funny that you say about the Jordans. We're kind of forgetting the Michael Jordan history and the athletes that made Nike into what it once was.
Yeah, and it seems to be that that's something that analysts have picked up on with regards to China, saying that the nature of the Chinese consumer has changed really quickly, and what they're looking for is a bit more technical, a bit more performance, rather than maybe what Nike had on offer in that particular area.
Exactly. It's become more of a fashion brand, and it really needs to discover those roots. But these things take time, and he kept saying about being in the middle innings, and what you're seeing with Nike is they're just really, he's been there just over a year, maybe takes 18 months to 2 years to get the products in, so he's just grinding through that change, and it is going to take time.
I mean, when you've got the likes of Hoka and On, how does Nike keep up with them when it comes to that lifestyle side of the equation, or does it just completely pivot to the sportswear athletes?
It's got to do a bit of everything. I mean, the way to think about Nike is, years ago, Nike and Adidas were everything to everyone. Now, gradually, all these other companies are sort of chipping away, and so he started with running, he started with performance. That seems to be working. But there is this whole huge lifestyle brand, this fashion element, and Nike really needs to win on both, because the biggest sneakers are the ones that start off in the gym, then they get tweaked a little bit, and they become massive on the street, and Adidas is really winning in that market. Nike's got to try and compete with the runners, but also on the fashion side.
It seems like today, I mean, some of those other athletics leisure wear makers are down on this, but not by, I mean, Adidas just down 0.3% or so. So we shouldn't read too much across from Nike into its competition here in Europe, do you think, Andrea?
No, I mean, the other thing with Nike is it is improving in North America, which is its biggest market, so that's important. It's also got this issue with Converse. I think they should just sell Converse. It's a distraction that they don't need. So it's also a big year for sport next year. So yeah, a bit of a read across, probably not, shouldn't be too much.
I feel like it's the same problem that Lululemon's having in a way, where they have to make stuff cool. I loved your column yesterday. You kind of put my thoughts into words that, you know, you've got aloe now and you've got Skims as well. How does Lulu and Nike end up, Nike, I should say, I'm British. How do they kind of get cool again?
It's all about the product. And what Adidas has done, what Bjorn Gulden at Adidas has done really well is he has come up with some great products. So when he came in, they were really reeling with from the Yeezy debacle. He noticed there was some heat around the Samba. He, you know, ramped up the production, got them out, and people loved them, and, you know, it became really, really big. And he's followed that through with other terrace styles. They've had the, you know, the ballerina sneaker, the taekwondo, the low rise. He's now talking about bringing the Stan Smith back. He's a whiz with product, and that's really working. And I think that's what Nike and Lululemon are both missing.
It's all about the product, all about performance. Nice message for 2026. Andrea, thank you very much. Bloomberg's Andrea Felsted from Bloomberg Opinion, of course. 8:22 here in London. Now, oil prices just a touch weaker this morning, down just 0.1%, so not by a huge amount. But oil is on track for its biggest annual decline since the pandemic, as a glut of supply stalks the market. Tankers filled with oil are idling on the world's seas, waiting for the market to pick up. For more, we're now joined by Bloomberg's Anthony DePaola with this story. Anthony, what's driving this surge in supply then? We've talked for quite a lot of months, it would seem, about how everybody fears this big wave of supply coming onto the markets and how that's been the dominant theme for oil pricing.
Good morning, Anna. Yeah, that's correct. A buildup of oil at sea or in storage is going to be a bearish factor for prices. And as you said, we have been expecting that for a long time, most of this year, in fact, and it's just kind of been pushed back as demand continued. There was a lot of great demand in the summer. We also have had lots of geopolitical uncertainty that's been buffeting the oil price, so that's been keeping things higher. But now it is appearing that this glut has finally arrived. We've got a lot of additional production that has been coming on, continued to come online from the Western Hemisphere. We've had Guyana starting production, increasing output. The U.S. is still a huge producer, even as we've seen some of those marginal barrels in the U.S. Drop off in terms of those producers, in the shale patch in particular, not being economical at certain lower prices. We still have seen growth, even if a little bit less than expected. So oil supply is continuing to grow, and it is outpacing the increase in demand. Demand, it should be said, go ahead.
No, I just wondered what the floor could be then. Before we talk about the demand story, Anthony, good morning, Lizzie here. For oil prices, big picture, how low prices could realistically go from here?
Good morning, Lizzie. Yeah, we are hearing discussions around the $50 mark. So we have dropped into the high 50s now, below 60, which is kind of a watershed mark for Brent to go below 60. We haven't been below and spent this much time below 60 for a while. We've been down there for a good part of this week, and so people are looking at it going even a little bit lower into next year, as we get a little bit more certainty about some of the geopolitical issues potentially, as this oil glut does materialize on the market. We've also seen OPEC Plus, which I should mention has also been adding production, lots of production this year. For example, the Saudis alone have added about 1 million barrels a day on their own this year, as OPEC Plus has eased those production constraints. Even OPEC Plus has decided to take a pause in increasing production in the first quarter because they have seen this glut coming, because anyway, these winter months are generally a shoulder season where we don't have huge demand. So we're going to assess the market as we get into this next year and see if it's going to be a really weak year and we are going to drop closer to that 50 mark, or who knows, geopolitical concerns could then pump that up again. But on the fundamentals, the market is looking long, feels long, and we're seeing that in the prices, Lizzie.
Okay, Anthony, thank you so much for joining us. Bloomberg's Anthony de Paula there. Happy Friday to you. As you say, Anna, we're looking at Brent weaker this morning, but only a touch, down 1/10% at $59 a barrel. Well, coming up on the programme, we're going to discuss plans for a European-backed stablecoin. Floris Klucht, digital assets leader ING Wholesale Bank, is coming on the programme next. We shall discuss that and the broader crypto story later in the programme, so do stay with us for that, as we're looking at the Stock 600 flat to the upside. Not doing much this Friday morning. This is Bloomberg.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life.
I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome back to the opening trade. 30 minutes then into our European session, and maybe this is what we need at the end of a really busy week, but we're not going anywhere very quickly. It would seem the best way to sum this up here in Europe. We've got a couple of markets, 3 markets in the green, 1 in the red, but really no change across these European equity markets, Lizzie. It's been an incredibly busy week. We've had data aplenty from both sides of the Atlantic. We've had a focus on the central banking story here in Europe, over to the BOJ. Quite a sizable move in the yen, actually. Yen weakening as Governor Ueda didn't stand in the way or didn't add to any hawkish expectations, certainly within that market. So, you know, I'm talking about the BOJ, Lizzie, because really there's frankly not much to say about this.
Well, I can't promise you much on my board either, Anna. It's very balanced, really, when it comes to the members higher and lower on the stock 600, which makes your picture make sense that really we're pretty unchanged when it comes to the broader index. The volume is higher this morning, perhaps surprisingly for a Friday, but let's flip the board over and you can see who some of the winners are this morning. In terms of the leaders, we've got Roche, Rolls-Royce and Total. Perhaps what you would expect for Rolls-Royce, given the news we've had on defence and the agreement on funding when it comes to Europe backing Kyiv. But flip over to the laggards picture, and we've got some of the tech names, SAP and ASML, in the red this morning. Unilever also down 0.4%, Anna.
Let's get an update on some of the other stories that we need to know this morning. Let's start with the news about Ukraine. European Union leaders agreed to loan Ukraine 90 billion euros for the next 2 years to strengthen Kyiv's hand and keep the war-torn country afloat. The EU will fund the loan through joint debt raised on the capital markets and backed by the bloc's budget, rather than using Russian assets frozen on European soil. The Bank of Japan raised its benchmark interest rate to the highest in 30 years. The BOJ made it clear that the hiking cycle will continue by asserting that it intends to keep raising borrowing costs if its economic outlook is realized, adding that the chances of that happening are increasing. And TikTok says it has signed deals to create a US joint venture, majority owned by American investors. An internal memo seen by Bloomberg from the CEO, Shu Chu, tells employees that agreements have been made with Oracle, Silver Lake and MGX. Oracle shares jumped in after-hours trading on the news. The new venture will operate as an independent entity that will control data protection, content moderation and algorithm security in the United States. Chinese regulators have yet to say whether they will approve the deal. And Lizzie, this has taken quite a long time, hasn't it? We talked for a long time about how they were going to resolve this tension geopolitically between China and the United States. President Trump was involved. Seems a deal has been done. And of course, Oracle at the centre of it. Oracle seems to be at the centre of every tech story right now.
Yeah, there's that squiggly diagram that shows us that everything seems to lead back to Oracle, doesn't it? Quite worrying for AI funding when it comes to that. But look, we don't know, as you say, what China's opinion is on this when it comes to TikTok. If it's approved, hopefully it would fix that issue in US-China relations and signal progress there. But of course, we await China's opinion on it.
Yeah, absolutely. We'll wait to get that perhaps into the new year. Let's pivot back to Europe then. Work to launch a euro-backed stablecoin will step up in the new year. Kivalis is the consortium of banks behind the digital asset, and Floris Lucht is digital assets lead at ING, and he will become the Kivalis CFO in January, and he is with us this morning. Floris, really nice to speak to you. Thank you so much for giving us your time. So tell us a bit about the consortium. The consortium includes lots of European banks working towards this euro-backed, euro-denominated stable coin platform. Talk about the progress. Are you still launching in 2026? What do we expect?
Yeah, indeed. That's the ambition. And indeed, we right now have a consortium of consisting of 10 major European banks. That is expanding, by the way. So we have the ambition to grow that consortium because we want to create one European standard euro stablecoin that will be used and distributed by European banks. Right now, where we are, so we launched the consortium several months ago and incorporated Kivalis, the new company that will be dedicated to the issuance of that euro stablecoin. So right now we are in the middle of developing that company. So hiring the management board, the supervisory board, the staff members, developing the tech platform and the risk framework. So yes, we do want to launch in the second half of the next year.
Okay, second half of 2026. Now, the US has moved ahead with dollar stable coins, of course. That's been boosted, in particular, recently by the Genius Act from the Trump administration. Why does the world need more stable coins? Why does the world need a euro stable coin, Floris?
Well, we believe the euro stablecoin or any trusted regulated stablecoin will be building blocks for new digital, meaning on-chain payment and financial market infrastructure. So transactions on-chain settle 24/7 globally and instantly. And what's more, they enable programmability of transactions. So this enables a huge range of new efficiency benefits as well as new innovative use cases that as banks we want to unlock for our clients and that we haven't managed to unlock yet. And the stablecoins are the trusted means of payment and settlement then on chain. So that is one of the key building blocks that need to be developed.
I wonder why then euro-denominated stablecoins, Floris, haven't taken off so far. And in terms of your geographical ambitions, why it's only Citi that's the only non-European bank in the group so far?
So to clarify, Citi is not one of the 10 consortium banks. So far, it's only European banks that have joined. But yeah, why in particular a euro one? Well, because right now stablecoins are predominantly used in crypto trading and DeFi markets, and we want to make our euro stablecoin available for those markets as well. But we believe that going forward there will be a lot more growth in payment markets as well as in settlement of tokenized asset markets. These markets exist already based on stablecoins, but we believe they will grow significantly going forward. And the key step to doing so is that banks will enable these kind of solutions and use cases for their clients. And that requires the banks to develop a new set of products, like offering a wallet, or like offering custody to their clients, offering liquidity management, FX, programmability of transactions. So that is still at an early stage for most banks in Europe and across the world, actually. And we believe that development is essential to really unlock these payment and settlement use cases. And that is when the euro stablecoin will really significantly grow, as will other stablecoins.
Well, yes, some banks are already going ahead and issuing their own stable coins. I'm sure you'd prefer those tokens were on your platform. But Floris, what if that liquidity is fragmented?
Well, that's exactly what we want to prevent by setting up a consortium, indeed. So if every bank or other institution would issue its own euro stablecoin, it will not help our clients, we believe, because it will be very difficult for clients to navigate that field. And it will absolutely not be efficient. And you create fractured infrastructure, and same for liquidity, indeed. So by setting up this consortium, we want to create one European standard. And we want to manage that consortium as a utility. So Kivalis, the stablecoin issuer, we do believe it will over time be profitable, but profitability is not the main driver. We want just to develop a piece of infrastructure. So just the conversion of the fiat euro to the euro stablecoin to enable these solutions on chain. And then the real profitability should come from the banks that offer these new solutions to the bank's clients. So we believe we need one European standard and avoid this fragmentation.
Yeah, so that's other banks that might want to, or some of the banks in Europe that maybe are already tempted to do their own thing, Floris, and you would like to see them maybe come into line with your plans. What about what central banks are doing? How does your project sit alongside, for example, the ECB's digital euro plan? Are they aimed at different audiences? Because, I mean, in the United States, the focus is on private stablecoin solutions. You're also in the private sector, but the ECB has its own plans.
No, exactly. So we believe that our consortium stablecoin is complementary to the digital euro that the ECB is developing. So first, the digital euro, there are currently no plans, as far as we are aware, to issue that on blockchain. So for specific blockchain solutions, which we are focusing on, it's not a suitable instrument. Plus, it focuses primarily on retail payments within Europe. And that is not a focus area that we are having right now, because we believe retail payments in Europe, that infrastructure is robust and efficient already. And there is no client demand that we see, at least, to replace that with a new infrastructure. The digital euro is focused on that right now, which is, of course, perfectly fine that ECB has its own plans and ambitions there. But we focus really on those use cases, which are now much more difficult with today's infrastructure. So, for example, cross-border payments, and like I mentioned already, settlement of tokenized assets, which are really the on-chain benefits.
Floris, it seemed in the past that banks in Europe, but maybe even globally, had been a bit worried that stablecoins and the digital euro project from the ECB could drive away deposits from the banking sector and put them elsewhere. But now we see the banking sector embracing the stablecoin idea. Is that a fair reflection? And what's changed?
Well, indeed, it is being embraced right now, and there is this concern indeed because banks use the deposits that are received from clients to fund lending assets, obviously. So it's important not to undermine the funding base of banks. But at the same time, we see that there is an opportunity here to serve our clients better, which is essentially the ambition that all the banks have. We need to keep in mind that the stablecoin is a means of payment and settlement. So it's not meant to generate any yield. Also, under EU regulations, it's not even allowed for stablecoin issuers to pay any yield or any interest on the stablecoin. Therefore, by having banks in the lead in this market, we believe that we can manage it in such a way that it serves our clients while also making sure that it doesn't interrupt the lending capacity of banks. And that is indeed a bit of a concern for banks, that if fintechs dominate that market, that don't have this same concern for European funding to fund the European economy, essentially, that could be disruptive in a way. But that's not the main reason for banks to step into this market. We believe this is a new opportunity, and we want to unlock these benefits for our clients, which is the main driver.
Okay, Floris, really great to have you on the programme this morning. Thank you so much for joining us. Floris Lucht, Digital Assets Lead at ING Wholesale Banking and soon to be the Quivalis CFO. Well, let's get more on this now. We can bring in Bloomberg's Senior Editor for Crypto, Anna Herrera. Good to have you with us, Anna, to get a bit more context here. I just wonder how stablecoins are going to affect demand for treasuries as all of this progresses.
So obviously in the U.S. or in general, stablecoins are traditionally pegged to an asset like, the U.S. dollar. And the way they work is that for each dollar you give to a stablecoin issuer, they give you a stablecoin back. And they invest those reserves in highly liquid assets so that you can get your dollar back if you need to. And generally this goes to treasuries, right? And so this has created a very big demand for U.S. treasuries. If you think about stablecoin, the biggest issuer right now, they have billions in treasuries, and that's leading them to generate lots of profits. So part of the reasoning of why the U.S. has been very favorable of stablecoins is that they think it's going to drive up or diversify the demand for their debt. So it's not just other countries, but it's also issuers like Tether.
Yes, indeed. And there's been, good morning to you, Anna. Yeah, there's been a lot of debate, hasn't there, about whether this is really going to sustainably drive up demand for treasuries or if it just takes it from other sources. But that one will no doubt run into 2026. In terms of that Euro stablecoin initiative we were just talking to Floris about, we finished there talking about the way that the banking sector does seem to have changed its mind or learned to embrace stablecoins in a way that it hadn't previously. What do you think is driving that?
I think definitely the Genius Act and the big change in the U.S. With Trump, they weren't sure before whether they were going to do a digital dollar, much like the digital euro, so sort of a Fed digital dollar. Instead, they've decided to go all in on the private sector, and we've seen American banks, we've seen American fintechs launch or think of launching stablecoins. So there's now the potential that you might see dollars flooding other countries with stablecoins that exist now. We have many instances of holders in countries where the currencies are very volatile or the countries are very prone to inflation. And so you could think that it's not just going to go to emerging markets, but could come to Europe. So there's a concern, also competitive threat a bit for the banks here. So before they were a bit concerned about deposit flight to the digital euro, and now maybe they're also a bit concerned that their competitors, American competitors and rivals, might start bringing dollar stablecoins in.
And Anna, speaking of volatility, we've got Bitcoin volatility really rising ahead of this $23 billion options expiry. Just walk us through why there is so much intense pressure on Bitcoin into these final weeks of 2025.
I think it's been a wild ride as usual with crypto. The big difference in Bitcoin this year is that, as I've said, and we've been talking a lot about, the environment, it's been a very favorable general crypto macro environment, in the sense that there's been a lot of support from regulators, especially in the US. We've seen big players come in. And so there's this big contrast, and it's a bit jarring to see that Bitcoin has fallen in these last few months. So I guess we'll have to see towards the end of the year whether it can pick up. It's more likely to stay range bound, we're expecting, but with crypto, as I always say, you really never know.
You really don't. I mean, we have seen selling by long-term holders, haven't we, Anna? I wonder, and this is Bitcoin specifically, how does Bitcoin sit alongside its competitors? Is there something else happening here? I mean, we just spent the last 10 minutes talking about stable coins, for example. Is there something else happening in the digital landscape that we need to be aware of when thinking about this weakness in Bitcoin?
I think, again, Bitcoin is the one that everybody focuses on the most, and largely because we've seen it's been there for longest. It's one where, institutional investors are slowly coming in. It was also the year of meme coins, which are the ones that are extremely volatile, but it's still not, those ones are even harder to predict. They tend to move on news or sentiment. But, Bitcoin is the one that has achieved more of an institutional status, in part because of the ETFs that have drawn in a lot of money from retail investors, but also, it's starting to bring money from institutions.
Anna, thank you so much. Thanks for joining us. Bloomberg Senior Editor for Crypto, Anna Herrera. Coming up on the programme, European Union leaders have agreed then to loan Ukraine 90 billion euros after failing to break the deadlock over using Russian assets frozen on EU soil. They have found a different solution. It's a loan. It's going to be funded by debt. We're live in Brussels with the details next. This is Bloomberg.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. The reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks happening everywhere, and that's what AI is most helpful in improving.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
8:50 a.m. in London, and we end the week with European Union leaders having reached an agreement on a loan to Ukraine after marathon talks at a summit in Brussels. The EU will raise joint debt to loan Ukraine 90 billion euros for the next 2 years, and across all of it has been Bloomberg's chief Europe correspondent, Oliver Crook. Ollie, just break down for us what this agreement means.
Lizzie, this is not an intensely simple thing to understand for what the Europeans have come to yesterday after 16 hours of negotiations and trying to figure out a way to get that bridge loan to the Ukrainians so that they don't run out of money by the first quarter, which is what we've been told by Zelensky. Zelensky telling me just a month ago that this is a question of survival, them getting that 90 billion euros. So the solution that the European leaders have found yesterday here in Brussels, I should say, and into this morning, is to basically have a joint debt-funded 90 billion euro loan to the Ukrainians, backed by the European budget, but a loan that they will only have to repay if the Russians pay them back reparations. So this is a way, in a certain sense, to sort of make a delay on any kind of real decision on the frozen Russian assets, because the Europeans will say if the Russians do not pay back those reparations, it is actually from the frozen Russian assets that money will come to, and that is how that loan will be repaid. So this sort of solves a lot of the problems. It sort of goes around some of the main issues that Belgium has. We should say that the loan is going to be backed by all of the European member states, with the exception of Hungary, the Czech Republic, and Slovakia. So what it manages to do is to bridge that financing for Ukraine while basically deferring this decision on the frozen Russian assets. Depending on who you ask, this is really either a very elegant solution or a really sort of convoluted can-kicking to try to not make the more sort of complicated decision as to what to actually do with those Russian assets.
Yeah, it's really interesting how some of those European countries do get that carve-out from contributing. Ollie, what could this decision mean for the peace negotiations that are obviously ongoing? There had been US pressure not to use the frozen Russian assets for this very reason.
Yeah, that's right. The U.S. really wants to use these frozen Russian assets as part of their own architecture for peace, their own rubric for trying to bring Russia to the table. We heard some sort of really kind of, I think from the European perspective, outlandish plans on how to do that in the original 28-point plan. But this in some way sort of preserves that conversation, leaves the Russian assets on the table. It leaves that tension in the air, saying that the Europeans could move on these assets at any sort of given time without escalating the situation. And we actually heard from Kirill Dmitriev, who's the head of the Russian Sovereign Wealth Fund, but who's also been spearheading the peace negotiations with Steve Witkoff in the various talks that they've had. He's said, as this sort of plan emerged to not take the Russian assets, he said that if that is true, shelving the EU's original proposed illegal scheme to tap Russian foreign reserves to fund Ukraine is a major win for law and common sense and for the voices of reason in Europe that protect the EU, the Euro, and Euroclear. So from the Russian perspective, we haven't heard a great deal yet from the outcome of this decision, but that sort of initial take from Kirill Dmitriev sort of suggests that the Russians, this is a solution that they can live with, and this sort of still does leave the path for diplomacy open for them to discuss those peace talks with the United States.
Oliver, thank you very much. Bloomberg's Chief Europe correspondent Oliver Crook joining us there. Now, the delayed US CPI report, back to the markets and the movement of this week, showed core inflation at a 4-year low, but with October's data absent, economists have warned of anomalies, huge anomalies in the report. Despite that, the Chicago Fed President Austin Goolsbee said there was a lot to like. Let's bring in Valerie Teitel for her analysis. Valerie, does this end here, or do we keep talking about this very flawed and full of holes CPI report into next week?
Well, look, if next week's a quiet week, I think there's still going to be a lot of debate on what exactly happened this week. We had not only an extremely noisy non-farm payroll report, but then a double CPI report that left a lot of blank holes, essentially, and a lot to be chewed over about what the BLS how they're going to handle the data distortion for months to come from the missing October CPI reports. Now, I think there is some comfort given to the market that Fed's Goolsbee did say that there was a lot to like in yesterday's report, so he was still able to make a conclusion from the noisy report. And he did say that he thinks rates can go down a fair amount if inflation does stay on track. And that is interesting, Anna, because he was the main new dissenter in the decision a week ago, and he's coming out and saying that at least yesterday's CPI report is enough for him to maybe flip his mind and thinking that they can reduce interest rates in the first quarter of next year.
Okay, so the year very much is not over when it comes to the data and the Fed speak. Val, stay with us. Bloomberg's Valerie Teitel there. I want to switch gears to Blackstone's annual holiday video. It's back, and this year the firm's 40th birthday, sparking an over-the-top midlife crisis.
Turning 40, it's a really big deal.
Did you get a nose ring?
I've always had this.
Some of us are in denial that we've become a mature organization.
Hey, guys, let's start buying sports teams.
We could buy Ferraris.
No, let's
buy a Ferrari.
Yeah, we're definitely having a midlife crisis. Wait, are we rolling?
Even Steve's going through it.
Well, I was thinking of becoming a DJ.
Steve Schwarzman, a DJ? He'd crush.
I really don't know what to make of that.
Just what we need, more finance DJs. I mean, what I made of it, I think, and the people in this video know well, I mean, 40 is a bit, is that a little young to be having a midlife crisis? I mean, maybe they got more years of crisis still to come.
Do you know what? I think it's commendable when CEOs have outside hobbies. You know, you try to interview them about what they do outside of work, and there's never that much. Look, in terms of what we're all up to this weekend, let me tell you what's on the weekend agenda. You've got the night of the proms in Cologne, Avatar. Is it Avatar 3?
Yeah, there's a third one.
That's coming out. You've got some alpine skiing.
That's in there for Guy.
And it's Christmas market season. That's for Val.
Well, maybe Val's into the skiing. Or maybe not. Maybe that would be dangerous. The skiing is in there for Guy. There always has to be sport. That's one of the unwritten rules about the Weekender. Speaking of the weekend, Bloomberg Weekend newsletter, of course, is available. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Beirut, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Astonishing day for U.S. technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
The EU greenlights a €90 billion loan to Ukraine after plans to use frozen Russian assets fails, despite marathon talks in Brussels. Governor Ueda strikes a cautious tone after the Bank of Japan hikes interest rates to a 30-year high. Plus, Nike tumbles as the sportswear giant struggles to get back on track in China. Let's get to the markets right now then. Futures on a day when we're starting to see lackluster moves across Europe, and the sentiment that came through on Wall Street and overnight in Asia is petering out when you look at the European session. US futures pointing to modest gains over 0.3%, looking to build on the upside for the S&P 500, which logs gains of around 0.8%, but still on track for a second week of losses. We'll see how that turns out, of course. Nasdaq 100 gained close to 1.5% by the close yesterday, and we'll see how that transpires with tech once again in focus. The US 10-year at 4.13, the inflation data out yesterday, giving some a little bit more ballast to push forward in terms of bets on the Fed for next year, but with all the caveats around the messiness of that data print. 4.13 right now on the US benchmark 10-year. The yield's up close to 2 basis points. The Japanese yen is in focus, of course, with the BOJ hiking rates to 0.75%. As expected, the commentary from Governor Ueda, some market participants not convinced that they can go that much further. 156 then, as the Japanese yen weakens, down by 0.9% versus the greenback. $60, below $60 a barrel right now on Brent, 59.74, softer again by 0.1%. Let's have a look at the breakdown then across the map. The FTSE 100, the last time I checked, was flat. That remains the case. Similar picture for the CAC 40, the IBEX as well, and the DAX just down 0.1%. The FTSE MIB over in Italy, slightly brighter, up 0.2%. But there seems to be a market on the last, of course, full trading day of the year, looking for the next catalyst. We know that volumes will be thinner, of course, at this time of the year. We're checking in on some individual stories that are much more interesting than the broader picture. One is Nike. Look at that then. Pre-market down almost 11%. Concerns about the China story on the earnings impact that came through yesterday. The China story has not turned around for Nike, and the Converse brand is still struggling. The inventory build-up is the challenge for Nike, so selling off pretty sharply pre-market. Let's split the board and have a look at Oracle. This, of course, has become something of a canary in the coal mine around the build-out of AI, but the story today for Oracle is the role that it will be playing in running the TikTok business in the US. Called higher by 6%, almost 6% on the back of that story. You'll get more details on Oracle and TikTok through this show. So, for the conversations and the analysis that matter, let's get it all started.
Newsmakers and market movers. This is The Pulse.
Good morning. Welcome to The Pulse. I'm Tom McKenzie in London. Happy Friday, everyone. The EU has agreed then to lend Ukraine 90 billion euros of its own funds after failing to reach a breakthrough on using frozen Russian assets. Following marathon talks in Brussels, French President Emmanuel Macron said Europe will need to find a way to directly engage with Russia. Let's get more with Bloomberg's Oliver Crook, our chief Europe correspondent. He's on the ground for us in Brussels, following all of this, of course, for us. Ollie, tell us about the nature of the loan and the failure to really use these Russian assets.
Yeah, well, Tom, depending on how you see it, you can see this as a failure and a success. And I think that that is exactly the line that the Europeans wanted to tread, and basically saying that, you know, on the one hand, yes, the Russian assets are still being held, and technically speaking, in the longer term, they're backing this loan, but they have sort of capitulated from the original plan, because that 90 billion euro loan to the Ukrainians, which will be at zero interest, which will fund Ukraine 2/3 of the way for the next 2 years, will be backed by the European budget, by joint debt, not primarily by the Russian assets. Now, what the Europeans have said in the way to sort of fudge this is that in the longer term, the Ukrainians will only have to repay this loan if the Russians pay reparations to Ukraine. If the Russians do not do that, then the Russian assets are back in play. So this sort of solves the problem in some respects for the Europeans. The first thing it does is it does bring financing to Ukraine, which we know is very desperate for that money, that they run out of money in the first quarter of next year. So it solves that problem. This circumvents some of the issues that Belgium and some of the other member states of Europe have had, such as Hungary, Slovakia, and the Czech Republic. Those three, for example, are carved out from sort of having any backing to that loan. They're exempt from having to back it. And the third thing that the European member states can say, sort of truthfully, is that this risk does not sit on their balance sheet, but that's not quite the full story. So it's a little bit of a complicated process. Depending on how you look at it, this is an intensely elegant solution to a very complex problem, or it's a really complicated fudge to something that they have just decided not to make a decision on quite yet.
So there are still question marks then, Ollie. I mean, what happens? We have this 2-year time frame then in terms of the loan, tying Ukraine over for that period of time. What are you watching for next? When does that loan get dispersed?
Yeah, well, so they're going to need to disperse that loan very quickly because, as the Ukrainians have told us, they basically run out of money in the first quarter. And when I spoke to Zelensky basically a month ago, he said that this money is a matter of survival for the Ukrainians, their ability to withstand the pummeling from the Russians that we've had over the last couple, well, certainly the last couple of months, more intensifying, but over the last few years. But what I think is interesting is how this is going to play into the peace negotiations. We expect those peace negotiations to resume over the weekend between the U.S. and the Russian delegation after that 20-point plan got a sort of makeover by the Europeans and the Ukrainians. What we're looking for now is the reaction to the Russians to this European plan. We've had just a sort of glimmer of that from Kirill Dmitriev, who's sort of the lead negotiator from the Russian side on the peace negotiations, also head of the Sovereign Wealth Fund. He came out on Twitter when we started to see that the Europeans were not going to actually seize the assets, but we're going to go with the loan. He said, if true, shelving the EU's originally proposed illegal scheme to tap Russian foreign reserves to fund Ukraine is a major win for law and common sense and for the voices of reason in Europe that protect the EU, the Euro, and Euroclear. So if we have any sort of reaction from the Russians, and if that is anything to go by, a sort of positive reaction for the Russians, on the one hand, this leaves the sort of path open for conversation, for dialogue, for the peace proposal, while still leaving the tension in the air because those Russian assets are still frozen and the Europeans can still move on them.
Okay, Oliver Crook, Bloomberg's chief Europe correspondent, with the details of that loan, the implications for those peace negotiations, of course. Ollie, thank you. Let's get to macroeconomics now and monetary policy because, of course, the Bank of Japan has raised interest rates and the governor says the benchmark interest rate remains some distance from the lower end of the neutral rate range. Earlier today, the central bank, of course, raised those rates then to the highest level since 1995.
It is difficult to determine the neutral rate in advance, and it is necessary to consider it within a fairly wide range. On that basis, we believe it is appropriate to continue monitoring how changes in short-term interest rates affect the economy and prices, while exploring the level of the neutral rate and adjusting the degree of easing accordingly.
Okay, let's bring in Paul Jackson now, our Japan government and economics editor in Tokyo. Paul, just make sense of this for us then. The rates increase as almost fully expected to 0.75%. Yields are up, but the Japanese yen is down about 0.8%. And the Bank of Japan is saying they still have scope to increase rates further from here. Just make sense of that picture for us.
Yeah, well, I think it was so telegraphed in the rate hike that it was all about, the forecast, the outlook for where rates might go. And in Japan, Japanese media has been fixated on this neutral interest rate concept, thinking, well, Governor Ueda is an academic, he likes the textbooks. Maybe this prescription of finding the neutral rate, which neither stimulates nor restricts the economy, that's kind of the end game for your rate hike cycle. So he referred to it in Parliament recently, and so there was a lot of attention on, is he going to use like this neutral interest rate estimate as a way of giving guidance on where rates might go in the future. And I think that the takeaway from what he's repeatedly said is no, I don't want to use a textbook. That's a very interesting theoretical concept. Of course, we do need to understand that. But in the real world, it's all about pragmatism. You go up a little bit, you see how the economy responds. If it's still growing, it means you can go up again. And that's the view that is repeated today. And clearly, for the traders out there in the markets, that wasn't enough.
Okay, so that's the market reaction, Paul. What about economists? How has the view been adjusted on the back of today, what we've heard at the press conference, in terms of how to think about future hikes, if indeed they do come through? I read one piece of analysis saying maybe it's going to be at a 6-month cadence.
Yeah, I mean, I think that is the overall consensus amongst economists and market participants, really, is, once every 6 months he hikes. That's maybe as fast as he can go. Could get slowed down a little bit. We've got this expansionist Prime Minister, Sanai Takaichi, in power. She might get cold feet or want to disrupt the rate hikes if the economy tanks. And this is something that the Bank of Japan has done in the past by going too fast with rate hikes. So that's certainly got to be on his radar as he goes forward. But I think, he's repeated his message over and over again, if the economy develops in the way we expect, we are going to continue to raise rates. So really, there was enough there to suggest that rates will continue to go up, even though the market moves suggested otherwise.
Paul, thank you very much indeed. Always excellent analysis in terms of the BOJ and how to think about things in the path forward. Currently, the Japanese yen down 0.9% at 156, closing in on 157. Paul Jackson in Tokyo, thank you. Now, for more on the BOJ and wider markets, we're joined by Michael Metcalf, Head of Macro Strategy at State Street Global Markets. Michael, always great to get your insights as well. So let's start on the BOJ then. Are you convinced that this is a BOJ that has the space to increase rates further from here? And what are you thinking about in terms of the so-called neutral rate for the BOJ?
Well, I think that question that you started with, Paul, about why markets have reacted the way they did, I'm pleased you asked him that, not me, because I think Ueda did everything that he should have done in terms of signalling that hikes are coming. He's never going to be direct enough to say, I think the neutral rate is at 2 and that's where we should go, because he's not going to pre-commit to that. Nevertheless, I think this was a change. If you think about where the market was 2-3 months ago, it was the idea that the change in government would mean that the BOJ would have to be more dovish. And that, I think, clearly isn't going to be the case. I think that the policy settings in Japan is going to be stimulative fiscal policy, which means that rates do need to go a bit faster, which means 1.5 and above. And that isn't yet fully priced in the market. So I think despite the market reaction today, I do think we're going to get tightening in Japan, and I do think that will ultimately lead to a strong yen.
And you think rates ultimately 1.5 and above?
Yeah.
And in what kind of time frame?
Well, so I think to Paul's point, the BOJ has been and continues to be quite cautious. I think if they have the inflation to justify it, which they currently do, it's not impossible that they could start to go in quarterly increments. And maybe that would... The market reaction today, I think, will be disappointing for them, and they'll be surprised that the market has reacted that it's a dovish hike, which I think his commentary suggests that it isn't. But look, I think sometimes we overread intraday market reactions, which in thin markets like today, it could just be that the market's quite thin and there's been a few flows that have gone the other way.
That's really fair.
So we shouldn't extrapolate, I guess, is what I'm saying.
But what you do see is a picture of narrowing rate divergence between the Fed then and the BOJ. And so my question then is, what does that do to capital flows? I mean, we're seeing a little bit, some modest selling in European sovereign debt and treasuries today, and some are linking that to the rate increase by the BOJ. What does that do to capital flows? I mean, how much is that a risk for the sovereign debt of the Eurozone and the US?
Everywhere. Yeah, I mean, look,
how challenging would that be?
So I think in kind of all the year ahead outlooks, there's always this question. So everyone always favors Japan. They're always waiting for Japanese rates to go up, and then also the impact of that of Japanese investors to bring money home.
Yeah.
And look, I think what we can say is that so far the experience of 2025 is they have not done that yet. But it remains a risk going forward that they will. I mean, look, rate differentials are still favoring, to some extent, Japanese investors to put some money abroad. But it would be surprising, given where long-term Japanese yields are now, that you don't get some repatriation and we don't eventually get this correction in what is still, by far and away, the most dislocated market right now is the Japanese yen and its valuation. And so at some point, we're going to get a correction in that.
Let me get to you to the UK then. So inflation in the UK is down, growth is down, unemployment is up. Is the BOE behind the curve?
Well, not yet. I think you can understand why the BOE has been cautious, simply because of where wages have been, and inflation has been sticky. But eventually you'd expect the weakness in the economy and the weakness in the labour market in particular to drag both of those things down. So, I actually think the market is a little bit underpriced for UK rate cuts right now. And we could get more rate cuts next year than the market currently prices.
2? More than 2?
Yeah, 2 or 3, or maybe even 3 or 4 actually, because I think that the weakness of labour market demand in the UK is very clear. The UK is a standout on things like job postings and metrics like that. That the labour market here is much weaker. So I think eventually you will get.
We could be below 3% then by the end of next year. On the if we get 4, we're at 3.
Yeah, I mean, I don't think it would be our central scenario, but there is a risk that if the economy weakens further, then clearly the risks are all skewed to that side, I think.
You've talked about the need to look for hedges in 2026. In 2026, investors need to be ready for a range of outcomes and be ready to hedge accordingly. What are your favourite hedges?
Well, so I think, look, our concern right now is we go into 26 with investors' allocation to equities very stretched relative to bonds. And you know, when we look at what typically happens next, you either have very good scenarios, which is the kind of the pre-bubble stuff, or very bad scenarios, you know, which is obviously the bubble bursting. And so, you know, I think it's, you know, going into alternates and, you know, just reducing your risk on beta, because I think that's just the danger is that, and look, it's the same danger we went into 25 with, is that, you know, investors are very overweight risky assets right now, and we're going into 26 with the same level of holdings.
It's on AI, before we let you go, is Oracle now the canary in the coal mine for whether or not the AI momentum can continue? What are you watching for in terms of what could be a trigger point, either down or for further gains to reassure the markets on AI?
So I think the lesson from this year, and look, you know, every major earnings announcement has been a potential trigger point, and I think almost every time this year they've actually been a validation point rather than anything else. So you know, we capture the fact that investors are very overweight equities. Obviously, their biggest overweight is in tech. And so you can understand that investors lighten ahead of all the big major earnings announcements.
Yes.
And then every time they rebuild afterwards. And so, you know, I do think actually the story is relatively straightforward. It is earnings driven.
Okay.
And right now the earnings, and generally the news flow has been pretty positive. So
okay.
It kind of justifies the position, and it's hard to go against it. And that's the challenge.
Fantastic to get your insights as we close out and get towards the end of 2025 and look ahead to next year. Of course, Michael Metcalf, Head of Macro Strategy at State Street Global Markets. Michael, thank you. Coming up, money has been pouring into data centers amid that AI boom. We've just discussed it with Michael. We'll discuss what it means for the real estate outlook with Chris Brett, European Head of Capital Markets at CBRE. That is next. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
The conversations that matter, the insights you need. This is The Pulse. I'm Tom McKenzie in London. Now, the global property market is showing tentative signs of a recovery as easing interest rates bring back some of the conditions that powered the previous rally. This time, there's also huge demand, of course, for infrastructure linked to data centers and the AI boom, although some investors worry that the level of capex spent could be getting out of hand. One firm making a shift into operations tied to digital and power infrastructure is the commercial real estate company CBRE. Joining me now is Chris Brett, the firm's European Head of Capital Markets. Chris, before I get your take on AI and the spending boom there, just looking back on 2025, how has the year shaped up? What are some of the key themes that have come through for your space and your sector in terms of transactions and activity and where the regional impulse has been?
Sure. Good morning, Tom. 2025 had a little bit of a slow start, but as we sit here today at the end of Q3, volumes are up 8% year on year across Europe, which is clearly a good sign. We have been buoyed by the amount of debt capital that has been available in the markets across all sectors. And as we said at the beginning of the year, living and logistics would be the two sectors which captured the most capital around the region. That has been the case, but I think the surprise of the year, Tom, has been the interest and the transactional activity in retail, which is a really good sign for that sector, which has clearly had a very tough time during and post-COVID.
What do you think is underpinning that interest in retail, Chris?
Well, I think that very simplistically, it can't be worse than being closed, right, like it was in COVID. And actually, what COVID did for the retail sector was it really secured the balance sheet of a shopping centre, a retail park or a high street and those retail tenants. And that has given people the confidence that actually when they're buying a retail asset, the income that's underpinning those assets is exceptionally strong and perhaps stronger than it was pre-COVID. At the same time, the cap rate in the sector has moved out considerably, and just versus other sectors, I think retail therefore looks like a pretty attractive buy. Hence, we've seen that spike in activity during 2025. And Tom, we expect that to continue in 2026.
Okay, so the interest in retail continues in 2026. What about the office space? There have been some anecdotes, Chris, around the office space starting to tighten in London, some big name projects coming on board and some big tech companies looking for additional space and additional real estate and to be able to expand their headcount here in London, just as one example. Is office coming back, and does that momentum continue in 2026 if that momentum is there?
I think there's no doubt about it. Office is definitely coming back. And it's had a much better 2025, and we can feel that momentum growing in the sector. It's really been very underpinned by the strong leasing demand that you just referred to, actually, with companies looking to take more space. And we've seen the best buildings attract top-class tenants, and we've seen a very strong rental growth story. And this is evident across all parts of the market in both London and other major cities around the world. The investor demand has been a little bit slower than the occupier demand, but we're seeing that catch up now, Tom. And again, we see a lot of capital that is now focused on offices for the rest of this year and certainly into 2026.
We were just talking about the lower rate regime that we're starting to see. The Bank of England, of course, cutting rates, the Fed looking to cut further. Potentially, that's the market expectation next year. How supportive is that lower rate regime for the space that you operate in, and how much of a catalyst for next year?
Well, it makes a huge difference, right? I mean, and when you look at volume activity this year, volumes are slightly down on the UK, but they're much higher and up on 2024 across Europe. And you know better than I do, ECB rates have been at 2%, whereas UK's been at 4% up until yesterday. And so that differential in the cost of borrowing has clearly had an impact on investor demand and capital that's gone into our sector. But the availability of debt from mainstream banks, from alternative lenders, is clearly there, which is giving the sector a real confidence across all the different verticals within real estate that actually there is enough debt capital to go into 2026 with real confidence. What I would say, though, and we hope we try and learn lessons from previous cycles, that the debt capital and the loan-to-value ratios are much more in line with prudent investing versus when we went into the 2008 GFC, where clearly debt and leverage ratios got a little bit out of whack.
Chris, when we think about debt ratios and leverage ratios, we can think about AI and the building boom there. So I guess my question is, how is that reshaping your sector? And are there any red flags for you in terms of what is being built out, what is being committed, whether it's the lease agreements or anything else within what you've seen there that is causing any concern?
I think the biggest red flag, and I remember talking about this on your show earlier this year, is really not the demand from the companies and not the availability to actually go and build, but it's the planning regime, which is quite tough, and it's really around the power and the availability of power wherever we look in any geography. Can it sustain the building activity that we need for data centres to grow? So I don't think there's certainly as we see it today, there's not a red flag around data centres per se. What we are, though, seeing with data centres is, given the scale and given the amount of capital available and needed, we are seeing this merger of infrastructure capital with real estate capital coming together. And I think that is a really interesting dynamic that we're going to see play out even more during 2026 and beyond, Tom.
That's really interesting. Okay, so we look for that merger between infrastructure and real estate capital in 2026, and if that continues. Chris Brett, really important and interesting insights into the real estate space. Thank you, Head of EMEA Capital Markets at CBRE. Coming up, Swedish tech darling Lovable closing a fresh round of funding, tripling the value of the vibe coding startup to $6.6 billion. We're going to be joined by Anton Asika, Lovable's CEO and co-founder, for an exclusive conversation. That is next. This is Bloomberg.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question. I mean,
I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, it's just actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise.
With some fun along the way.
This is Bloomberg Surveillance.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Good morning. Welcome to The Pulse. I'm Tom McKenzie in London. Happy Friday. These are your top stories. The EU greenlights a €90 billion loan to Ukraine after plans to use frozen Russian assets fails despite marathon talks in Brussels. Governor Ueda strikes a cautious tone after the Bank of Japan hikes interest rates to a 30-year high. Plus, Nike tumbles as the sportswear giant struggles to get back on track in China. Pre-market, you can see that stock called lower by close to 10%. Now, the governor of the Bank of England has warned that the pace of interest rate cuts will slow as the BOE reaches the end of its cutting cycle. Andrew Bailey was speaking after the central bank voted 5-4 to cut rates by 25 points to a near 3-year low.
Now that we're on a path where we'll probably be around this level for a few months, but we think that come the spring, April, May time, we should see another quite sharp drop and take us, I hope, to around target. So we're going to come back to target sooner than we thought. So that's encouraging. All of this is very encouraging. And for me, certainly, it was a strong basis to cut today. It's the 6th cut we've made. Now, looking forwards, I do think we'll continue to have something of a gradual downward path.
Well, for more on the key central bank action we've seen over the past 2 weeks, let's bring in Vanya Stavrakeva, Assistant Professor of Economics at the London Business School. Vanya, great to have you in the studio. Thanks for coming in. What is your kind of takeaway from the central bank action that we've had so far this week? So the BOJ hiking as expected, the BOE cutting as expected, the ECB on hold as expected, and yet you lift the hood and there's significant divergence on views and on the path forward for all of these central banks.
So thank you so much for having me. Indeed, central banks are again front and center in the news for very good reason, and there is significant heterogeneity. So let me start maybe with Bank of England, and there are some parallels that I'm going to draw with the Federal Reserve. One of the main problems that Bank of England is facing is, of course, inflation is still elevated, the unemployment rate is picking up, and there are a lot of fiscal forces that are not helping the central bank. What do I mean by this? We recently had significant increase in taxes that are actually propelling wage growth due to higher minimum wages, higher national insurance contributions, so that is not helping tame down the inflation. On the other hand, the unemployment rate is increasing as a result of those fiscal forces as well. Another big problem, both for Bank of England and the US, is significant divergence in terms of view of what is the long-term natural rate. So what are we converging to? So when we have a discussion, is it going to be another 1 or 2 cuts? We need to know what is the consensus. Now,
here we're talking about the rate that is neither stimulative nor tightening.
Exactly. So if you look at an interesting report that the Federal Reserve publishes, which is the summary of economic projections, they tell you all the different FOMC committee members, where do they stand in their expectations of the long-run natural rate. So usually a very important number there is this kind of centrality tendency measure. So you remove the top 3 outliers, the bottom 3 outliers, and usually we find that spread is very narrow, right? It's only 2-3 basis points. At the moment, we are talking about a range in the US between 2.8 and 3.5. So how do we know
2.8 and 3.5?
Exactly. So even in the long run, there is massive divergence, even once we remove these outliers. So we're talking only about the middle 6 members of the committee of where we're going towards. So what does this mean for asset prices, right? So asset prices are forward-looking variables. So they're function of revisions and expectations over the whole path of policy rate. So the moment you start to have shocks driving the long-run natural rate, meaning markets don't know what we are converging towards, you're going to have massive market volatility. And this type of shocks are way more important than are we cutting next quarter by 0.25, because they're changing the whole trajectory of expectations going forward.
Okay, let me get to the volatility piece is really interesting. Before we get there then, what is the reason for this significant uncertainty on the path forward?
Perfect, that's a great question. It's supply shocks, and in this case, AI. AI is another supply shock, right? We don't know what this is going to do to the labor market. There'll be massive heterogeneity across sectors. A lot of discussion centers around implementation, right, and adoption of AI. But adoption of AI is going to be very heterogeneous. It's going to have very different impacts across countries and within sectors across countries. So we don't know what is the new real, long-run real rate, right? So this is a standard productivity shock, which is a supply shock. So supply shocks generate this kind of divergence in views because we don't know whether in the long run the real growth rate is going to be 2.8 or 3.5, how important is going to be AI for long-run growth, and then on top of that there'll be massive heterogeneity across sectors.
Do you expect to get a start to that answer next year?
No, there'll be no answer directly, but I do expect that there'll be way more discussions on that. And this is going to show up in the numbers through impact on employment across different sectors, through impact on productivity. I do expect that we're going to get an interesting dynamic where you might find good profits, which we have been seeing in the US in certain sectors that are linked to tech, bad performance in others. It will be a function of the adoption of AI and other factors, but moreover, the labor market is where we're going to see much more bifurcation, right? We see, for example, in the UK and in the US, where certain jobs still demand higher wages and high inflation in terms of wages if they're complementary to AI, but to the extent that some jobs are going to be substitutes to AI, those jobs are going to disappear, and the wages in those sectors are going to become lower. So central banks will have to deal with this heterogeneity, which is going to be even bigger than what we've seen so far as AI starts to get adopted across different sectors and countries.
That's really interesting. And so this increases volatility, and,
yes.
and investors should be prepared for that in the years ahead as a result of what you've just described. Do the frameworks does the central bank frameworks need to be reworked in light of this uncertainty and this fundamental change?
Absolutely. It creates a massive problem for central banks because historically central banks hit it easy. What do I mean by this? The correlation between the unemployment rate, output gap, real GDP growth was very strong. And they almost use these different variables as substitutes. This will no longer be the case. You can have very fast real GDP growth and the labor market doing very poorly, etc., and then they will have to prioritize. Clearly, the Fed has a objective function which is linked to the employment rate, but having said that, even there'll be massive heterogeneity, and we are seeing this in the UK as well. I mean, fiscal policies are not helping, of course, in the UK in terms of creating high unemployment among lower income and younger people, etc., but more divergence, much harder objectives in terms of how we define them and how we measure things. So we need central bankers that are equipped to tackle those problems.
Really interesting, fascinating. Vanya, thank you very much indeed for bringing that insight to us this Friday morning. Vanya Stavrakeva, Assistant Professor of Economics at the London Business School. We're going to stay on AI and do a deeper dive into a particular sector of that space because Swedish AI startup Lovable has just closed a $330 million Series B funding round, valuing the company at $6.6 billion. That is treble the valuation from the company's previous round back in July. Lovable specializes in so-called vibe coding. Its AI-powered platform enables users to build applications without writing code. The latest fundraising round includes the VC arms of both Alphabet and NVIDIA. Joining us now exclusively is Anton Osika, CEO and co-founder of Lovable. Anton, fantastic to get your time. Congratulations on the raise. It is significant. It's a chunky amount of money. How are you going to be putting it to play, Anton?
Great to see you again, Tom. And we're super excited about this new era where anyone can build. And what we're going to do is to continue to support both founders that have been starting new companies from scratch using our product and the really large companies out there that we're seeing a lot of success using Lovable. Microsoft, Uber, and a large part of Fortune 500 companies. And what we're building out is more integrations to everything else that you're running your company and collaborating with. So other tools, where many of these tools are investing in this round. So we're seeing support from HubSpot, Databricks, as you mentioned, NVIDIA, and many more. And then on top of these integrations, we have been differentiating in making vibe coding secure since the early this year, and we're going to continue to invest in being the most secure place to build with AI.
That's really interesting, and you're bringing me to a question around the enterprise push for you and the team, Anton. How significant to the revenue streams from enterprise, and you've already, as you've mentioned, got companies like Klarna, Uber, Zendesk already adopting your services and your platform and your capabilities. How important does enterprise become for you versus the individual, and how are you ensuring that security component for them?
So the shift we're fundamentally seeing is that building things has been the biggest blocker for businesses, and many individuals are now discovering how much you can get done when you build software without being bottlenecked by not being able to code. So the individuals are the ones who have discovered the power of Lovable, and they are taking it into their work, into the enterprise. And at the same time, we're seeing people who discover Lovable from their colleagues and bringing it out into their small businesses, to their personal use cases. So we're focusing on making the enterprise adoption much easier over the coming months. It's, as you say, there are all of these companies that are now even listing Lovable in job requirements as they're hiring more people. At the same time, we're supporting both of these groups.
So, Anton, on the security part for enterprise, how do you make sure that AI-developed apps are both secure and auditable?
So I love that you bring up auditable. So one part is, of course, that the software that's being created with Lovable does not have security vulnerabilities. And that's something that has been traditionally very difficult to guarantee, because us humans, it takes a long time for us to verify that something is secure. What we're starting to see is that AI can much faster validate if code is secure. Currently, we don't have a 100% guarantee that something does not have a security vulnerability. It's in the same way that your iPhone might have a security vulnerability right now. But we're seeing that AI is going to be able to do this better than humans. And then the other part is the data and being able to audit who has access to which data. And that's something where we're pushing forward a new standard for how you give access to the AI and how you give access to AI agents and how you give access to humans of which data in your enterprise, which is currently a huge pain point where configuring who has access to what has been a blocker for productivity in large companies, medium companies, even in the government.
Anton, I want to get you some growth stats from you. So you famously hit $100 million in annual recurring revenue, that milestone, within just 8 months. You doubled that 4 months later. What is annual recurring revenue looking like by the end of this year, and what's your target for next year?
So I'm looking forward to see what happens next year. But what I can say is that we've more than tripled the revenue since our last fundraise, and we're so far this year. Since we decided on taking the investments from this round, we beat our projections. And what we're focusing on now is just to make our customers as successful as possible, because we're doing this for the coming decades, as we think that we have an opportunity here to architect how do we humans build software. And that's going to be a very, very long-term effort. I think it's early days in everything that we're doing, and that's why we're so excited to partner with the current investors that are coming on.
Anton, let me push you on the ARR. Are you at 300 million right now or above that?
I'm looking forward to get way past 300. As I said, we announced 200 like a month ago, and we're way beyond that right now.
Okay. It's a competitive space, Anton, and one of your main competitors, Cursor, valued at almost $30 billion US dollars. What differentiates you from the competitors, and do you see consolidation in the space, or is this a winner-take-all?
So what we're hearing from everyone who loves Lovable and uses Lovable is that it just works. There's a lot of complexity under the hood that Lovable is reducing, while using that like simplification to ensure certain standards. For example, in terms of security and how the applications on Lovable are built to be secure and have AI included from the get-go. So there's this simplicity that we think is the future of how us humans will want to build software. And as for how this looks in the future, there are piles of gold in what value you can unlock for businesses and for individuals across the board. We are ensuring that we create an interface that can be used by everyone, by CEOs, CROs that are building their command centers in Lovable right now, as well as your mom and pop store that's creating a new website for this.
Anton, what stops OpenAI and Anthropic replicating what you do?
So it's a very complex product that we're building, and that's something that we're seeing when people try Lovable, that all of this complexity is boiled down. Maybe there's some Scandinavian design taste that people talk about that makes people just keep coming back to Lovable and absolutely love the experience.
Okay. Anton, I'm going to try and fold two questions into one. One is, you get asked this all the time, but your view probably changes because the environment changes. Who are the losers and who are the winners when it comes to jobs as an impact of this? And how are you thinking about an IPO?
Okay, so the winners, I think, is what we're seeing since we launched Lovable about 1 year ago, is that there's a movement being spawned of that everyone can create. And this is extremely empowering, both to individuals in large companies and, for example, founders and educators for starting new companies and new economic opportunities. I think it's truly an example of AI being a democratizing force, where it was previously very difficult to collect a team that could create amazing software. Now, anyone, anywhere in the world can do that. I don't see, I see this like democratizing force as something where there will be more winners, and currently maybe some of the big winners are going to have a more competitive experience, which I think is good, very, very good for consumers. As for an IPO,